we have been hearing pretty positive news from a lot of retailers, which I find absolutely fascinating.
I thought one of a really good quote, just to remind everybody of, in the Wall Street Journal story, was in February, where Jim Farley at Ford said that the proposals at the time would have a huge impact on our industry, with billions of dollars of industry profits wiped out. And at the time, you saw those auto companies trading really negatively. Instead, what did we get from the earnings? Everyone's buying heavy trucks. Everyone's buying really expensive cars. Things did not play out the way we expected them to. It was a really humbling year, and maybe a good reminder as everyone's putting together the 2026 forecast.
Well, and some people have noted, and I know that Eddie Ardeni is coming up, and one thing that he has talked about is that the stock market's not the economy, but kind of it is, because increasingly the stock market gains have really fueled a lot of the consumption at the upper end. And so if the stock market does decline materially, you could see the one ballast of the consumer economy lose some steam, and how problematic that could potentially be. And so you wonder at this point how much the Fed is between a rock and a hard place. On one hand, they want to support people who are on the lower end who could lose their jobs. On the other hand, you're dealing with the potential for a stock market shock that would eliminate one of the one bastions of this particular economy.
That's part of the reason why last week's sell-off, I mean, I hate to use the word ironic because obviously it was very painful for a lot of people, but there was some irony behind it. Because part of the reason you got the sell-off, or at least that initial shove to get the sell-off happening, was a hawkish Fed. So you had fears that the cut's not coming. The market sells off. The market sold off badly enough that people started assuming that a cut would come, that the Fed put would come back and would rescue the market. We heard from Williams. That was the thing that saved us all. So yes, it was AI, it was credit concerns. But the real thing that's allowed the market to sell off or to recover has been expectations for a cut, and if they would save the market were it to sell off.
Meanwhile, what you are seeing is this expectation that the Fed will be able to cut rates. We are getting retail sales tomorrow from September, so a little bit stale, but nonetheless some data. We're also going to be getting PPI, a very big focus on Wednesday with the jobless claims. They are early, as well as the beige book afterwards, based on the fact that that is the reference period that a lot of people would be looking to for the jobs report. So a lot of people thinking there will be a greater emphasis on that going forward.
Does it help clear up any of the fog that Chair Powell is driving through? I don't know if it does. It's still not a lot. You can only sort of go on what we've heard from corporate America, from these little bits coming out. Again, we're also going to get delayed retail sales for September, but is that out of touch as we're about to get a big Black Friday spending period?
Coming up, we're going to be speaking with Commerce Secretary Howard Lutnick. That conversation on trade coming. At the top of the hour, also Eddie Ardeni of Ardeni Research, Lorraine Hutchinson of Bank of America, Neil Dutta of Renaissance Macro, and Noor Christiani of JP Morgan Private Bank. This is Bloomberg Surveillance.
a rate cut at the next meeting. We're going to get a flood of data that's released, and if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Well, that was Fed Governor Chris Waller. For more, let's bring in our executive editor for Asia Markets, Paul Dobson. So, Paul, we've heard from Williams, we've heard from Waller, we've heard from Daly. They are all making the case for a cut in December. The Wall Street Journal reporting that is where things are starting to line up, that they're giving space for Jay Powell to push for a cut in December. What could potentially derail a move lower in rates next month from the Fed?
Yeah, good morning, Tom. Well, I think it's far from nailed on that the Fed will be cutting in December. Think back to earlier in the month when we heard from a bunch of policymakers who were saying they didn't even want to cut last time, let alone are they convinced that December is where they want to go. So the jury is still out a little bit, but the market is definitely gaining more confidence in the idea that they will cut again. This chorus of speakers that you just mentioned kind of giving that reassurance to the market and seeing that pricing come in. Analysts or economists are similarly, more of them favouring the idea that the Fed will cut, fewer expect a hold, but there is a decent proportion there as well. The Fed's dilemma is, as Waller was saying, the labour market on the one side, the inflation picture on the other side. Is inflation too sticky to have much lower interest rates, or is the labour market deteriorating so fast that interest rate cuts are not only warranted but necessary? These are the things that they're trying to get to grips with. The problem is we're in this sort of data vacuum to a certain extent on both of those fronts. Figures coming out after the next Fed meeting aren't going to be much help to them. So they're going to have to feel their way through a little bit and do it a little bit on instinct as well.
Paul, talking of data, we will have, of course, retail sales data for the month of September, dropping later today. Producer prices as well, PPI out of the US. Where is your lens going to be? Where is Paul's scrutiny going to be of this data that we get out later today out of the US?
Yeah. At least we do get some information that will give us a little bit more clarity. But look, I think the retail sales is September, so that's quite a long way backwards, looking already into the third quarter. We're already a lot further beyond that. So it will be helpful, but not that helpful. We also get some consumer sentiment, which might give us a little bit more of a current read on things. And I think that these what the consumer's doing and what retail sales look like is important, because we're seeing an increasingly strong narrative about the idea that the US is in this kind of K-shaped economy or K-shaped growth at the moment, where the poorest people are not really feeling very well off at all. They're suffering and struggling. They're struggling with employment. They're struggling with paying back their debts. We heard from retailers when they were reporting their earnings that there's not a lot of demand or appetite, and that's starting to sort of spread even into the middle classes as well. And so, if the data do give us more of a sense that that's happening, then that may be one more cause that the Fed hasn't been talking about too much yet for them to think about cutting interest rates. So it will give us some helpful information. Might not be great news for some parts of the equity market, but it might be good news for interest rates if we do get some negative data there.
Paul, on geopolitics, we had this call then between Presidents Trump and Xi, the first time they've had a call since their face-to-face meeting, of course, in South Korea. It's apparently lasted for about an hour, and President Trump says he's going to be visiting Beijing, or at least China, we know, probably Beijing, presumably, in April. Has this been a catalyst for the markets? How significant is this? What are investors kind of making assumptions about when it comes to the US-China relationship at this point?
Yeah, interesting, isn't it? Because this sort of came a little bit out of the blue, and we don't have too much information exactly at the moment. So it helped the mood music, I think, for Chinese equities, but it's not the clincher here. It's much more about that tech story and the growth story at the moment that's really been powering the moves. And you can see that US futures are down a little bit as well, so they're not getting a particularly big lift off it. I think, it speaks to this idea that the Taiwan question and the Japanese comments and the tension between China and Japan has gotten to a point where people want to try and find a bit of a circuit breaker or a way out of this. So after speaking with Xi Jinping, Trump also spoke with Japan's Takaichi, and you get the idea that maybe, there's a little bit of a hidden message or a bit of shuttle diplomacy going on to try to, bring things back away a little bit from where we are in terms of that escalating kind of rhetoric and actual physical moves as well on the defence side. So resolving that, actually, it would be helpful at the margin, I think, for markets, although they haven't particularly struggled so far or been weighed down by China-Japan tension. Nonetheless, clearing the air would definitely be a positive, not a negative.
Executive Editor for Asia Markets, Paul Dobson. Paul, thank you. Let's bring you some breaking news right now from the banking space in Europe. ABN AMRO, that stock is up about 90% year to date. The redhead across the terminal with an update from ABN AMRO on the jobs front. They will be cutting 5,200 jobs by 2028. That is compared to 2024. So 5,200 jobs to go at ABN AMRO compared to the 2024 headcount number. They also give an update in terms of their targets for return on equity of at least 12% in 2028. So they see a return on equity of at least 12% by 2028. That is the forecast. They see a cost-to-income ratio below 55%, and they see common equity Tier 1 ratio above 13.8%. Again, that is a 2028 year forecast. On the jobs front, interestingly, for those who are anxious about the AI impact, the 5,200 jobs that are to go, this is about creating efficiencies, they say. In a statement, operations are being simplified, driving efficiencies by reducing the number of legal entities, optimizing and digitizing end-to-end processes. Technology is central, with legacy systems being phased out, API use expanded, and AI embedded. That is a stock to watch today. Here's what else to think about today. At 7 a.m. UK time, EasyJet earnings will be breaking. We'll give you those numbers, of course, for that European airline. And later this morning as well, a gauge in terms of the AI progress over in China with Alibaba earnings. And, of course, their artificial intelligence prospects will be central to that. A lot of scrutiny on that one. And at 1:30 p.m. UK time, we're going to get that delayed September US retail sales print and producer prices or factory gate prices. So data out of the US, even though it's delayed later today. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to Day B Go on the terminal. In focus, question marks about NVIDIA and its dominance. It has about 90% market share for AI chips. But has Google just made a bold move in terms of this potential deal with Meta? To what extent is Alphabet going to be chipping at the heels of NVIDIA? That rivalry is in focus. Coming up, Kyiv under attack, Russia and Ukraine exchanging fire overnight. As US President Trump pushes for that peace deal, we bring you the latest next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersecci. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. So, US Commerce Secretary Howard Lutnick says President Trump will decide whether to allow NVIDIA to sell its more advanced H200 chips to China. Lutnick spoke with us from Brussels about the national security concerns surrounding Trump's decision.
That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from NVIDIA, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
US Commerce Secretary Howard Lutnick speaking to our team over in the US. Now, for the latest on US-EU trade negotiations, let's bring in Bloomberg East Asia Government Editor John Herskowitz. John, and meanwhile, we have these negotiations between the EU and the US, and that's why Howard Lutnick was on the ground in Brussels. Does it look like the EU is going to comply with these US demands to roll back some of its digital regulations?
We got some strong words from EU officials saying that these regulations are not on the negotiation table. So they're drawing the line. They're saying that they don't want to do this. But Letnick offered a deal to roll back 50% tariffs on steel and aluminum, which have really affected a lot of members in the EU. I think that this applies to about more than 400 products across the EU which are being hit with these tariffs. But the U.S. stood its ground, and the U.S. has really tried for many months to get the EU to change these regulations on tech firms. These have hit some of America's biggest tech firms. The Trump administration sees these regulations as non-tariff barriers that are creating unfair obstacles to U.S. firms. So it's a point of contention. Lines have been drawn, and we'll see if there's any progress from now as to whether either side will blink in this situation.
Bloomberg's East Asia government editor, John Herskowitz. John, thank you for that update. Coming up, Kyiv under attack. Russia and Ukraine exchange fire overnight. That's as President Trump pushes, of course, for that peace deal. We'll bring you the latest next. This is Bloomberg.
Up to the minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Bloomberg Daybreak Europe. Now, Russia and Ukraine have exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launching a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained suspected drone attacks. Bloomberg's chief Europe correspondent Oliver Crook joins us now with an update. Ollie, what is the latest on negotiations then as the two sides exchange blows once again?
Yeah, that's right, Tom. I mean, after those talks in Geneva, those 24 hours of frenzied diplomacy led by Marco Rubio, the Secretary of State of the United States, and Andrei Yermak, the sort of number two in Ukraine in Geneva, we have now sort of a new adaptation of that 28-point plan that ripped through diplomatic circles at the end of last week, something that is now apparently a 19-point plan. There were apparently a couple of different plans floating around over the last 24 hours. As you can imagine, Tom, the Europeans were trying to put forward a plan, but it appears that now it's this sort of 19-point 19-point plan that's sort of the living document that the United States is working from, and now is going to have to obviously take that back to the Russian side. The commentary from the Russian side so far is that the 19-point plan is a non-starter. We understand also from Zelensky, who briefed the people of Ukraine last night, as he does every night, that after the Geneva talks, that no longer the 28-point plan, many of the right elements have been taken into account into that framework. The action now turns to the UAE, where we understand Army Secretary Dan Driscoll, who has become a greater and greater protagonist in these negotiations, has met potentially already with Ukrainians, but more importantly will meet with Russian officials a little bit later today to get it past them. All of that being said, some of the most difficult points now in that 19-point plan, dealing with territory, some of the most most difficult political discussions have been actually removed from the plan and are going to be left for President Trump and President Zelensky to negotiate. And we understand from a Zelensky aide who I spoke to yesterday that could happen over the next couple of days. All of that being said, Tom, it seems pretty unlikely that this gets all squared and settled by Thanksgiving, which is this Thursday, which is, of course, Trump's initial deadline.
When it comes to pressure on Russia at this point, Ollie, because arguably the ball is moving back into the Russian court, what measures can the US and Europe exert at this point?
Yeah, so of course the sort of, I feel like a broken record bringing this up every single day. Of course, the Russian assets is the main lever of leverage that the Europeans have to exert on the Russians. They have failed to move on that as a 27-member state sort of unity. This is something that probably, again, I heard from the Lithuanian foreign minister yesterday saying that basically in a Trump world, you need to get your voice heard at the table by earning it, and the way the Europeans could earn it is by moving on those Russian assets. But we should say, Tom, we shouldn't lose sight of the fact that last Friday is when those Lukoil and Rosneft sanctions went into effect on the Russians. That is only beginning to hit the economy. That could have a major effect, but that again will be for months to come. And there is, of course, still that bipartisan Senate bill that is sitting with the United States. It is sitting on Donald Trump's desk. He just needs to pull the trigger, put it in front of the Senate and the House. That would likely pass, and that is the secondary sanctions, where the United States would impose 500% tariffs on anybody buying Russian crude oil, Russian gas. Those are the levers that the United States could still pull. And of course, the lever they can pull on the Ukrainians, which we've heard they've threatened to do, is to start to withhold military hardware and intelligence, which would be absolutely devastating to the Ukrainians. But those are the sort of stakes going into these negotiations over the next couple of days and what the United States and Europe can do.
Bloomberg's chief Europe correspondent Oliver Crook with that update. Ollie, thank you. Coming up, we're going to be discussing what tomorrow's UK budget could mean for the country. We're going to speak next to Laura Falk, portfolio manager at Janus Henderson, for a view on the UK equity space, how to think about positioning in and around that budget, which of course is tomorrow. That analysis coming up. Stay with us. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Tech stocks power gains across Asia, extending a global rally fueled by bets the Fed will cut rates next month. We're going to get US retail sales and factory price data later today. Nvidia shares, though, slip on a report that Meta is in talks to spend billions on AI chips from Google, a potential challenge to the industry leader's dominance. And Russia and Ukraine exchange fire with heavy air raids on Kyiv and assaults on parts of southern Russia, just hours after President Trump struck a positive tone on prospects for a ceasefire deal. Let's get to the markets right now. European futures looking a little soft, down 0.2% after some very modest gains for European stocks by the close of play yesterday. It was a stellar session, of course, in the US, with gains on the Nasdaq Composite of around 2.6%. The S&P 500 ended up around 1.6%. Tech, as a basket of stocks, the best day since around May. You saw gains of 11% for Broadcom, gains of more than 6% for Alphabet on that potential tie-up with Meta. It's not really giving much of a lift, though, to Europe at this point. Asian stocks have been up on the back of this story, particularly those exposed to the Alphabet story. European stocks, though, pointing led by 0.2%. FTSE 100 futures was really lead up to the budget tomorrow, pointing led by 16 points. S&P E-minis after the rally yesterday, a little softer by 0.1%, and the Nasdaq 100 futures pointing down by 36 points. Let's flip the board and have a look at the cross-asset board. US Treasuries relatively stable, yields up just 1 basis point after a move into the sovereign debt of the US yesterday on expectations the Fed will cut in December. It's not locked in yet, but we've heard increasing voices, of course. Chris Waller, the latest to come out and call for a December cut. 4.03 then, 4.03 on the benchmark 10-year. Euro dollar at 115. Bitcoin at 87,000, just crossing below that 88,000 level, down 1% once again in the session. And gold holding about 4,140 right now per troy ounce. The yellow metal up 0.1%. Let's turn our focus, though, to the UK, where markets, of course, are bracing for Chancellor Rachel Reeves to deliver the government's budget tomorrow. Laura Foll, Global Equity Income Team Portfolio Manager at Janus Henderson, joins me now with a lens on the UK and the UK equity space. Laura, good morning. Thanks for joining us. In the context of the FTSE 100 up 17% year to date, so outperforming the S&P 500, and yet the FTSE 250 underperforming significantly, up just 4% year to date. What would be a positive outcome for UK equities from the budget tomorrow?
So it's always going to be more material to the FTSE 250 because, as you say, that FTSE 250 is lagged because it's more domestic. So what would be a good outcome? I would say first and foremost, it has to be non-inflationary. So if we think back to the budget last year and the national insurance cost that was put on employers, the knock-on impact of that was that those employers then passed on those costs to the end consumer. Inflation was higher than it could have been, and so there was less of a path down for interest rates in the UK as a result. So I think the number one thing the market will be looking for is this non-inflationary and therefore allows that path of interest rate cuts that the Bank of England has given a steer to as we look ahead to next year. So that's the first thing. I think, secondly, it has to be credible. And what I mean by that is it has to raise what the government is forecasting that it will raise, and ideally sooner rather than later. So not towards the end of, say, the decade. The market will look for measures that raise money, ideally in the next couple of years, and that it will actually raise the money that's forecast. And finally, I would like to see, and I think both equity market investors and gilt investors would like to see, that it's non-distortionary. And what I mean by that is it doesn't put a heavy burden on particular subsets of individuals and companies to the extent that it changes behavior and also perhaps doesn't raise, again, what it's forecast to raise. So those are the three things in the front of my mind.
If we get a budget that does not involve an increase in income tax and is a smorgasbord of tax increases, as has been signalled, does that remain a credible and non-inflationary budget? Does it remain credible?
I think the nice thing, if you want to call it that, about the income tax rise before there was the U-turn, if that does end up being correct, is that income tax would have fulfilled those three things. It would have been non-inflationary, it would have been non-distortionary, and it would have been credible. So that's why the market reacted. It might seem counterintuitive, but the market actually reacted positively when it was income tax rather than, as you say, this smorgasbord. I think the path is narrower. If you're going down the smorgasbord route, the path to fulfilling those three things is more challenging because you're, by its very nature, relying on a large number of smaller taxes, but smaller taxes that will have to raise a fair amount, given that we're probably talking about 25 to 30 billion that needs to be raised. That's quite a lot of these smaller taxes. So I think from an economist point of view and a market point of view, that's not ideal. You're more likely to drive change incentives and change behaviour, and therefore not potentially raise the amount of money that you wanted to raise.
Has the lead up to the budget and all of the leaks and U-turns, possible U-turns, has that already damaged the credibility of this government?
I think to an extent, yes. And I think the other thing that you've seen is that some companies already have come out and warned about the knock-on impact that they've already seen in the real world. So, for example, the likes of ITV has come out and said that Q4 advertising has been weaker than they think it would otherwise have been. You've seen some of the house builders like Taylor Wimpey and among others come out and say this has impacted demand because consumers, completely understandably, are delaying big decisions. So there have already been real-world impacts of this, budget bingo or whatever you want to call it, that there's been kite flying, across the summer.
And you touched on a couple of sectors there. Is there a particular sector that stands out in terms of a potential vulnerability or potential upside as to what comes out of this budget?
I think it's been clear that property taxes will form part of this smorgasbord. The exact mechanics of that haven't yet been made clear. But house building was one of the areas that Labour mentioned in its manifesto last year, really centred in on. And I think property taxes, they will form part of it. And so I think for me, as an equity investor, I'll be paying particular attention to the form that property tax takes. It seems to be, if you're to believe the recent press, it seems to be in the form of higher council tax, which could potentially, gum up, for want of a better word, the higher end of the property market. But what it will be interesting to see is whether that's offset in any way at the more affordable end of the housing market with any kind of stimulating measures to boost demand.
Reports today that the banking sector will get a reprieve from higher taxes. Is that already priced into the UK banking basket, or is there an upside there if that does materialise?
I think if there is any upside, it's pretty minor. As I'm sure you know, the banking sector has performed incredibly well this year on the back of coming back to that NICS increase and inflation staying higher for longer. UK interest rates have stayed higher for longer. That's definitely already boosted banking sector earnings. So banking sector profitability is already relatively high. Valuations have moved up. I think if there is to be any benefit, it would be pretty minor in terms of bank shares.
You started by talking about the importance that this is a budget that is non-inflationary. That's what you want to see, and you tied that, of course, to the rates outlook. Yes. What is your current? I mean, of course, this could very much change in the next 48 hours. What is your current estimation? Your current kind of view on how the Bank of England responds in the months ahead, looking into 2026? What is your base case at this point?
Sure. Very willing to be proved wrong in the next 24 hours. I think, on balance, I think interest rates will be cut in December. So if we look at labour market data, I know there's been some issues with necessarily the accuracy of some of that UK labour market data, but it does point to a job market softening. We've seen unemployment tick up. We've seen wage settlements still above the 2% that the rate target is, the inflation target is. But I think it has paved the way, provided that there isn't any inflationary impulse in the budget tomorrow. I think it has paved the way for the Bank of England to do a 0.25 percentage point rate cut in December. And then I think as we look ahead to 2026, you're probably talking about another gradual pace of interest rate cuts. So perhaps a terminal rate of, say, 3.5, perhaps 3, but just that path of gradual rates down as we look ahead to next year.
And is that view on the direction of travel for interest rates here in the UK making an assumption about the smorgasbord of cuts, or is that making a bolder assumption that maybe she will do a U-turn on the U-turn and raise income taxes? What assumptions are you making about taxes in that view?
What it assumes is that there isn't an inflationary impulse in there. So what it would assume, for example, is that there isn't, say, if we go back to a couple of months ago, one of the things that was being speculated on was a VAT increase. That would be inflationary.
Yeah.
So it would assume that they don't go down that route. Now, it doesn't necessarily matter whether it's the smorgasbord or the income tax route, as long as none of the smorgasbord are inflationary and that they are seen as credible by the markets.
I want to go one more sector before we let you go, which is the retailers.
Yeah.
And some of them have had a pretty good year as well, despite the cost pressures. Tesco coming out with some decent results. We know that's been part of the conversation, according to reporting in the Treasury, as to whether or not they have scope then to raise business rates on some of those big retailers. How much of a, can they look through that? How much of a challenge would that be to the retailers if that came through? High rates on some of the big box retailers here?
I think it would be frustrating for the retailers to see business rates go up. If you think for the likes of Tesco, Sainsbury's, M&S, they've had things like the packaging tax put on them. They've had obviously NI, national living wage. The cost inflation that they've already seen as that subset of retailers has already been substantial. So I know that there's been some pushback from them about the business rates coming on. We ideally, I say this as someone that owns Tesco, Sainsbury's shares on behalf of my clients, they've done very well in terms of managing those costs. I think it would be frustrating to see extra costs put on them that would then ultimately probably end up in consumers' pocket as well.
OK, Laura, thank you very much indeed. Really great setup ahead of the budget, of course. Laura Foll, Global Equity Income Team Portfolio Manager at Janus Henderson, looking for a budget that is non-inflationary, credible and non-distortionary. Now, some other stories making the news this Tuesday. Apollo Chief Executive Mark Rowan has rejected the notion that adding private assets to retirement and insurance portfolios can pose a systemic risk. During a presentation on Apollo's retirement services business, Rowan said, quote, "People have really just lost their minds, and the headlines get more and more hysterical." Hopefully not from Bloomberg. Rowan told investors that most private credit held by insurers and pension fund buyers is rated investment grade. And today's Big Take looks at the topic of trade and whether President Trump's claim of $21 trillion worth of investment pledges really stack up. The short answer is not really. You can read the full story on the terminal and on Bloomberg.com. All the analysis, data and graphics around that story. Well worth your time. In other news, a federal judge has thrown out criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruled that the prosecutor who brought the cases had been illegally appointed. President Trump abruptly installed the prosecutor in September after her predecessor resigned under pressure to bring charges against the pair. Comey and James are among a group of Trump's perceived political foes who have faced investigations after the president called for their prosecution. European car sales climbed for a fourth straight month in October as the nation's or the region's automakers continue to push out more affordable electric models. The European Auto Manufacturers Association says new vehicle registrations rose 4.9% from a year earlier to just shy of 1.1 million units. China's BYD saw sales in the region more than triple, easily outstripping Tesla, whose sales continued to slump, with registrations down 48%. Bloomberg understands UK government ministers have approved London Heathrow Airport's £49 billion proposal to build a third runway. UK Transport Secretary Heidi Alexander is expected to announce that decision today. Sources say ministers backed the more costly option, which will involve moving the M25 motorway. That plan has come under fire from major customers, including British Airways and Virgin Atlantic, which argue that the hub is already expensive to use. Coming up, Funding Circle CEO Lisa Jacobs joins us to discuss the likely impact of tomorrow's budget on British business. We have that interview for you. More analysis in the lead up to the Chancellor's budget. Stay with us. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Welcome back. Investors will be keeping a close eye on the gilt market tomorrow, of course, as Rachel Reeves makes her much-awaited UK budget statement. Bloomberg understands the Chancellor will slash the amount Britons can save in their tax-free cash ISA saving accounts each year from £20,000 to £12,000. That's the cash component. We understand the move is a bid to get households investing more in UK stocks. For more, let's bring in Anna Andrade from Bloomberg Economics with some of the details and the potential implications. What do these ISA changes mean, Anna? We assume that the total cap is still 20,000. It's just that the cash component is 12,000, so you're compelled to put the extra 8,000 into equities, but not necessarily UK equities. Is that correct understanding?
Yeah, I think those are the broad contours of it.
Yeah.
I think from a public finance perspective, this is part of sort of a broader move of Reeves to sort of try to raise revenue anywhere she can outside, you know, the biggest four tax streams. So these include income, corporate tax, NICS, and VAT. So she's clearly trying to do her best efforts to sort of keep the manifesto, Labour's manifesto. I think I would say there's like two problems with these sort of moves, and, you know, going a bit after savings, a bit after pensions, is that the tax base is much narrower. So she actually needs to do bigger policy changes to yield any sort of significant revenue, and that will only yield a few billion. And then there's a lot of uncertainty about the sort of the revenues it will generate, because people might just stop saving into cash, as you said, and so then, you know, there's not that much revenue that will sort of come from that. So in a way, you know, it's a bit of a risky move, I would say, to sort of rely on these sort of like going after savings, pensions to sort of fill a hole that's as big as 30 billion.
Does that keep the bond vigilantes on their toes then? How much of a risk are the bond vigilantes tomorrow?
I definitely think the composition will be the composition of the savings, of how she fills the hole, of how she gets to sort of this 30 billion, if that's the right amount, will be something that the bond vigilantes will care about. I mean, the income tax has been ruled out, and the risk that she relies on these sort of small measures, it means that, you know, I mean, I think it means uncertainty about the exact revenues she will get, but I also think the other thing that the bond vigilantes will be looking at is the profile. So if she does the fiscal tightening sort of in the next few years, that means, you know, that the revenues will start to come in quite soon. But if she backloads the fiscal tightening, you know, I think investors will start questioning, are they going to follow through with those changes, because 2029 is an election year. So, you know, they might discount a bit of that as well.
Anna Andrade from Bloomberg Economics, thank you very much indeed. And that brings us to our next guest, Lisa Jacobs from Funding Circle, for a view on what is needed around SMEs, small, medium-sized enterprises, of course, under pressure, given some of the economic challenges here in the UK. Lisa, let's bring you in at this point. What would you like to see, and your members, your customers, I should say, like to see from this budget?
I think it has been a really tough time, like you say. You know, our small businesses are finding the environment quite tough. But what they really need to see is that stability, to see that long-term stability that gives them the encouragement to want to invest over the long term. The government has said before that they should have one budget a year. I think that would be a really good start for them to focus on.
How much has the instability that we've seen leading up to this budget put a dent on the animal spirits of the SME space up until now?
Yeah, I think if I look back over the last 10 years, actually, it's been a difficult time to run an SME. And when I speak to my customers, they say, you know, we've had Brexit, we've had COVID, we've had the cost of living. They've built the resilience into their businesses. They've built the resilience into how they run it. So I think it has been a distraction. And they would much prefer to be focused on running their business. The average small business we support, they're about 10 employees. The person who's running that business is doing the sales, the marketing, the finance. They want that certainty to enable them to continue to run their business.
So what amongst the policies that have been floated so far have been most encouraging or most concerning for your customers?
I think the one that we think is a really positive move would be to support businesses with business finance. There is a growth guarantee scheme in the UK. It's working really well. That should be expanded. It's about a quarter of the size of the equivalent one, GDP adjusted, in the US. Because when we see that businesses get finance, they go on to invest in their businesses, they employ people, and they continue to grow and support GDP. So we think that would be a really important move in the budget.
What are you able to give us a approximate proportion of your customers that are holding back on investments at this point? Need that stability, need that clarity before they pull the trigger on investing?
Yeah, we've got actually a really big range of small businesses that we support across the country. So we've got fine art foundries in Edinburgh, we've got chocolate manufacturers in Somerset, we've got furniture manufacturers in the Midlands. And so actually they have varying different degrees of investment appetite. Some actually are thriving in this market. They're finding confidence is good for their segment, particularly those who serve an affluent base. And others are holding their nerve a little bit and working out what's coming up in the budget.
Oh, interesting. Okay, so businesses that have exposure to higher-end consumers are faring well in this environment.
I mean, we have a restaurant business here in London who their customers come once a year for a treat, and so they've been able to pass through prices, continue to grow their business.
What are the biggest funding challenges, and what's needed to widen the access to funding for SMEs in the UK?
So I think actually over the last decade there has been a significant increase in the competition in the market, the choice for small businesses. We now find that over 60% of funding to small businesses is coming outside of the traditional high street banks. So there has been this change. 60%, that's correct. So there has been this change. We have originated over £16 billion now to 110,000 businesses. So I think two things. One is awareness of these alternative sources out in the market for small businesses to get funding. And then the other thing is this, on the demand side, for small businesses to want to invest in their business, to continue to want to invest in their business. And for that, they need this stability. They need to be able to see a 5-10-year horizon where they can invest in their business.
Our previous guest was talking about the fact that she wants to see, from the equity investor perspective, a non-inflationary budget. To what extent are your customers absorbing costs up until this point, whether it's national insurance or input costs, or passing that on to the consumer? What is that dynamic looking like?
Yeah, we see them doing a bit of a combination of both, actually, and also, importantly, innovating around their products. So we have a chocolate business in Somerset, and actually cocoa prices have increased significantly over the last year, almost doubled. And one of the things that they've been doing is expanding their product set, thinking about how do they use different sources of confectionery in their products, how do they expand beyond just that chocolate. And so what we see is this continued innovation, continued resilience happening in small businesses across the UK in order to counter those cost prices, whether that is in raw goods or whether that is as a result of policies.
Lisa, great perspective. Thank you very much indeed on what the SME space of the UK needs from this budget tomorrow. Lisa Jacobs, CEO of Funding Circle. So, UK Chancellor Rachel Reeves, of course, will deliver that budget at 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. It doesn't stop there. The opening trade will break down the numbers with key business and political voices in its budget special the day after, on Thursday, of course. There's a lot more coming up. Stay with us. This is Bloomberg.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back. So a decent session overnight on Wall Street. The S&P 500 gaining around 1.5, 1.6%. Importantly, for those technical analysts out there, breaking above its 100-day moving average, and comfortably so. 6,552 is the 100-day moving average. The S&P 500 ending comfortably above that at 6,705. The next level then is the 50-day moving average, 6,713. If we cross that level and remain above there, maybe that is a further support for the S&P 500, particularly as these bets around a potential Fed cut in December continue to mount. Given the commentary we're hearing from FOMC officials, we know the debate continues to be live, of course, but money markets pricing an almost 90% chance. So above the 100-day moving average, the next line to cross is the 50-day moving average for the S&P 500. Watch that today. Let's flip the board and have a look at what happened in the tech stocks yesterday. A very, very powerful rally indeed for the Mag 7 names. And that crushed volatility. It fell to 20, so just above 20 in terms of the VIX index, as Mag 7 stocks gained, particularly Alphabet, up around 6% by the close. You also saw Broadcom closing higher by around 11% as well. Nvidia, of course, challenged on that competitive threat from Alphabet. But again, volatility has been squeezed lower as a result of that. Talking of Alphabet, this is now a clear leader in the AI space, given its dominance across the stack, from data centers to chips to the product to the models. The Gemini 3 model has been very well received. The gains, more than 70% year-to-date for Alphabet, just outstripping its competitors by a long margin when it comes to the likes of Meta and Microsoft and Amazon. Meta up just shy of 5% year-to-date versus 70% for Alphabet. Coming up, we will be speaking with EasyJet's CEO. That's coming up. The Open Traders next. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first lessons opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing, because I never watched the movies. You know, I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So Example, Nobu Hotels idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Global equities rally fueled by Fed rate cut bets as Governor Christopher Waller says he's advocating for rates to go down, but European and US futures are now slipping. Google parent company Alphabet rose in late trading, while Nvidia dropped after reports Meta is in talks to spend billions of dollars on the search giant's AI chips. Plus, we'll bring you results from EasyJet this morning and speak with the airline's CEO. This, as sources say, London Heathrow's proposal for a third runway is set to be approved by ministers ahead of the UK budget tomorrow.
In the meantime, quick check on these markets here. Starting to take a little bit of a breather when you look at the futures picture coming off of the rally that we saw yesterday. Eurostoxx 50 futures down 0.3%. Over in the States, a similar story, down about 0.1%. Keep one eye on the bond market. The Fed very much in focus. A 10-year yield that's really headed right back down to 4%. At the same time, it's the countdown to the budget. We're looking at cable at 131 this morning. The countdown to the opening trade starts right now.
Tuesday morning, good morning. All I want for Christmas is a rate cut. That was certainly the message that we got yesterday from the markets, loud and clear. The doves are out in force, and the market loved it. Yeah, we're rolling over a little bit this morning, but wow, that was a rally yesterday.
It absolutely was. And this is piling on. This came after Friday from John Williams talking about the need for a rate cut. And going into all the dovish talk, it felt like the consensus was moving in the opposite direction. So this means more. I should say, though, the comments we're getting from Chair Waller, we got to take with a grain of salt. He is one of the shortlisters and one of the contenders to be the next Fed chair. And I think Scott Bessent yesterday narrowed down the list even further. Now there's only 3 candidates, and Chris Waller is one of them.
Mary Daly, seen as being quite close to Jay Powell.
Yeah.
John Williams, seen as being quite close to Jay Powell. Is Jay Powell sending a message to the market? The blackout period starts on Friday. That would maybe be the narrative that I think the market is latching onto here. It is clear that the market desperately wants a rate cut.
Yes, and some people making the point that nobody at the Fed has come out to correct the interpretation that was given to those Friday comments as being sort of pro-risk, and no one's come out to sort of speak in any other way about the rate cut expectations for December. So that in itself interesting. I thought Daly was interesting in this conversation about non-linear drops in the labour market and that being increasingly a concern, because we had heard so many comments, to your point, Chrissy, about inflation, lingering inflation concerns in recent weeks. And that narrative just seems to have pivoted a little, despite all the darkness in the data, the blackout in the data, the fact we don't have the full picture.
There's 2 camps. There's obviously 2 camps in the Fed. The question is, which one does Jay Powell sort of err towards? And is that what we're going to see? Because he came out and surprised the market in the last press conference after the last rate decision, and he was clear and quick to be clear that there is a divided Fed here.
Yeah.
But does it slightly err one way or the other? How divided is it? Does it mean we can get a rate cut? Does it mean we can't get a rate cut? That's kind of, we're dancing on a pinhead here in terms of where we are.
Money markets seem to be increasingly convinced, though, don't they? I think, was it 90% chance now that we
we were at 100 and something. It's come down very rapidly and bounced.
Yeah.
And plus, with the whole background of the repo funding pressures as well, that's something that our very own Valerie Teitel has been warning us about for a couple of months, especially going into year-end when you're already getting some of the tightening of the balance sheets as well. I think it's also crucial, though, is this market too dependent on the possibilities of rate cuts, or is it a completely different narrative? Is it tech? We've had guests on the show who've talked about it both ways, that the Fed is greasing the wheels of the tech rally, and maybe that are 2 separate issues. Let's talk about tech.
Yeah, let's talk about tech. I mean, John Author's talking about the Greenspan put being back, but we'll pick up that conversation perhaps later in the show. So tech. I'll start with the big picture. I've read some commentary this morning suggesting that the reset we've had, or the sell-off you could call it, in tech and tech valuations is maybe setting us up for something more positive in tech in December, some kind of Santa rally, maybe. We will see. But in terms of the overnight news flow, or yesterday into overnight, because this is still having an impact on the Asia session, Nvidia down, Alphabet up. Alphabet's role, increasing focus on what they're doing in the chip space and the TPU space, as opposed to what Nvidia is selling. And that seems to be what Meta is going after. And so this has been a bit of a negative for Nvidia. And you can see it in the Asia suppliers. So Asia suppliers to Nvidia down overnight, Asia suppliers to Alphabet up overnight, as if the market is taking this kind of reporting really quite seriously, all coming on a day when we're really focused on AI because because Alibaba also reports.
The market, you could argue, and by extension the US economy, is largely built on Nvidia's outperformance. The fact that Nvidia is going to continue to perform and perform very strongly and be able to deliver the kind of margins that it has been delivering. It is feeding the data center story, which is feeding the US economy. If that starts to falter, if those margins are questioned, if Nvidia can't fulfill that role, then that, I think, is a big question. Then you've got the kind of OpenAI relationship, which I think is interesting. We were talking about SoftBank before we came on air and what's happening there. Big hit there. If Nvidia, by extension, and OpenAI are struggling, how does that change the ecosystem and this circularity that is built into it at the moment?
That's the Nvidia piece of it. There's a geopolitical piece to this as well, in that, and Bloomberg put out a great story this morning talking about just how much of the fiscal boom is tied to those AI investments.
Yeah.
Some of that is the partnership between Jensen Huang and Donald Trump, frankly. They're talking about 21 trillion. I think it's trillion. 21 trillion. That sounds right. 21 trillion of promised investments from the Trump campaign, only of which 7 trillion are actually looking to manifest. But if you look at the category, it's all AI, it's all chips, it's all manufacturing.
That's what I mean about the US economy.
Yeah.
That's the US economy link.
But if Nvidia loses to Alphabet's gain, that would be one thing. But if it loses to China's gain, that would be another. And that's why I think it's really interesting, the advancements that Alibaba is making with its rival product to OpenAI, Qwen, just launched yesterday, really strong demand, and so that puts the focus on them as well.
If there is competition, are there lower margins? So at the moment, Nvidia is making amazing margins. You saw it, and the results were amazing. The results are sensational. And there is a kind of question around demand in being asked about Nvidia after those numbers. But nevertheless, the numbers were sensational, and the margins are sensational. But if you've got a choice, we start getting kind of trade-offs, and margins come under pressure. And that's where I think kind of the Nvidia valuation will be questioned. But you can take it back to the Fed as well. Fed rate cuts will help. If you want a high multiple, Fed rate cuts certainly deliver. Let's talk a bit about EasyJet. It's quite a pivot, I know, from the chip space to EasyJet, but we're going to do it anyway. You've got EasyJet numbers out this morning. The numbers look all right. I think the dividend is a little light in terms of what Bloomberg was expecting. The question now is what happens over the winter. I think there's a big question about what happens in terms of the demand picture post-budget. Going into the budget, I think, is an open question as well. There's a Heathrow story floating around this morning about the fact that the government has apparently greenlit Heathrow. I speak to very few people in the airline industry that think that Heathrow can have a third runway at a cost that is...
They see only costs.
They see you've got to move the M25, for heaven's sake.
I know. At the risk of sounding like somebody else's talk radio, that sounds expensive.
It's very... Anyway, it sounds expensive. So EasyJet doesn't operate there, so it's a Gatwick story and other airlines as well, and other airports as well. But it's going to be interesting to see what they say about the demand picture. We're going to speak to Kenton very shortly. Kenton Jarvis, the CEO of that airline. What is he going to say? Now, remember, people like Michael O'Leary have been pushing very hard for the budget to deliver cuts to airfare duty. He would like to see that happen. It's unlikely to happen. This looks like it's going to be a tax-raising budget. So we're in the kind of final countdown into that budget now. Excited is the wrong word. Trepidation, maybe.
Yeah.
The latest is on ISAs and all kinds of things like that. We're in the weeds.
We are in the weeds now. The latest, we're going to get that drip of news or leaks.
We've had it for months. What are you talking about? It's been going on for...
Maybe it turns a little more into a torrent, but limited on cash ISAs to £12,000. That seems to be the latest newsline overnight. That's the focus. Elsewhere, there's a focus on what's going on with FX markets. Are we going to see traders trying to protect themselves from downside in the pound? Are they going to start protecting themselves from volatility and gilts? All of that conversation, no doubt, still
Do you buy UK banks this morning on the idea that maybe they're not going to see a further levy being attached to them, but if they do see that that happening, they don't get to say negative things about the budget. That's what the FT is leading with this morning.
They're also talking about, in the FT, but also our own markets reporting, suggesting that people are really piling in on the shorts when it comes to the pound. So maybe we do see some sort of bigger drop down. We're looking at 131 at cable. It's kind of been floating around the 130 level.
So I was thinking about this. Is there the opportunity, if people are short going into this, that actually it's not quite as bad, and actually you get a bit of a short squeeze in the pound, which would paint a more positive picture than maybe the budget actually delivers,
I mean, and it was
just because of positioning.
The protect against the weak pound argument was all about weakness in the UK economy, and I just wonder whether the immediate growth prospects for the UK are going to be the thing that the market focuses on. Thank you.
What growth?
Well, but is that going to be the focus, or is it all going to be about debt markets? In which case, the pound might have a different reaction function.
I think it's just a positioning. It's just a positioning argument, which I think is going to be fascinating, and you can kind of see that on the screen at the moment, how the market is set up going into this. Anyway, let's talk about what we're going to be doing. What is it, tomorrow? It is tomorrow. Finally, we're there. We're almost there. The UK Chancellor Rachel Reeves is expected to deliver her budget at 12:30 p.m. in London tomorrow. We will, of course, bring that for you live for UK and European viewers. Full coverage and analysis as it happens around that budget. It doesn't, of course, stop there, though. The opening trade will break down the numbers with key business and political voices in our budget special, which is happening first thing on Thursday morning. What have we got coming up on this morning's show? We're getting a little bit ahead of ourselves. Anne Whitty, Bahuguna, Northern Trust Asset Management Global Co-Chief Investment Officer, is going to be joining us. Helen Miller is from the Institute of Fiscal Studies, the director there. We'll get her take on what is happening here. Kenton Jarvis, as we've already mentioned, the EasyJet CEO, is going to be joining us. That's just kind of the first wave. Second wave looks a little bit like this. Hugh Gimber, JP Morgan Asset Management Global Investment Strategist. Florian Duetto, the data IQ, not IQ, IQ I think is the way to pronounce this. CEO is going to be joining us from Paris. And then we're going to be speaking to Rupert Harrison, PIMCO's Senior Advisor for the UK, a little later on the show.
Let's talk about plenty of data and other kind of tradable points you want to keep an eye on as well. We do have an auction coming up in just under 2 hours here in the UK. £4.5 billion worth of Treasury gilts due to hit the market. Plus, of course, plenty of data coming out of the States later in the day. 1:30 p.m. UK time. September retail sales, some delayed data hitting the wire. Plus, of course, those US PPI numbers. And then we are back in the thick of earnings. We have Alibaba later this morning, UK time, HP and Dell after the bell in the States.
What else do you need to know this morning? Let's figure it out. Russia and Ukraine have exchanged fire overnight. This, of course, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launched a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained damage, we think, from drone attacks. The EU's antitrust chief has ruled out easing the bloc's tech rulebook. This after the US Commerce Secretary Howard Lutnick said Brussels needed to change its digital regulation in order to get a deal on lower steel and aluminium tariffs.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
Another factor in yesterday's bounce, maybe the following story. President Trump and his Chinese counterpart Xi Jinping have held their first talks since agreeing last month on a tariff truce. President Trump said the call was very good and touched on issues such as trade and Ukraine. He also says he will visit Beijing in April and that he has invited President Xi for a state visit next year. But the White House readouts of the call did not significantly mention Taiwan. A Chinese Foreign Ministry statement says that Xi told Trump that the return of Taiwan to China is a key part of the post-World War II international order.
Yes, I mean, that was what was really interesting, wasn't it? The fact that the readouts from the two sides had very different emphasis. The US side emphasising trade, the Chinese side emphasising what's been said on Taiwan. On the subject of Taiwan, we've got further comments coming through from the Chinese this morning. China asking airlines to extend their Japan flight cuts until March, so an extension of what's previously been initiated by the Chinese with regards to Japan. And we've seen this point of tension many times, and we've seen it being exercised through trade and restrictions on people's ability to trade with each other, in this case aviation, in the past. But what's really interesting is the extent to which we have not seen much progress on China-US relations. I mean, they haven't deteriorated with this phone call, but there hasn't been much progress, and we still don't have the rare earth deal. You know, the finer details of that still being ironed out, and Besson had said he wanted it by Thanksgiving.
Yeah, it's fascinating one that this is getting kind of entangled here, because just at the same very moment that Donald Trump is trying to perhaps extend that olive branch to China, he also just made a big show about the partnership with Senae Takaishi on, I think it was the USS George Washington in the Pacific, and it was this big show of strength. So what side do you kind of lean on?
He's trying to balance the boat. He's trying to balance both, isn't he? He basically doesn't want to erode the China deal.
Yeah.
But he needs also to make sure that, as you say, that relationship with Japan continues in the way that it has been developing.
Which is such a big part of the American defense strategy in the South China Sea.
So he's got a tricky deal to manage here, I think. And I find it interesting that the Chinese are talking about this going on, this flight ban going on until March. So this is not something they see being resolved kind of quickly. They're not doing it on a kind of week-by-week, month-by-month basis. Like, it's the spring. That's the next time we're going to take a look at this.
Yes, it is interesting also, though, on China-US relations that we do have plans in place for Trump to go to Beijing in April, and President Xi has been invited to the United States later next year. So we'll see whether the Japanese relationship and what has been said around Taiwan has the ability to throw that the relationship between the two world's largest economies off track or not. We'll continue to monitor. Coming up on the programme, back to corporate news, and ABN AMRO Bank plans to cut 5,200 full-time roles by 2028 as the new chief executive officer, Marguerite Bérard, unveils her vision for the lender. We'll check in on the share price reaction at the open. Plus, we'll have more on those EasyJet earnings. We'll be speaking, as Guy's been saying, to the airline CEO, Kenton Jarvis. That conversation coming up later this hour. Up next, though, we dive into the markets. Fed rate cut expectations to the fore. We'll talk to Northern Trust Asset Management's global co-CIO. If you have any questions, please get in touch. IB plus BBTV Go is the function to use to do that on the Bloomberg terminal. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
Tuesday morning, good morning. This is what futures look like. Yesterday was an incredible day. I think you've just got to bear that in mind. In some ways, what you see on the screen in front of you doesn't really bear any kind of resemblance to the reality of what we've seen over the last few hours. Markets are sharply up, and the reason they are sharply up, well, there's a number of reasons. Trump-Xi, you could argue, what's happening in tech, but actually probably most relevant is what is happening when it comes to the Feds. Christopher Waller out yesterday signalling his support for a December rate cut. Now, he's been on that camp. He's been on that box for quite some time. He spoke to Fox Business yesterday, very much though echoing earlier comments from other officials, including in the Wall Street Journal, San Francisco Fed President Mary Daly.
My concern is mainly the labor market in terms of our dual mandate, so I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released, and if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Meeting by meeting. Next Fed Chair? Maybe. Anne Whitty, Bahuguna, Global Co-Chief Investment Officer at Northern Trust Asset Management, joining us around the table. Good morning.
Morning.
December?
Yes, definitely in the cards.
On the cards or a racing certainty now?
Given the statement by Waller just now and Mary Daly, it's getting very close to near certain.
Yep.
And one factor to consider is that once the market probabilities are this high, Fed follows through.
And December's the blackout. Sorry, Friday's the blackout period for the December meeting.
So they have a few more days to correct course.
Yeah.
Otherwise, if the probability is 70, 80...
Let's get a bit more nuanced. What kind of a cut will it be, though? Because Waller's talking about kind of meeting by meeting beginning of next year. Is it going to be a hawkish cut? I.e., will Powell have to recognise there are those on the FOMC that are still concerned about inflation?
Absolutely. Absolutely. I think it'll be a cut that comes with a statement that from here on, we are meeting by meeting. We are watching inflation numbers.
Yeah.
They are rightly so worried about growth at the moment, on the labor side, I mean, with the unemployment rate picking up a bit in the last data. And then we have this gap of data where some of the data releases won't be available until after the December meeting. And so they can really afford to wait and see, is the labor market deceleration continuing, or are they now seeing more of a pickup in inflation?
To what extent, though, given the choice, if Jay Powell does have to take this massive U-turn from the hawkish tone he's taken previously, does that erode his credibility and, by extension, the Fed's?
Markets have been questioning that for quite a while now, saying that how can the probabilities reflect a change from 30 earlier in the week to now 90, that it's flip-flopping quite a bit with very little data to back it up.
Yeah.
So it's very much, are they positioning for all of next year? What is 2026 going to look like? And we've just sort of published our 2026 outlook, thinking through how much more they can cut. Because remember, they're not cutting because this is a big growth scare in the U.S. In fact, many are questioning why they're cutting at all when growth is in the sort of 3% handle and inflation is also well above their target. So they're likely to position that we think neutral rate is somewhere lower, policy is still restrictive, we're going to cut once in December, then it's meeting by meeting, and then let's see how the data pans out for the remainder of 26, which we think will afford them a few more cuts.
Well, to your point about this data, why not lean into the narrative of an insurance rate cut? Why has the Fed not pressed that button more?
Well, that's an interesting question. It is indeed exactly that. It's an insurance rate cut.
They just refuse to brand it that way.
Yes, it's more that they're well above their perceived neutral, which is around 3%. And growth, labor data has indeed moderated enough for them to have something to latch on to for insurance. But it is an insurance rate cut.
But you have not given up being worried about inflation, though, Amriti. I mean, I noticed that you talk about inflation averaging at 3% next year and your overweight inflation protection assets.
Absolutely. We are quite concerned as inflation being one of the most significant risks for us in 2026. As I mentioned, the inflation rate is not back to the target. What concerns me is that we are also going to see a little bit of fiscal spending from the U.S. administration in 2026. Trump's been talking about his $2,000 checks as a tariff payback to the consumers, which is spending, really. It's fiscal spending. On top of that, we really are seeing cuts in an environment where economy is likely to accelerate again.
And where does a rate cut into a tech stock boom, give or take, last couple of weeks or so?
Yes.
But where does a rate cut into that kind of boom for US tech? Where does that leave us? Where does that leave your US weightings versus elsewhere?
So I would say that beginning of this year, in 2025, I used to think, well, tech stocks are not really concerned about the interest rate environment. That's more relevant for cyclical stocks. That's more relevant for small caps. But you've seen a bit of tech spending that's now not funded by their cash flows alone, and they're raising debt. So it is starting to be relevant for tech stocks also, since they're going out in the market and raising debt too.
How important is it that NVIDIA keeps spending money or kind of driving an ecosystem for the US economic outlook? How important is that data center build out, and how important is NVIDIA to that data center build out?
So I think this year, for the first time, Guy, we saw the capital spend by the hyperscalers, by the tech semiconductor companies actually show up in GDP data. It was significant in the first half, where the first half we were expecting a sort of negative print for technical reasons, and in fact we got a positive one, solely driven by about a near 1% contribution from capital spend. I think it is important, but ultimately US is still about the consumer. And if you don't see unemployment rates pick up, we don't absolutely, I mean, it's marginally helping. It's not the only important factor.
Fascinating. Fiscal spend, a little bit of tech in there, and all the Fed. The view, of course, from the Global Co-Chief Investment Officer at Northern Trust, Amriti Baguna. We thank you so much for your time around the table. Coming up on the program, we're going to continue the fiscal conversation this time on this side of the Atlantic, especially as we build up to tomorrow's UK budget. Helen Miller, Director of the Institute for Fiscal Studies, joins the program next. Stick with us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Welcome. Tuesday morning. I think the party's over, at least for now. Yesterday, everybody was partying. Everything was having an amazing session. Today, maybe we're a little bit more cautious. Euro Stoxx 50 futures down by 1/10 of 1%. FTSE futures down by 1/10 of 1%. The CAC's having a slightly more positive day, but I'm not entirely sure that that's a party. What we are, though, is dealing with is a little bit of a hangover from a very solid Fed-driven session yesterday. And that kind of is the narrative we're dealing with first thing this morning. The bond market was interesting as well yesterday, though. It wasn't just equity. It was everything moving yesterday.
I mean, just the fact that we're looking at a bond market that's now headed back to 4% and potentially sub 4% is
on
pretty,
a 10-year. Yeah.
On a 10-year is pretty, on the U.S. 10-year is pretty significant. Just coming off of just how sensitive this market is when it comes to some of the commentary we're getting out of this Federal Reserve. That being said, whether or not it's flowing to Europe is a completely different story. Virtually unchanged on the European bonds this morning. But keep an eye on it. I think we're awaiting some comments coming from Emmanuel Macron later in the day as well. Some radio interviews there. There's definitely one eye on Germany, one eye on Ukraine. That is likely to feed into the fiscal picture.
Absolutely. So all of that potential for fiscal news flow could impact on European bond markets. We'll wait for the gilt market open in half an hour's time to see where the mood is a day before the UK budget. Of course, that UK budget will be delivered by the Chancellor of the Exchequer tomorrow. A lot of expectation that we will be getting some tax hikes this time around. Let's talk about the fiscal choices that lie ahead of the Chancellor. Helen Miller joins us, Director of the Institute for Fiscal Studies. Helen, very nice to have you with us. Thank you for your time. So there does seem to be this expectation that we will get tax rises, another budget with tax rises in it. Is there a way to do this that is better than another way? There's a lot of focus on whether you just do one tax increase or whether you do many piecemeal small tax increases, and views seem to differ there. What's the IFS view on that?
So I think there's not one single correct way, and ultimately it's obviously a political choice who the Chancellor wants to raise more money from, and therefore there's no one political right answer either. But there are definitely worse ways to do it. And I think the key fact is that the devil will really be in the detail. So if the comparison is between one larger measure or a whole subset of measures that are actually tweaks to particularly damaging taxes, then I think that you can make the case for the bigger measure. I think this whole idea of a smorgasbord has got a bad press recently. The idea that it has to be bad doesn't need to be bad. It could be sort of a set of delightful treats, a set of smaller measures that reform some of the smaller taxes, make them better along the way, then it wouldn't be so bad. But if we see a set of smaller measures that are tweaking taxes that are damaging for growth, where the revenue is less certain to actually come in and that makes investors nervous, I think that is the big concern for tomorrow.
So that's on the tax side. On the spending side, Helen, this government has failed to deliver on some of the cuts to spending that it had intended, and failing to convince its backbenchers on the need for those. You've been giving a lot of thought, I know, to where the government could cut. Obviously, these are political decisions, but where it could cut spending. What do you think the focus should be on? I mean, will it be on? Will it be on the triple lock, around freezing some benefits, around the state doing less than it does at the moment? I mean, what's the focus?
Yeah. So just to pick on the triple lock, and that's a case where I think this government or any government should be getting rid of the triple lock, no matter how you want to set the state pension in terms of how it relates to average earnings, for example. The triple lock has a particularly horrible feature of having this ratchet effect. So you end up getting pensions ever upwards. So that would be a good thing to get rid of. And replace it to make more sensible. More generally, again, there are lots of options. If the government wants to tackle welfare, then there are reasons to do that in the sense that disability benefits are rising very, very quickly. That's an area to look at. But as you said, they already tried and failed to do that. I suspect they won't rush back for that. It's already the case that they are freezing benefits related to rents. So again, not much else you can do there. And of course, there are calls for the two-child limit to be removed. So there absolutely are cuts you could do to welfare. I don't think we'll see them from this government. On the day-to-day spending, the challenge of this government is that they only just settled the spending review this year. So they've set out their detailed departmental plans for the next 3 years. They could reopen that, relitigate that, unpick it. I think that's unlikely. What they shouldn't do is just pencil in big, unspecified spending cuts for the end of this parliament. The danger with that is that no one's going to think that's credible to say that a year before election you'll just get some big cuts.
Helen, good morning, it's Guy. Can I take you back to the smorgasbord? The problem I have with buffets is that I never end up with a satisfying meal. And I go to the buffet and I look at it and it's too complex and I don't really know what I'm going to end up eating and what I want to end up eating. This looks like it's going to be something similar. We're going to end up with a budget that is a smorgasbord of changes. It's going to be very complex. The situation is going to get more complex, and business doesn't need that right now. It's already too complex, the tax situation here in the UK. Is a more complex situation growth negative?
Again, devil's in the detail, but yes, probably. I mean, complexity is a problem in and of itself. And you're right, the system we have at the moment, the tax system we have in the UK is horribly complicated. Why is it horribly complicated? The short answer is that what chancellors tend to do is bolt on new things or fiddle around the edges rather than fix what we've currently got. So if that's what we see, if we see new taxes bolted on or taxes tweaked but not fixed, then yes, we'll have a more complex tax system that's good for nobody. And if that's the approach they take, another danger is that it'll be harder for the OBR to work out the revenue effects. And if people in the markets aren't feeling confident that the measures will deliver the revenues they say they're going to deliver, that's another cause for concern. So buffets can be delicious, I think, but there's danger this one won't be.
Yeah, there are some. There are a few, but there are some. Do you think this budget, how big a danger is that this budget is inflationary?
I think a relatively small danger, actually, for a couple of reasons. One is that big picture, Rachel Reeves is going to deliver a fiscal consolidation. She's going to be reducing, either increasing taxes or cutting spending. And Rachel Reeves is on record many times as saying that she wants to help get inflation down. Having said that and pitched relatively for that, it would be surprising to see this be a big inflationary budget. So never say never, but I think it would be a surprise at this point to see that.
Helen, what is the magic number here to reassure some of these markets? When we're talking about fiscal headroom, I've seen some pretty big variations. I've heard it from anywhere from £10 billion all the way up to 30. What's the magic number that would make this budget a success?
I'm not sure there's a magic number in the sense that, again, there's a choice. I've seen 15 billion floated. So 15 billion would be more than we've got currently in terms of wiggle room against the fiscal rules. But honestly, in public finance terms, 10 and 15 billion are the same number. They're so trivially different as to not matter a huge deal. So I think she would need to do at least that, because again, she's pitched role for the idea of more headroom. So she needs to do at least something to show that she is delivering on that. Past chancellors in the 2010s were operating with something more like 30 billion. We used to think of 30 billion as the norm. So getting back to that would be getting back to the historical average. I'd be surprised if we see something going that far, because it would mean Rachel Reeves increasing taxes by an extra 20 billion just to build that headroom. And that would obviously be politically difficult.
All right, so potentially $15 billion is kind of what I'm hearing there. What does the BOE need to hear then again? So we just talked about it from the investor point of view in terms of what success looks like. What does the BOE need to hear to say that was a good budget?
Well, again, the bank will be looking at its own forecast and thinking about whether anything in the budget today changed its expectations over inflation and the path it's setting. It's thinking it's setting for interest rates. So again, it will be looking carefully, I've no doubt, at the potential inflationary consequences and whether this changes anything for that. And at the broader picture of the timing of the different measures. So everyone always focuses on the end year here because that's when the fiscal rule binds. But actually, it will matter not just what Rachel Reeves does in that end year. I think nobody doubts that she will meet her fiscal rules, but also the profile of spending and borrowing and taxes over the coming year, because that will matter for a Bank of England that obviously is monitoring things month to month and not only on a 5-year horizon.
Helen, great to catch up. We're nearly there. We'll soon be at that moment where we get the budget. Helen Miller, Director of the Institute of Fiscal Studies. Thank you very much indeed. Now, remember, the UK Chancellor is expected to deliver her budget tomorrow, circa kind of 12:30 p.m. London. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. We're also going to have an opening trade special the following morning to break down the numbers. We're going to talk to key business and political voices. That'll be our budget special on Thursday morning. Up next, what does Kenton Jarvis want out of this budget? He is the EasyJet CEO. He's just dropped his numbers. There's interesting things to talk about here. We'll be back with him very shortly. That's next. This is Bloomberg.
The aim here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
17 minutes to the market open. EasyJet's stock is going to be in focus this morning. I suspect the company out with numbers first thing this morning. Headline pre-tax profit coming through at 665 million, slightly ahead of estimates. The dividend, a touch light in terms of the estimates we had, but a big pickup in terms of that dividend. The revenue per seat, £83.3. Again, just a touch shy. One of the most significant factors, though, in the numbers this morning is that they have raised the holiday business target for 2030 over at EasyJet because they've met the near-term targets a little earlier than anticipated. The company's CEO is Kenton Jarvis and joins us now. Kenton, good morning. Thanks for bringing us the numbers. Thanks for being on the show this morning. Where should I be focusing in terms of these numbers? Is it on what is happening with the top line, what's happening with revenue, or is it what you are doing with costs?
Thanks, Guy. Well, revenue did grow. We increased our turnover to just over 10 billion. But this was our third successive year of earnings growth. And since we set our medium-term targets in full year 23, we've increased our profit before tax by 46%. And this year was another good year, increasing earnings by 9%.
In terms of the cost story, though, how big a struggle is it? Because those numbers could look better if there wasn't a fuel issue, if there wasn't an ATC issue. How big a factor is that? How easy is it to manage the cost line right now? I hear what you're doing on revenue, but is it actually the cost line that's holding you back?
Well, the unit revenues have actually stayed flat for the last 2 years. They were flat again this year. What we've done, and it impacted the winter, was made quite a considerable investment into resilience measures, so we could set up for what we expected to be a poor air traffic control environment, particularly above France. And the French did not disappoint there. But because of the resilience measures we have put in, we actually saw an improvement in our punctuality. And we also saw, really pleasingly, that customer satisfaction increased by 4%, up to 80%, which is the highest level we've had in over a decade. And as a consequence, our kind of disruption costs came down almost 50 million on an underlying basis. So the investments were made mainly in the second quarter to set up for the summer, and they really came through.
What does the winter look like? You're talking about enhancing consumer choice and driving productivity and utilization. Is that what you're really referring to there, that ability to manage through some of those issues? What does the winter look like? What are we going to see? Why is the consumer experience going to be better? Just give us a sense of what demand looks like right now and how that's going to reflect again through the winter in terms of your numbers.
Sure. Well, last year we flew 3.7 million more customers, and EasyJet Holidays grew the business by 20% more customers. As we look forward into next year, EasyJet Holidays is anticipating a 15% increase in customers, so still a healthy growth from obviously now a larger base. And as an airline, the most visibility we have are over our first 2 quarters. The December quarter, we're 81% sold, and we've actually we've taken 1.4 million extra bookings compared with this time last year. So we're better sold as a percentage of the seats on offer. And for our second quarter, still quite early for the quarter to March, we're 26% sold, but again, we're better sold than we were this time last year. So the consumer is still there. And we'll have to wait to see, especially in the second quarter, how pricing comes through. But it's competitive as always.
Well, Kenton, you mentioned the second quarter there. Let's go a little bit beyond that. For all of next year, talk to us about what your fare picture looks like. Are we looking at rises?
So in full year 25, the year we've just had, our average fare was £74, and the year before it was £73. So pretty flat fare environment for full year 25. The first quarter we're seeing fares broadly flat year on year, and then for the second quarter fares are up a little bit, but it's quite early, so we're some way away from the late selling period.
Well, sticking with what's going on next year, talk to us a little bit about fleet deliveries. And we've previously talked to you, about deliveries when it comes to Airbus. How are you seeing that timeline play out into 2026 and beyond?
We're growing in confidence with the deliveries from Airbus. We said this time last year when we announced the results, we said we expected 9 aircraft to be delivered in full year 25, and then that would rise to 17 the year after, then 30, then 43. And I'm pleased to say we got the 9 aircraft we anticipated, and we still have expected delivery schedule from Airbus is 17, rising to 30, and then 43. So we haven't actually had a change in the delivery schedule over the course of the last 12 months. So the production change seems to be unlocking a bit.
Kenton, good morning. It's Anna. You've previously said there's nothing to add to speculation about whether whether another company is going to buy EasyJet, which we understand. But these kind of rumours just keep on coming back to the extent that one day earlier this year, your share price went up by 12%. Talk of MSC possibly coming through with an offer. Why do you think all these rumours keep coming?
Well, there has been consolidation in the aviation sector. We've seen the big 3 aviation groups of IAG, Lufthansa Group and Air France KLM buying some of the smaller flag carriers. We know in Portugal, TAP is a target. We've seen all 3 go for Air Europa. SAS has been bought by Air France. So, you know, this process continues in the flag carrier space, and when it came to EasyJet, it was in fact pure speculation. There was nothing in it, and as a manager of the business and my management team, we just remain very focused to keep building on the earnings growth that we've had over the last 3 years and drive forward to our target of sustainable profits over $1 billion.
Could you see it making sense, Kenton, for that consolidation story to extend into the low-cost airline space, though? I mean, Michael O'Leary talks about that their business many times larger than yours. You're a few times larger than Wizz. Would it make sense for consolidation in the low-cost airlines?
It's not in my plans. My plans are to remain focused on improving the customer experience and improving our earnings year on year, and that's what we'll focus on doing.
Kenton, any thoughts on the budget? Budget tomorrow? Anything in it for the aviation sector, do you suspect?
Well, I hope there's some consistency in the budget. The government have been very pro-aviation and pro-growth. They really recognise the valuable role that aviation plays, especially to an island economy, in enabling growth. So I hope that there is some sort of freeze or even reduction on air passenger duty, because last time we saw a reduction in 2023 on domestic APD, EasyJet added capacity, other carriers added capacity, that increased the connectivity, increased the consumer choice and brought down fares. And I think that, you know, that kind of action would be very encouraging, but we'll have to wait and see.
OK, Kenton, thank you so much. Thanks for your time. EasyJet CEO Kenton Jarvis. Let's broaden the lens, talk about the markets in 3 minutes. Our Markets Live executive editor Mark Cudmore joins us now. So strong gains in stocks globally, US into Asia, Mark, as a result of what, the Fed rate cut theme. Does that live on? US futures have rolled over a little.
Yeah, I think that the sell-off that we started in stocks about 4 weeks ago is still not fully exhausted. I know that's been a kind of repeated refrain of mine for the last few weeks. I understand why people are rushing to buy the dip very quickly, but it just doesn't feel like that the plane in the digital asset sector has fully played out. And sure, there's not a direct transition, but that is weighing on the margin on some of those popular retail names and some of the most popular momentum stocks, and that is dragging on the sector. I don't expect a major pain, and as we've talked about a lot, I think the AI bubble will continue to inflate very, very strongly into 2026. I am just not convinced that we're ready to get right back on the bubble bandwagon already. I think from here until Christmas will continue to be difficult and not the usual Santa rally.
Does it matter, though? The AI, yeah, that's obviously a huge market theme. But as long as the Fed's cutting, who cares?
I think that ultimately the AI theme is much bigger. It's what drives the US economy. It's driving all the biggest valuation stocks in the world. So for markets, the AI theme matters much more. It is true that at the moment, there seems to be a very outsized reaction, surprisingly so, to small moves on whether the Fed cuts by 25 basis points or not in December, which seems kind of ridiculous. I actually think that, Powell's got the votes to probably push through a cut at the margin. I think that's the way we're going, and that will help the stock market. But that's not coming for, I think it's 3 weeks from today. So, they've still got quite a bit of time. Or maybe it's, 2 weeks from today. So you still got, until then, I think it's going to be tough for stock markets. And I'm not sure that's going to be the game changer that people are looking for.
Mark, does a cut in December mean a cut in January?
No, I don't think that's necessarily the case. I mean, clearly, if they cut in December, it's going to be super, super debated. And as I said, I understand the uncertainty out there. If you ask me now, I think it's more likely they will just about cut in December, but there's a lot of data coming in between today and tomorrow before Thanksgiving that might help kind of clarify that. But I think that even if they cut, I think it'll remain very, very difficult to have kind of consensus behind it, which means we don't necessarily follow through. The overall theme, though, going to next year is that we know this, we've known this for a while, is that the Fed is going to provide easier monetary policy than orthodox economics would suggest, and that is supportive for the stock market. Growth at the moment seems to be holding up okay, but driven by the AI capex boom. If the AI capex boom blows up, then the economy is not robust enough to hold up because it is a K-shaped economy. And that's why ultimately it is the AI theme that dominates absolutely everything else out there.
All right. Bloomberg's Markets Live executive editor Mark Cudmore joining us this morning, trying to connect the themes between, of course, the Fed and the tech space. More analysis from him and the team, all on ML Ivy Go on your Bloomberg terminal. I think it's fascinating. We're hearing two very different camps here. One, that the Fed is greasing the wheels of the tech rally, and then folks like Mark who are saying this is at the margins, this isn't the key driver.
So what is the key driver? What is it that is going to drive this stock story forward? Because valuations are already pretty punchy. Why do you continue? What is the next catalyst that gets the tech story rallying forward? Yeah. I don't know, because a lot of things are in the price right now. Nvidia's it feels like it's all in the price.
Yeah, and if it's all going to be increasingly about competition for either Nvidia or US tech, then where does that conversation leave us? We will see what the man in red delivers in December, if anything. We'll be back with the market open. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
we're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
How you doing? Good morning. Tuesday morning. Yesterday was epic. Massive rally. On what? I don't know. There's a bunch of reasons. The Fed, maybe the Trump Xi call. I don't know. Whatever it was, the market clearly wanted to go higher and did so with gusto. The dip buyers were in. You can see it yesterday. Yesterday's session, the S&P was pretty strong. Most of it, though, was front-loaded, which I think is interesting in light of what Critty's about to show you in terms of the futures this morning. US futures are flat. Similar picture here in Europe, Critty.
Waddling around. We're treading water, it seems. A breather, maybe, if we can kind of call it, given the green on the screen you showed on your chart earlier, because we are taking a little bit of a step back. Remember, volume, I imagine, is light. We're kind of counting down to Thanksgiving. Turkey Day over in the States on Thursday. Eurostoxx 50 futures down about 0.1%. The FTSE 100 a similar margin. The outperformer this morning, Anna, is France. And this one's interesting. Higher by 0.2%. Not a massive move higher, but in a background of red on the screen. This one's significant. One eye, I think, on politics in France this morning.
Yeah, perhaps the politics to the fore. We'll keep an eye on the French market then at the start of trade. In terms of individual stocks we're watching, we'll also keep an eye on ABN AMRO, the bank over in the Netherlands, planning to cut 5,200 full-time roles. New CEO in post, trying to boost profitability over at that business. EasyJet also in focus. We just spoke to Kenton Jarvis, the CEO, talking about growing in confidence in terms of deliveries of those Airbus jets. Consumer demand still there, he told us, and there's nothing to it when it comes to the M&A conversations. He's still focused on just delivering for the business, as you might expect. In terms of defence names, there's been plenty of violence overnight. Kyiv and parts of southern Russia. There have been meetings taking place in recent days over in Geneva, some in the Middle East as well. Have yet to see any progress, but it does seem as if the many conditions attached to some kind of ceasefire maybe aims to reduce them, at least from the European side, Guy.
OK, here we go. Let's find out what actually the market is going to do this morning. We think it's going to be a fairly flat open, but the sector story, the single stock story, is going to be interesting. So I'm not expecting fireworks. Fireworks came yesterday. Today, we're kind of just waiting for the next catalyst, I suspect. Where does it come from? Is it the UK budget? Is it more Fed speak? Remember, the Fed goes into a blackout period Friday. Anyway, I'm talking because actually there's not much happening on the screen right now. Stock 600 is up by 0.1%. The FTSE 100 is flat. We are waiting a CAC that may be a little bit more positive, but not by much. Elsewhere in Europe, maybe we get some of the defence names moving on the back of some of the news that Anna's just been bringing us, but we'll watch that one. Tech maybe continuing a little bit of upside. Is that why the AEX is having a better day? But you also got the ABN AMRO story to fold into that as well. They've got an investor day today, and it looks like big job cuts are coming. What does that do to the cost picture? So that's where we are. IBEX is absolutely flat. We're waiting for the DAX. What are we seeing in terms of the sector and the single stock story? Critty.
Well, it's a fascinating one. When you look at this market, it is kind of split half and half. I'm pulling Guy Johnson here, 265 versus 214. And you can see it red and green on your screen across the board. Telecom, chemicals are your laggards this morning. But when you look at the outperformers, I'm trying to find some sort of narrative here. I'm not seeing a ton of it. It just feels like yesterday's underperformers, the energy sector that had taken a hit, some of the banks that were taking a hit yesterday, the underperformers are your outperformers this morning. Tech still very much on the forefront. ASML, your biggest index contributor.
I wonder if the Fed narrative is sort of sidestepping into the European markets. I saw earlier on someone attributing the higher copper price to Fed rate cuts, and I now see that basic resource stocks are higher by 1%. Copper was higher in the Asia session. Iron ore was a little bit higher in the Asia session, but not by a huge amount. But basic resources, the best performing sector, up by 1% in this morning's session.
So what I find surprising is biggest points gainer, ASML.
I know, I was just saying, it's a tale of two tech, isn't it?
SAP is the biggest loser. So even tech is split this morning and doesn't have a sort of convincing narrative running it through. Maybe the chip story is more positive. Novo's up, Barclays up, Novartis is up, Lloyds is up. Lloyds and Barclays both, I think, probably representing that story that we talked about earlier. It looks like we are going to see additional levies being applied to UK banks by the Chancellor in the budget. The cost of that may be that you've got to talk up the budget. Maybe if you're a UK bank, I don't know, much being made of that this morning. So the UK banking story is positive. Shell's up, NatWest is up. So there's some UK stocks in there. In fact, the UK story is and the budget, kind of the preamble to the budget, is definitely represented in the market this morning, which I think is interesting.
It is. It's fascinating. And I think sticking with kind of the fiscal story, we're talking, of course, about the countdown to the UK budget. The conversation's happening in France as well right now. This isn't a massive move that we're necessarily seeing, but I think it's worth noting that just from an index perspective, the CAC 40 is the outperformer, higher by 0.3%. So, again, not a massive move. But we should point out there were some headlines crossing earlier from the Socialist Party talking about French radio. Our colleague Caroline Conan, who, of course, is our French correspondent, saying that they have really been the linchpin in some of these budget negotiations. If they're saying that a budget is actually possible, that could be a game changer. I think the market may be still casting a little bit of a skeptical eye on that this morning. But
or already thought that.
Yeah, but still, France is the outperformer.
What I think is it's the French industrials that are up this morning. So you've got Airbus, Safran, Schneider. These are the kind of companies that are doing well. The banks are doing all right as well. Some of the luxury names less so. So LVMH under a little bit of pressure, Hermes under a little bit of pressure. So that's where you've got a kind of reasonably balanced market in terms of the French story. But there are definitely more up and down, like 30 up and 10 down.
Yeah, we don't see that. We don't see that very often in the French market. Do we? Let's get a little bit more analysis this morning, if we can. Hugh Gimber, global market strategist at JP Morgan Asset Management, joins us around the table. Hugh, pleasure to have you. We have a lot of, let's put the U.S. to the side for a moment. There's a lot of questions around the fiscal conversation here in Europe. We've got the UK tomorrow. We were just talking about France as well. There's also that tech theme in the U.S. What is the driver for European markets? The local issues or what's going on across the pond?
Good morning. The driver for me is fiscal policy. This all comes down to government's willingness to spend through 2026, in some ways independently of what the data is suggesting they should be doing. You look at the European growth backdrop, you look at the labour market, you look at inflation, there's really no strong need here for booming fiscal stimulus in 2026. But when you throw Germany into the picture, that's what we think we're getting. These are governments who have decided across the board, UK, France being two good examples, that cutting back on spending is politically unfeasible, and therefore the narrative for next year is about further spending. We can argue whether the deficits are too large. I mean, when we look at the numbers, we think really you have government spending at levels that imply we're already in recession, or perhaps we're already in kind of war phase. Obviously, that's not where the global economy is today, but with spend, the way we're framing this in our outlook for next year is about fuel in the engine. Governments that are continuing to power ahead with fiscal stimulus, and so we're focusing in European markets on the potential beneficiaries of that, whether that's the industrial story or potentially further upside for the defence names as well.
At the end of the day, though, they are still promises. They haven't actually hit the market just yet. So I am curious, to what extent is the under-delivering of that priced in?
So this is all about timing, and I think you hit on a really key point, which is that broadly, the consensus narrative for Europe next year is still very pessimistic. We're getting a lot of pushback on our positivity around the fiscal pivot, and that comes not just around question marks about Germany's ability to deliver, but also whether French or UK politics might derail the story. Ultimately, France, I think, are engaged in one big can-kicking exercise where all of the tough decisions are being pushed out to 2027. And in the case of the German story, we had the announcement back in February and March, and enthusiasm around that fizzled out quite quickly. But this is just an issue of waiting for that spending to start hitting the economy, which we think should be first showing up in the Q4 GDP data. So this story remains on track, despite lots of the excitement that has faded quickly over the course of the summer.
Hugh, will we continue to enjoy tech concentration in 2026, or will we try to protect ourselves against it? What's the strategy?
I'm not sure we have enjoyed tech concentration in 2025. I wouldn't say it has been. It's been so difficult for managers this year to position in what feels like a broadly diversified and broadly prudent way, and to keep up with benchmarks that are still being driven by a small number of names. So, if anything, I think we could enjoy next year hopefully a bit less tech concentration and some broadening out of earnings across a wider range of sectors. But critically, given how important US tech spend has become for economic growth, that broadening out is not about tech pulling back and others starting to take on that mantle. Rather, it's about a continuation of the tech capex story and others being able to benefit. So it's a broadening of AI, which then starts to drift into other sectors. I think the common narrative that many had at the start of 2025 about a tech pullback that would see others step forward is just very, very difficult to envisage here when tech has become such a critical driver, not just of the market, but the US economy overall.
And will competition start to be part of the narrative? Tech competition, competition amongst tech giants, will that start to be part of the conversation? Because it seems as if everybody's just gained, not everybody, but there's been a lot for everybody in 2025. Will that continue to be the case?
Absolutely, but I think there are three specific areas we're expecting to see that competition. So one is within the different buckets of the tech ecosystem. So look at the chip makers as one example. We're still not clear, I don't think the market is clear, as to whether or not in 5 years' time there's going to be room for many chip makers or whether this is really a winner-takes-all type scenario. Same is true with the LLM providers. Are we going to need multiple different models, or is it actually going to be that one of Google or OpenAI or Anthropic turn out to be the ultimate winner? So that's, I think, competition area number one. Two is regionally. We've seen developments overnight with the US and China. I think really all that tells you is about China's key role in critical minerals that are so essential to tech production, and therefore the US being forced to make more concessions. And then the third is that balance between public and private markets, where we think the change in the structure of capital markets today that's allowing companies to stay private for much, much longer means that the balance of power within this AI story could be more tilted towards the private markets, because companies have just fundamentally changed their route to large cap. It no longer needs to go through small and mid cap. You can go private, 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 and then bang, a large cap IPO.
Hugh doesn't sound like he's worried about cockroaches, Guy.
I know somebody who is. I've just been speaking. I've just been kind of writing a few notes down. Governments are going to continue to spend. Central banks are going to cut rates. Fed's going to cut rates. Tech keeps spending. Inflation?
So
is that the biggest risk for next year?
This is one of the two biggest risks that we're flagging. We have a chart in the Outlook, probably my favourite, looking at consensus forecasts for inflation next year, which are broadly flat in the US, hovering around 3%. And we've overlaid that against all of the consensus forecasts through 21 and 22 that told you every time inflation rose, don't worry, this is the peak. Oh no, don't worry, this is the peak, this is the peak. And history tells us when you have excess stimulus in an economy, it typically shows up in one of two ways. In the 20s and the 90s, it was about asset price inflation. In the 70s and the early 2020s, it was about consumer price inflation. And so this is where I still think...
both at the moment.
Well, we have to a degree, but we have enough confidence in the labour market slowdown that we're not derailing Fed
so this is the 1920s.
So, well, I think there are definite echoes of the 1920s to today. For me, wage growth is key. Because if wage growth remains under control, if you continue to see that labour market slow down, the Fed can dismiss the pickup in US inflation that we do see ahead by saying we're more focused on our labour market mandate. If we're here in 6 months' time, inflation has picked up and the labour market is not only stabilising but wages are starting to accelerate, there you have a true test of Fed independence and you have the market getting a lot less comfortable about the inflation narrative. So diversifying against that pickup in inflation, I think, is absolutely essential, even though it's not our core scenario.
My kind of... If we go back to the 1920s, the Fed was a big part at the end of it in terms of what happened next. If the inflation is not coming down, is the Fed going to have to hike rates at some point? And if so, when could that come?
So in the interim, I think the Fed goes lower. Let's be clear. We should separate out...
So inflation's still sticky, but the Fed's going lower?
Yes. That is our core scenario for the first half of next year. You have an inflation pickup, but one which is contrasting with a labour market slowdown, and therefore this is still a Fed in cutting mode. It's where the labour market starts to turn that Fed narrative becomes far more difficult. Because look how they've justified
That's a 2026 story.
This is a 2026 story, potentially. Now, I think, again, you take into account Powell leaving in May. You take into account some softness in broader parts of the economy. This is not a red-hot US economy today. There's enough here for the market to look at the Fed cutting and say, this comes with risks, but we can understand why they're taking this position. If the wage story starts to change, that market narrative becomes more difficult. And so this is where alternative assets, your inflation diversifiers, are a critical part of a well-balanced portfolio, because it's not just your typical, are we going to be fine or are we facing a recession story? It's the inflation risk that I think is actually greater than the growth risk.
Hugh, nice to see you. Interesting charts. worth a read. Hugh Gimber, Global Market Strategy at JP Morgan Asset Management. Thank you very much indeed. OK, let's take a quick look at the Core 6 this morning. Interesting market. Yesterday was the big day, but today, actually, there's some interesting gains still coming through. Defence stocks are up after getting hit hard yesterday. At this time, ASML is up, which is interesting. SAP's having a tougher time. Let's deal with the details of what is going on. Chloe Melly joins us now with a look at what's happening in banking.
Good morning, guys. So yeah, ABN AMRO is up quite strongly this morning after announcing plans to cut more than 5,000 jobs over the next few years to boost profitability. This is part of a broader revamp plan for the bank, which also includes ambitions to become a top 5 private bank in Europe, as well as strengthen its position in Dutch retail banking. And this is a plan that is being welcomed very warmly by the market, and we are up 3.5% for ABN AMRO this morning. Moving on to defence, and we have also got a wall of green across the screen for defence after falling yesterday, and that is because the prospect of peace between Ukraine and Russia looks increasingly fragile. The two have exchanged heavy fire, and that is putting in question Trump's efforts to strike that peace deal between the two. And we have got that reflected across that defence industry this morning, with Rheinmetall and Hensoldt in particular up more than 2% this morning. Moving on to Continental, which is also up. The tyre maker is up because the European car sales have risen for the 4th month in a row, and that is because more affordable electric vehicles are being pushed onto the market, and so it is really boosting optimism for that car sector that has seen quite a lot of weakness. But we are up this morning 1.3% for Continental. And finally, Kingfisher, the owner of B&Q and Screwfix in the UK, boosted its profit guidance this morning, and we are up almost 6% this morning for Kingfisher on the back of that profit upgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up, we'll continue to focus on one of the stocks that is on the move this morning, EasyJet, down by just 0.8%, underperforming the broader market just a touch on the back of their numbers. Highlights from our conversation with the CEO next. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Morning, welcome back. 20 minutes into a session that in some ways is going nowhere in a hurry after a massive day yesterday, though. I think we're just pausing for breath and reassessing the situation. Let's talk a little bit about some of the single stocks that we are watching this morning. EasyJet shares have had a really choppy ride this year. Part of that's been driven by kind of what is happening at the operational level. Part of it's been happening as a result of what's been happening on the M&A front. This morning, the stock is a little off after rising into the numbers that they've delivered this morning. Headline profit pre-tax for the full year beat the average estimate. Some of the other metrics were a little softer. We spoke to CEO Kenton Jarvis about the investment areas that he is focusing on for this business.
Because of the resilience measures we have put in, we actually saw an improvement in our punctuality, and we also saw, really pleasingly, that customer satisfaction increased by 4%, up to 80%, which is the highest level we've had in over a decade. And as a consequence, our resilience, our kind of disruption costs came down almost 50 million on an underlying basis. So the investments were made mainly in the second quarter to set up for the summer, and they really came through.
Kenton Jarvis, the CEO of EasyJet. Kate Duffy joins us around the table, Bloomberg's aerospace reporter, covering EasyJet for us. Good morning.
Morning.
What's the takeaway? What is the kind of read on EasyJet right now? Where should I be focusing on it? Is it the fact that the holiday business is doing well? Is it the fact that they're trying to get costs under control? Is it the fact that we're going to see more capacity next year? Where am I looking?
Is a bit of a mixed bag this morning. So as we've seen, the holidays business is doing really well. They've met their medium-term targets early, and that means that they've upgraded their target for about fiscal 2030. Their profit is good, it's looking up, but as you say, they've really struggled with their costs over this year, whether it be from the air traffic control disruption, that's caused planes and crews to be out of position, passengers to want refunds and compensation, so that's added costs. Also their Airbus deliveries as well, these were slightly slow, but what we're saying this morning is this growing confidence that actually they're stabilising. So they got the expected 9 aircraft this year, they're getting 17 next year. That's all in line with expectations, and that means that they can grow their capacity into next year by about 7%.
Kate, I've lost track of the number of times we've had stories, reports about people possibly interested in buying EasyJet. And when asking Kenton about it this morning, I thought I was going to get a really short response. I mean, I did in the sense that he says there's nothing to see here. But he went into a lot of detail about how all the flag carriers keep combining with each other. Seems not very interested in talking about where the low-cost airlines do. But we know that others in the sector have thought that it's a good idea. Michael O'Leary, for example.
Yeah, exactly. Michael is very outspoken about the fact that
the others should consolidate.
The others should consolidate. Yes, that EasyJet is this prime target for that. Also Wizz Air as well. I mean, there's lots of chatter in the sector, and as Kenton was saying, there's interest in the moment at TAP, the Portuguese airline. That's something that IAG, Lufthansa, Air France are all vying for. So it's a really sort of meaty airline consolidation environment at the moment. But Kenton said there's no plans for him at this present moment to be involved in that environment.
So what happens next? What do we think the winter demand picture is going to look like? What are we looking at in terms of the demand picture next year? We've got a budget coming up very soon. They obviously have significant exposure to the UK consumer. What is the message they are delivering in terms of what demand is going to look like and the health of the consumer?
Well, winter's always a really tricky time for airlines. Obviously, summer is when they make their most money. People are going on holiday. Winter's a little bit more subdued.
But that's changing a little bit, though, isn't it?
Yeah, he did say that fares are sort of flat year on year, but then going into Q2, which starts in March, they're slightly up a little bit. That's something that we probably do expect. But then next year, as I said, more aircraft's coming through, capacity is looking up. So it's
so does more capacity equal steady fares, but more volume?
Yeah.
Well, presumably that must be the argument here.
Yeah. Yeah.
Okay. We'll watch that one with interest. Kate, thank you very much indeed. Kate Duffy.
All right, our Bloomberg Aerospace reporter, Kate Duffy, thank you so much. Let's talk about another topic. We are, of course, monitoring this time out of Brussels. The EU's antitrust chief has ruled out easing the bloc's tech rulebook. This comes after U.S. Commerce Secretary Howard Lutnick said Brussels needed to change its digital regulations in order to get a deal to lower steel and aluminum tariffs.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
Howard Lutnick there, the U.S. Commerce Secretary. Let's get a little bit more analysis from our Brussels bureau chief, Suzanne Lynch, joins the program this morning. Suzanne, we've heard this narrative before. Europe has too much tech regulation. Did Lutnick move the dial at all?
Well, I think it's clear that under this administration, there has been a renewed push for Brussels to roll back some of that regulation that affects US big tech. And Howard Lutnick made it very clear here in Brussels yesterday that he was linking these issues, that he was linking the call for laxer EU regulation on tech with a deal and further concessions on trade tariffs, particularly steel and aluminum, something that the Europeans want. So this is a real dilemma for the EU. I mean, the EU has always had huge power when it comes to regulating tech, both through its digital regulations and through its antitrust laws that are very, very powerful here in Brussels. But at the same time, it is said that is not negotiable. We heard from the EU Commission Vice President Teresa Ribera last night that the EU digital regulation is not for negotiation. European consumers would be protected. So the question is now how far the EU would go to roll back on these regulations. But the message seems to be from Brussels, not very far.
Right, yeah, Suzanne, it's interesting, isn't it, that the Europeans keep trying to say that these are not linked, the tech regulation and tariffs around metals and steel. You know, there's no link between them. But do you get the impression that the US decides what's linked when it comes to trade policy?
Look, the reality is that the Trump administration does link issues. These technical trade talks are connected to them with the broader relationship between the United States and the European Union. Now, I mean, the European Union would say that it is already moving to pull back on some of its more stringent regulations. So, for example, last week it announced a digital omnibus package, it was called, which did decrease some of the reporting, some of the red tape around digital regulation. So the EU are trying to say, look, we're doing this anyway. We're pulling back on digital regulation. It doesn't just affect US companies, also our own companies in Europe have been complaining, and we're listening to them. So whether that would be enough to convince the Americans that the EU is changing its tune when it comes to digital regulation remains to be seen. Because at the end of the day, these fines that the EU have levied against US tech companies have been enormous, particularly on Google.
Suzanne, do you think there's a connection between what is happening on trade and what's happening on Ukraine? Is that going to influence the overall relationship between Europe and the United States and vice versa?
Yeah, in one way, the timing of this meeting in Brussels this week, I mean, it was a big deal having the US Commerce Secretary and the US Trade Representative attending the EU Trade Ministers meeting. That doesn't happen that often. And yet that coincided with a real crisis in the Ukraine talks, where their colleagues were scrambling to try and get in front of the Ukraine story, to get the ear of Donald Trump and try and influence this 28-point peace plan that had been circulating. So yes, the two issues are connected ultimately. That's politics. The EU is trying to keep the US on board on Ukraine, so it's trying to keep that relationship strong. Now, the Europeans also say it's got leverage. We heard Secretary Lutnick say in the clip there himself, it's a huge market of 450 million people. The US knows this. US tech companies know this. They know that they want to operate in these markets, and the EU say they have to play by their rules. So it's not that the EU has no power in this, but yes, I think the two issues are linked.
Suzanne, thank you very much. Suzanne Lynch, Bloomberg's Brussels Bureau Chief. Thank you very much for joining us. Coming up on the programme, we'll stick with the tech theme, in fact. We're going to be speaking to Data IQ's CEO about the artificial intelligence platform company that he leads, the role it plays in agentic AI in business and the rate at which businesses are adopting AI. He is at the Adopt AI Summit that's currently underway in Paris. We'll check in on the AI theme next. This is Bloomberg.
Do you think the dollar will remain the only reserve currency in the world, and are you as comfortable with the dollar as you used to be?
The dollar has been, as you say, a reserve currency for about 80 years. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars, and that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years. Of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. The outperformer, I think this is interesting, is actually coming here in France. CAC 40 higher by 0.3%. We don't say that very often. There's a political overhang over all of it, but it looks like some commentary potentially coming out of the Socialist Party there. Maybe, just maybe, removing some of that political hang in today's session. They're saying that a budget is possible. They were the linchpin. We'll see if it really moves the dial, but this morning, the French index is your outperformer. But green on the screen across the board. Futures were showing a negative open, Guy. We've come back from that.
Yesterday was a party. Today's definitely kind of meh. That's what we're seeing in terms of the internals right now. Look at this. 312 up, 270 down. Nothing to see here. Volume is light. We're down. This is on a 20-day average as well. Is down by a quarter. More than a quarter. So this is a very unconvincing session in terms of what you're seeing in terms of the internals. But I guess you've got to see it in the context of yesterday. Let's talk about some of the leaders and laggards. Let's talk about the leaders first. Chips are up. SAP's down, we'll show you that on the next board, but chips are up. Barclays is up, UK banks look like they may get a reprieve when it comes to the budget. Shell is up as well, which is interesting. A little bit of volatility in the oil space recently. How low do we go there? There were some interesting notes floating around on that story yesterday. Let's follow this up with the laggards because they are equally balanced this morning. SAP is down by 0.8%. Roche is down by 0.7%. 3i. Is that a UK story? I don't know, but it's down by 1.9% this morning. But it's a really balanced market. There's nothing really kind of obvious that gives us a clear vector, a clear sort of sense of direction this morning as to where we're going. Anna, what you got?
Yeah, in the meantime, let's get an update on some of the geopolitical news flow that we need to keep across, Guy. Bloomberg has learned that the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through to March. The move signalling that Beijing is braced for a protracted spat between the two nations after the Japanese Prime Minister's comments on Taiwan caused disquiet in Beijing. Russia and Ukraine have exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launched a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained suspected drone attacks. And Nvidia shares fell on a report that Meta is in talks to spend billions on Google's AI chips, suggesting the internet search leader is making headway in efforts to rival the industry's best-selling AI accelerator. According to reporting from The Information, Meta is in discussions to use the chips from Alphabet, known as Tensor Processing Units, or TPUs, in data centers from 2027. Meta may also rent chips from Alphabet's cloud division starting next year. Pretty?
Lots of big moves in the tech space. Of course, it comes amid this backdrop of this rally that we've seen, some of the corrections that we've seen, driven both to the upside and the downside by the tech names on both sides of the Atlantic. Let's bring that to a little bit local in terms of that tech conversation. Europe's biggest corporates are revealing their tech spending plans at the Adopt AI Summit in Paris today. Dataiku is one company hoping to lead the race. Its aim, of course, to build the integration of AI into everyday business operations. Dataiku CEO and co-founder Florian Duetto joins us now from Paris. Florian, a pleasure to have you on the program. Thank you so much for joining us this morning. As we've been talking about on the show today, but also for, I want to say, months and years, there's a lot of optimism around AI, a lot of investment in AI. Do you feel like the community and outside investors who are learning about this are maybe getting too excited about the prospect of adoption of AI into our everyday lives?
I think the AI market is incredibly early. I think if we are to compare to anything, building AI, building agents in 2025 is like building websites in 95. You're very excited, you're building lots of things that will have lots of value, but in the context of things, you're building websites without having invented yet the concept of blog post or the concept of e-commerce. So that's where we are in the market. That's why everyone is excited. Lots of investments are happening and lots of adoption is going on, but it's also a very early market.
Well, Florian, to your point, I love that you talked about 1995. It's certainly a parallel a lot of people are making. But to your point, there are a lot of websites that failed, a lot of domains that failed, a lot of technology associated with the internet that failed before they took off. What is the equivalent timescale here? It feels like a blog post we talk about all the time, but that's 25 years after the dot-com bubble. Do we have to wait 25 years for this AI bubble to manifest in real life?
I think the concept of AI bubble is related to investment in infrastructure, which is potentially unrelated to the fact that in the grand scheme of things, enterprises are already finding value with AI. We have customers all around the globe, some of the largest companies on the planet, and they've been investing in AI, not just in terms of data centers or GPU or whatever else, but in terms of building application with AI, automating the way they manage their customers, finding efficiencies in terms of internal processes all around, finding 1, 2, 3, 5, 10% here and there. And I think that those efficiencies will compound over time, creating for companies the ability to actually find this value of AI that everyone is after. But indeed, it requires ambition. It requires to actually invest, not just in infrastructure, but it also in the transformation of the business.
Florian, good morning, it's Guy. You spend a lot of time in the States, you spend a lot of time in Europe. How is the perception of AI different on either side of the Atlantic?
I think that there is a difference in terms of timescale, in terms of speed of investment, where investment in the US is probably in advance in terms of how corporates are actually investing and adopting AI more rapidly. But I think what's common is that there is this problem of trust related to AI, meaning trust at every scale. Individuals are not sure whether AI is good for their job. Corporates are not sure whether AI will work, whether these agents will actually prove to be working versus not. And there is also a trust in terms of infrastructure, vendors lock-in, potentially technology that could be locked over time, creating for companies kind of like the trap associated to AI if they are not actually free to use any type of AI technology in the future. So you've got like trust issues at every level throughout the planet, even if speed of adoption is potentially ahead in certain countries, notably in the US.
Okay. Let's just kind of segment that a little bit. The labour market is clearly one area that everybody's watching for very carefully. Agentic AI and its impact on the labour market, what do you think it's going to be? People are worried about mass job losses. People are worried about a significant shift in the labour market. You're at the cutting edge of this. What do you see?
I think we are, again, too early in this market to make a call from a macro standpoint. But indeed, there is the potential of a significant augmentation of jobs. What I want to believe in, what I hope for, is that AI will be a way to actually spend less time over our keyboards and more time, well, human-facing. In the last 20 years, meaning our jobs have changed. Our jobs have changed from being like human-facing a lot to being screen-facing a lot. People spend time filling out forms with their fingers on their keyboards. Potentially with AI and agentic, you will find back augmented jobs where you find back this ability to talk to your customer directly, to favor human time. And I think it will be a profound change of the workforce, of course. This will be radical, this will be tough, but indeed, this is something that I think will be for the better in the long run.
Florian, so with that, I mean, would you expect to see, I mean, maybe I should ask a labour market economist, but would you expect to see job cuts in the short term, but maybe not in the longer term? Is that one way of thinking about this? I've seen that applied to other technological innovations over time.
I think there will be efficiencies in businesses. There will be a way to actually augment jobs to find efficiencies, and there will be new jobs being created with AI, new opportunities for revenue. We see some of our customers focus quite a bit on immediate efficiency, but others also looking at AI and AI technology through the prism of innovation. How can I actually put drugs faster on the market? How can I actually design an aircraft engine faster? Meaning this type of capabilities will actually lead AI to actually, well, faster economic growth, not just job cuts.
Florian, I want to ask you about the subject of tech sovereignty. And as a Franco-American business, I've seen your business described in such terms. Perhaps you have something to add on this subject. I mean, Europe worries quite a lot about the extent to which Europe relies on big tech names in the States, and maybe something about the politics of late makes that feel like a vulnerability. Do you get asked that by clients? Is this part of the conversation at all?
Yeah, it is. It is top of mind for every corporate on planet Earth, even some in the US, meaning they actually don't want to be locked with AI, to be locked to certain providers. And it's a matter of sovereignty. It's also a matter of controlling their costs in the long run. So they want to keep optionalities in terms of AI. It's about where the data is, about where my compute is. And most of our customers end up having a hybrid approach, where they mitigate the risk by having a multiplicity of vendors, American cloud vendors, on-prem, meaning GPUs they own and they can control fully, as well as data. And I think that those robust strategies, meaning are not obvious. It's not about like picking one vendor and making things easy, but it's necessary for large enterprise in order to mitigate the risks. And it's, I think, something and an opportunity for building cloud capacity all over the planet with a multiplicity of vendors providing it.
Florian, we're getting close to Christmas. My tree's already up. I'm very much in the Christmas spirit. What is on your Christmas wish list in terms of making your company and the AI ecosystem in Europe a success? Are we talking about labor? Are we talking about energy, credit financing, cutting the red tape? What's on your Christmas wish list?
Oh, none of that. It's ambition. I think that in order to find the value of AI, and ambition is actually to some extent easier to get. Maybe you can't get it from Santa Claus, but you can get it from your art. So it's actually closer. I think that European businesses need the level of ambition matching American businesses. And in particular, in order to find the value of AI, you need to look at your most mission-critical processes, the big, heavy mammoth that you've got in your business, or you onboard customers as a bank, or you manage clinical trials as a pharma, or you manage all of your supply as a manufacturer. Those things cost hundreds of millions for most companies. They are like heavy information-driven processes. There is no way those processes are the same in 5 years for the leading companies on planet Earth. So as a company, if you don't change those processes today, if you don't start now, you will be lagging behind in 5 years. And then, actually, maybe we will find some economic impact of AI in terms of job cuts, but they might not be coming from jobs being cut by companies. It might be coming from companies failing.
Florian, thank you very much. Thanks for joining us. Good to get your perspective. Florian Duetto, the CEO of DatIQ, thank you for your perspective. Let us tell you what is coming up on the programme then. We continue to focus on the UK budget, of course, ahead of tomorrow's budget. We speak to Rupert Harrison, Senior Advisor for the UK. Well, he used to be a senior, he's a Senior Advisor for the UK at PIMCO, I should say. Previously has advised the UK Conservative government, of course. And we will get to a conversation with him shortly. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
welcome back. This is the opening trade, 45 minutes into today's session, Tuesday, 25th of November, and European equity markets not really going anywhere in a hurry. US futures pointing just a touch lower. Are we off earlier lows, though? I mean, yesterday was a stellar day, up by more than 1.5% in S&P stocks, up by more than 2% on the NASDAQ, but that was yesterday. Today is today. Let us move on to tomorrow. Investors will be keeping a close eye on UK markets tomorrow as Rachel Reeves makes her much-awaited UK budget statement. Joining us now, Rupert Harrison, Senior Advisor for the UK at PIMCO, former Chief Economic Advisor to the UK Conservative Government. Rupert, really nice to have you with us. Thank you so much for joining us. So, I mean, the bond market must be front and centre for everybody's thinking when it comes to the UK budget tomorrow. What does fiscal credibility look like, do you think, when it comes to the budget? What does she need to keep an eye on specifically to keep that bond market movement in check?
Yeah, I mean, I think there's been a bit of a risk premium priced into the bond market and probably the currency over the last few weeks because of all the speculation and particularly the U-turn on income tax. So I don't think she needs to do very much to see some of that sort of come out and a bit of relief in the gilt market. She needs to deliver on the fiscal plan. She needs to show that she has the political ability to raise taxes, maybe a little bit of spending cuts in the mix, but mainly tax rises, that she is going to deliver more headroom. I think the market is expecting a minimum of 15 billion headroom, ideally 20. Even that would be relatively small by historical standards, but it would be an improvement on 10. And then I think that the profiling of the consolidation is going to be quite important for credibility. So if it's all backloaded in those last couple of years, I think that might raise a few questions.
Yes, with similar numbers coming to us from the IFS earlier on when we spoke to them. They were talking about the 15, but also suggesting this in terms of the headroom, but also suggesting that this would be low by historical standards. I mean, wouldn't it just be a relief for everybody if it were substantially higher, and then the government wouldn't necessarily have to be whipsawed by daily moves in bond markets?
I mean, completely, but it's a bit like that old adage of, I wouldn't start from here.
Yeah.
So, the best decision would have been in that first budget to do more on tax and spend or whatever, the mix that she'd chosen, and give herself more like 30, maybe even, 30, 35 billion. That would be more comparable with the previous periods after previous changes of government, so after 2010 or the early Gordon Brown era, and gives you much more, leeway against changes in the forecast. The problem when you're starting with minus 10, which is probably where she starts before any measures, is that, every 5 billion is extremely politically painful. That's a lot of tax that you have to raise from a lot of people. And so what we've heard in recent days is that, 15 billion, I think, is the bare minimum, and I think the Treasury would love to get to 20 and to be able to say, well, we've doubled the headroom. I think that has a decent ring to it.
Yeah.
We had a conversation the other day with RBC Blue Bay, and the line there was that the gilt market won't believe anything this government says until it incredibly shows that it can cut as well as raise. That's true.
I'm not sure that's true in the short term, because I think the market has come to terms with the fact that serious spending cuts are really off the table while you have this Labour government, particularly because the Labour backbenchers are so influential given the U-turn we had on welfare. I mean, I think we will see a little bit on spending. We might see a tweak to the spending assumptions at the end of the forecast. That is probably on the less credible side. I think if we get some cuts to budgets over the next couple of years dressed up as if, efficiency savings, that will add to the mix. But I think the market understands there's got to be tax. And I think the test will be, is it tax revenues that the OBR think are stable, predictable, and will these tax rises definitely get through the House of Commons, which I think is much more likely with tax rises through the Labour Party than spending cuts.
Is this going to be growth negative or growth positive?
On balance, clearly tighter fiscal policy is going to be growth negative. I think we will see downgrades to the growth forecast, not least because we know the OBR is going to downgrade its trend growth assumptions. So I think we will see probably almost every year of the forecast lower growth. In a sense, that is good for the gilt market because I think that's going to create more space for the Bank of England to cut rates. And also, I think we are...
Do you think they're going to need to cut rates?
Well, yeah, certainly at PIMCO we think that the market is underestimating the need for rate cuts, particularly because the labour market is weakening and inflation is already coming down. And I think to the extent that we might get a surprise tomorrow in the budget, I think that more action than expected to cut inflation, bring down people's energy bills, fuel duty, I think that might be where the Chancellor would like to pull some sort of mini rabbits out of the hat.
Mini rabbits.
Tiny rabbits.
Forgotten the diminutive of a rabbit.
Going back to the growth picture, should growth still be a priority at this moment? You talked about what would be reassuring for the gilt market. Is it just about plugging the gap for now?
Look, growth should, of course, be a priority because when you're thinking about medium-term and longer-term fiscal sustainability and, of course, the growth in living standards that the government was elected to try and deliver, growth is absolutely crucial to both of those. But a prerequisite for growth is stability and predictability in policy. So I think that they have to restore fiscal credibility as kind of step one towards growth. And indeed, it would be, going back to the discussion about headroom, getting out of this 6-monthly cycle of speculation is really important for growth. Because it's been politically damaging, all this speculation, but it also has very real economic consequences in terms of frozen investment and the hit to consumer and business confidence. So, it's possible that this budget, if it does enough, could be a bit of a clearing moment for that uncertainty and speculation and then allow people to focus on a longer-term horizon.
Well, you mentioned the tax rises. Helen Miller over at the IFS earlier in the program had talked about that and called them delightful little treats, as in like a fun little combination of various tax rises. Is it just better to get one giant tax rise? How damaging would that be?
She wasn't a huge fan of the small little treats.
Yeah, I know. A raised eyebrow, I imagine, when she said that. Look, clearly that would be better. And actually, that's not just the view right now. If you look back in history, in the UK in particular, but also other countries, in the UK, successful tax-raising budgets, so if you think of Geoffrey Howe in the early 80s, Gordon Brown in 2001 when the Blair government raised national insurance, Geoffrey Howe and George Osborne in 2010 both raised value-added tax. Those big levers, first of all, they raise the vast majority of revenues in the tax system, and they're also predictable. They raise revenue without big distortions. No one likes paying more income tax, but a big income tax rise is evenly spread, easy to forecast, and less distortionary and has less growth impact than some of these kind of capital taxes that I think we're going to get tomorrow. So clearly that would have been preferable, but in the end, the politics has come down on the other side of that, and that's why we're going to get this. The word that is being used in the Treasury is this smorgasbord of a list of...
That's where the delightful little treats thing came
I know,
up.
but exactly. I always struggle with a buffet. Never know, it's always confusing, and I do wonder whether business is going to see it that way, that it's just going to be... it's going to get more complex, not less complex.
I'm taking you to a buffet after the show, so I can teach you how to do it right. Rupert, but isn't the argument you're making on the tax piece, that completely undermines the growth picture, though? You're talking about trying to tackle growth in the medium and long term and incentivize it, while also advocating for the giant tax rate. Aren't those contrarian measures?
Look, I clearly think that the market and most economists would prefer more of the emphasis to be on spending, particularly the less productive parts of spending. So I think that they would like to see serious welfare reform, for example, particularly in areas like health and disability benefits where you've got a very rapidly rising bill. So even limiting the increase in that, not even reducing the spending, would be a really good start. And that would be good for growth, good for confidence, good for credibility. If the assumption is that's off the table, all we're left with is tax rises, and then it's a question of minimising the damage.
All we've seen so far is fewer Mercs and BMWs, but we'll see whether we get in more detail on that. Let me ask you more seriously about AI and whether the UK, we haven't got time to do justice to this subject, but is the UK going to be well positioned to make any productivity gains that are available to it from AI technology, do you think, Rupert? Given it, the service nature of the economy, does that make it a good thing or a bad thing?
Well, a very heavily service sector economy has been a real problem for productivity growth for many countries, but particularly the UK, because some of those services have been very stubbornly resistant to process and process changes and innovation. And I think the big hope is that AI can be a real transformational technology in services. I think the UK is relatively well positioned because it also has a good AI sector in terms of, particularly around London, but also some other parts of the country in terms of some of those big firms are located in the UK. There's a big skill base. So the UK should be relatively well positioned and also should have a little bit more flexibility. So this could be one area where actually the flexibility of Brexit allows the UK government to set a regulatory framework for AI that is perhaps a little bit more permissive than the rest of Europe. So it should, if done right, be relatively well positioned.
Can I ask you the tricky question around all of this? Is the gilt market going to focus on the growth aspect, the kind of what happens with the economy when it comes to this budget, or is it going to focus on what it means for Rachel Reeves' political career and whether or not she gets replaced by somebody that is further left than her, whether the government gets kind of changed and there is a further left government? Which way, what's the most important bit here?
So I think that's a really good question because I think that the most that the budget can do is settle the kind of short-term nerves now. And I think, as I said, I think it can be a short-term clearing moment by getting back on track with the fiscal path. But the reality is, and I think this is what underpins your question, that over the last couple of weeks, the genie is out of the bottle now about Labour leadership. And about the markets are now talking a lot about what is the probability that Keir Starmer and Rachel Reeves won't be here in a couple of years' time, and you'll have a different leadership of the Labour Party. And I think that clearly creates risks. And therefore, you have seen that particularly in the kind of longer end of the gilt curve. I think that premium is going to be much harder to remove. And something that maybe we'll be living with for the foreseeable future.
OK, something to keep in mind then. Rupert, thank you so much. Thanks for joining us. Rupert Harrison, Senior Advisor for the UK at PIMCO and former Chief Economic Advisor, of course, to the UK government. We have a lot of programming on this subject tomorrow. UK Chancellor Rachel Reeves is expected to deliver her budget 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trade will break down the numbers with key business and political voices in our budget special. That is Thursday in the cold, just for you, Thursday morning.
With a beautiful view of St. Paul's Cathedral. We're very excited about it. In the meantime, we are seeing these markets kind of mixed. Green on screen in Europe, red in the States. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Tech drives gains for global stocks as confidence grows over a potential rate cut by the Fed next month, but the rally fades in Europe. The gold standard under threat, Nvidia shares slip on a report Meta is in talks to spend billions on AI chips from Google. We'll bring you the pre-market moves in just a moment. And tensions over Taiwan. President Trump holds back-to-back calls with the leaders of China and Japan as the diplomatic fallout continues between Beijing and Tokyo. Let's get you up to speed on these markets because we saw a positive end for Wall Street yesterday with both of the majors, S&P and NASDAQ, posting solid gains north of 1.5% for the S&P, 2% for the NASDAQ. Today, the handover from Asia pretty positive as well. The Asia Pacific Index up 0.5%. S&P futures trading sideways, moderately weaker, with a focus on some of the more dovish commentary coming through from Chris Waller, one of those Fed policymakers, putting a December rate cut firmly back on the table again. 10-year yields at 4.04, and then the euro slightly firmer versus the USD. 115.30 is where we are at. A little bit of weakness in the dollar. Keep a close eye on those EU-US trade discussions. As for the European map, it's a mixed picture. All eyes on the UK as we get closer and closer to that budget happening tomorrow. Of course, a bit of green on the FTSE, CAC 40 as well. The underperforming indices today seem to be the peripheries, with the FTSE showing a bit of red today. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai. Well, the information reporting that Meta is in talks to spend billions of dollars on Google's AI chips. An agreement would help establish Google's chips as a rival to the industry's best-selling AI accelerator made by NVIDIA. So take a look at the respective price action. This is the first glimpse that we're getting of pre-market price action. NVIDIA down 2.5%, Alphabet up almost an equal amount, 2.7% firmer. And what we're seeing is more competition come through, especially with those TPUs, an important AI accelerator component, in addition to, of course, the launch and the success of Gemini, a competitor for OpenAI. So this is one of the big themes that we're watching out in the tech space this morning. One of the other big themes is vis-a-vis growing calls for a rate cut. So let's talk about that. Confidence is growing for a potential Fed rate cut in December. Governor Christopher Waller says he will advocate for an interest rate cut at the next meeting.
My concern is mainly the labor market in terms of our dual mandate. So I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released. And if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Well, traders are now pricing in an almost 80% chance of a U.S. rate reduction next month. Let's bring in Bloomberg Markets Live Executive Editor Mark Codmore. Mark, it wasn't that long ago that there were only 6-7 basis points priced into the meeting next month, and now we're looking at 19 basis points. All of that has happened in the last couple of days. What is it about the Fed's messaging? What has prompted the Fed's messaging to change?
I think Williams' speech at the end of last week was absolutely vital here. He's seen as a bit of a spokesperson for Powell, and importantly, he was the person who hadn't said much recently. So his kind of guidance that there would be, there's possibility of a rate cut in December, kind of spoke to the way that Powell is probably leaning. And I think Powell's probably got the votes to deliver that rate cut. We're in a slightly strange dynamic that the Fed blackout period starts this Friday. Normally, we have a decision about 80% priced or higher going into that blackout period. Fed officials make sure that the pricing is right. They don't like surprising the market. And it's very rare that we then change plans. It's obviously completely different this year because we've got so much delayed data coming through from the shutdown that there's a genuine debate out there. But I think that the messaging from Williams last week is very important. I think that the base case now is that we will get a rate cut in December, and it'll require the data between now and then to kind of really surprise, to change that narrative. There is a lot of data to come which has the possibility to do so, but I don't think we're going to get enough of the kind of the headline CPI and jobs data that's going to really change things.
Yeah, and looking ahead today, we have obviously retail sales and PPI on the docket as well, something to watch out for there. But I guess if you look back at that jobs report, the delayed jobs report that came through, maybe the market simply misinterpreted it. The strength in the headline should have been focused more on that uptick in the unemployment rate. Do you think perhaps that is really what the Fed policymakers are focused on here, the weakness in the job market?
I think that's definitely a viable narrative, but you've got to remember that also an outdated jobs report at this stage, and we're going to then missing some jobs data. I think the fact is here is that because of the administration pressure, because you've got several candidates on the current board who are angling to be a potential to be the next Fed chair, you've got pressure to provide easier policy than orthodox monetary policy, economics would suggest. So in orthodox economics, there's no way we'd have enough data to justify a rate cut just yet in the US. But people can't risk being behind the curve. They want to err on being premature if they make any error, which is not how normal orthodox central banking should work. Normally it should work that you wait till you're definitely going towards a recession and then you cut super aggressively. Premature rate cuts aren't always a good idea, especially when we've had an inflation scare in the last few years. But we're erring towards being a premature rate cut. And I think that because of that, there are enough inconsistencies in the data to say that, hey, maybe the economy is slowing enough to provide what Donald Trump and the administration wants. And that's why we're leaning that way in the pricing.
Yeah, always good to chat to you. Bloomberg's Markets Live executive editor Mark Cudmore laying it out for us. Well, another day, another debate on private credit, this time with Apollo's Mark Rowan weighing in, saying that people have, quote, lost their minds over private credit fears. If he's right, where should we be looking for credit opportunities across both public and private markets? Joining me now to discuss is Omotunde Lawal, head of EMEA Corporate Credit and EM Corporate Credit at Barings. Good to have you with us. Before we lean into the opportunities, I just want to bring it back to something that our colleague Mark was just talking about, which is what he's referred to as a premature cut. Other people are calling it as an insurance cut. Do you think we're going to get that out of the Fed this December?
Thanks, Jemana. Yes, certainly. I think if you look at the last sort of 4 weeks, we've seen quite a lot of sort of big swings in the market with what the market is pricing in about the December rate cut. We've gone from less than a 90% chance to less than a 30. Sorry, more than a 90% chance, less than a 30, to now around 80% chance. So certainly the market oscillates between the narrative of a weak labor market to a weak labor market plus sort of AI tech bubble to what it seems to be AI bringing productivity gains and all of that. And certainly from where we sit today, it does seem like we're set to see perhaps this rate cut for December. And generally what we're thinking there is potentially there is a scenario where you're seeing this dichotomy play out for much longer, where the front end of the yield curves are anchored down by this sort of concerns around the weaker labor market, but actually the long end starts to price in the expectation for next year, where ahead of midterm elections, the U.S. probably starts to come back to life with some of the tax cuts that are due to come from the one big beautiful bill, the sort of high tensions from trade uncertainty starting to fade away, and some inflation starting to creep back in there. And so potentially you do see a scenario where the Fed, as Mark was saying, preemptively cuts in December, but then we have a scenario where the front end of the curve is anchored there lower, but actually the longer end of the yield curve actually starts to price in this stronger growth picture for U.S. for next year. You've seen quite a few of the sell-side guys have actually revised out their U.S. GDP growth forecast for next year.
Yeah, it's interesting you mentioned the shape of the curve as well, because you have seen just in the last couple of days money pour into the front end of the U.S. yield curve. Is that also happening in EM, or has it yet to catch up?
So within EM, for us generically, I mean, lower rates is good for everyone because everyone's pricing off of that, right? So EM generically has benefited from the fact that U.S. rates coming down or the Fed cutting rates is good for yield-seeking assets. If I think about what history tells us that EM corporates actually have generated quite positive returns after peak Fed rate. We've seen peak Fed rate since July of 2024. And so we're seeing EM returns sort of matching what history tells us. I think year-to-date coming up to July of this year, we've seen EM corporate returns coming up around 18% cumulative, which is in line with history where cumulative EM returns post-peak Fed rates has been anywhere from 18 to 22%. So EM generally benefits from that. And for us specifically, we actually find the short-dated part of EM corporates quite interesting because that again speaks to the kind of rates volatility that we've seen. If you focus on the short dated part of the curve, you're minimizing that volatility that you ordinarily get from the swings with, is the Fed going to cut, is the Fed not going to cut, what are rates doing or rates not doing. And that's why we like EM from the perspective that EM is less vulnerable to all the AI tech bubble noise, but also the short dated part of the curve because you benefit from what we think might happen with the front end being more anchored and with the long end reflecting a stronger growth picture for the US next year.
And to be clear, you're buying this on all-in yield as opposed to on a spread basis. Spreads, you could argue, credit spreads are extremely tight. It would be tough to see a replication of 2025's performance in 2026. So what is the best way to position?
Correct. We're really looking at all-in yields here. When you look at yields, especially on the sort of EM corporate side, you're looking at IG yields anywhere from 4.5% to call it 5.25%. And that's actually quite interesting for us. And when we look at that, you're still seeing a 20 bips pickup to developed markets for the investment grade portion. And you're seeing anywhere from 80 to 100 bips pickup against developed market on the high yield segment of the market. So actually, that's still quite interesting when you look at it on an all-in yield basis.
Yeah. I want to ask you about private credit and pick your brains there. And I wonder whether there's some crowding out effect that may be going on because of the sheer amount of investor interest there is in getting exposure to the private markets. Is that moving attention away from some of the public markets that you look at in EM? And, of course, in DM as well, but EM in your case?
So we've seen a huge amount of interest in private credit and the size of the market, if you believe any of the stats out there, is anywhere from $2 to $3 trillion. And that's certainly taken some of the heat off our public market. Some of the issuers that might ordinarily try to come to issue in our dollar public market have probably found other avenues. So it's become another lever that borrowers can pull in terms of private credit. Is it taking away business from the public side of the market? No, not necessarily, because I think it's just another lever for the markets to pull. And I think it also provides a bit more diversification for capital structures for different borrowers. So it's a good thing in terms of that. In terms of whether or not there are concerns of what is going on in the current private sector space in terms of a couple of instances of distress within the private credit market and what it might mean for the public's market. We definitely keep an eye on it because if you see distress in some private credit sectors, it has the potential to reprice leverage loans, which then has a potential to reprice all of credit, EM included. Potentially, that also has the impact that where some investors suffer some distress or credit events on some private credit stuff, they might be seeking liquidity or redemptions from other liquid parts of their investments, and that tends to come through from the public credit side, which impacts us as well. And also just general risk sentiment where, sometimes if these sort of credit events persist, that general risk sentiment around credit in general also has the potential to impact us. So we do keep an eye on it for multiple reasons, the repricing risk, the liquidity risk, the credit sentiment risk. These are all the reasons why we do keep an eye on what's going on in the private credit market. But by and large, we find it quite encouraging that there is just another lever for investors for borrowers to use in terms of borrowing, especially in EM. We are starting to see a lot more private credit activity within emerging markets. Markets like India, we're seeing a lot more private credit activity.
Yeah, makes sense. We've talked about the fundamentals being solid, the fact that many of these EM economies have undertaken reforms that are actually beginning to pay off. I just wonder from a technical perspective, what you think issuance is going to look like for next year in an environment where the Feds continue with their easing cycle. Will you see a lot more issuance come to the market from some of these EM issuers?
Yeah, I think if you take a step back, you look at this year, EM corporates, for example, gross forecast for supply for the year from JP Morgan, who we track closely for the asset class, originally was supposed to be something about 430 billion. That got revised upwards. I think right now the forecast for the full year for 2025 is something about 460 billion, and we're currently around 455-ish billion. So we're very close. It probably will exceed the upward revised forecast. And that is in comparison to the US IG market, for example, where they've had a huge amount of supply. I think the number that I heard more recently is a net supply of about 800 billion, which is up 60% year on year in the US. And a lot of that is the AI and tech capex investments driven supply. Do I see that repeating in 2026? Absolutely. I think some of the numbers that are being thrown around in terms of AI tech investments for the next few years varies from 5 trillion between now and 2030 to 9 to 13 trillion per year between now and 2030, depending on whose sell-side research you believe. So that's a huge amount of supply. And that will be funded through developed markets. Some of it will emerging markets, some of it will be public, a lot of it will be private, and some of it will be equity. So do I think some of that sort of seeps into the emerging market space? Absolutely. You know, you've got the likes of the Babas, the Tencents, you know, the China tech companies. Yeah. You know, this morning you were speaking about Google buying chips from Meta. Some of that sort of AI capex with China is also in that race. Some of that AI capex will be funded through EM as well, but I think it pales in comparison potentially to the supply that we will likely see from developed markets.
Yeah, so interesting to make the comparison between the two. And actually, it's DM where the issuance is getting ramped up. Motunde Lawal, thank you so much for joining us, head of EMEA Corporate Credits and Emerging Markets Corporate Debt at Barings. Thank you so much. Oh, coming up, Russia and Ukraine exchange fire just hours after President Trump struck a positive tone on the prospects of a ceasefire. More details next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
Everything is on the table when you have such a great partner as the European Union. They have 450 million people and a $20 trillion economy. So the opportunity is great. They would like to have steel and aluminum as part of this package. And we think it is very, very important that they understand our digital companies and they reconsider their digital regulations.
U.S. Commerce Secretary Howard Lutnick saying Brussels needs to change its digital regulations in order to get a deal to lower steel and aluminum tariffs. Now, the EU's antitrust chief has since ruled out easing the bloc's tech rulebook. So for more, Bloomberg's Hong Kong news desk editor Balazs Pence joins me now. So the EU really digging their heels in here. It seems very unlikely that they're going to yield to the U.S. demands to make modifications on the digital rulebook.
That's correct, Jumana. The U.S., especially the big tech companies, have long been pushing to ease some of those EU digital regulations. Some of the biggest companies like Meta, like Amazon, like Apple, I could go and list almost the entire Mac 7. They have been hit by multi-million-dollar fines, lengthy litigation processes. So they have been trying to push the EU to ease on some of those rules. And clearly, the White House now saw an opportunity to tie those regulations to the tariff talks. As Howard Lutnick mentioned, we just heard him talk about the metals tariffs. They thought that there may be some leeway if they tie these two issues together. But the EU was very firm, and they said immediately that these regulations are not up for negotiations. They don't think they are discriminatory. They say that these apply for all companies, including European companies. And they say that these are vital to protect the interests of European consumers. So as Howard Lutnick said, the EU is a large market, 450 million people, and if American companies want access to the market, the Europeans are saying they have to play by the rules.
Yeah. Well, let's switch over to something that's closer to your neck of the woods. President Trump has spoken to both President Xi and Prime Minister Takaichi. Obviously, we know that there's a bit of a diplomatic spat going on between China and Japan right now. How delicate is the U.S.-Taiwan tightrope?
Well, I think you have to look no further than the fact that President Trump spoke with both President Xi and Prime Minister Takaichi over this issue. And from Beijing and Tokyo, we heard that it was the U.S. side that initiated those talks. So clearly, Trump is trying to insert himself into this very, very delicate situation and trying to keep both China and Japan on his side. Let me just remind you, the U.S. is in the middle of very important trade negotiations with China. So the last thing they need is for those to fall apart over the issue of Taiwan. Trump had a very important meeting with President Xi in Busan not too long ago, and both sides described that as a very good meeting. But crucially, the issue of Taiwan did not come up. So now the issue is back on the table, and the president needs to make sure that Japan, a very important ally, stays on its side, but at the same time, he can continue building a constructive relationship with China.
Yeah. Bloomberg's Hong Kong news desk editor Balazs Pence, thank you so much for the overview. Well, Russia and Ukraine exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Bloomberg's chief Europe correspondent, Oliver Crook, joins us now. So, Oliver, this Thursday was supposed to be the original deadline for Ukraine to agree to the peace plan presented by the U.S. What is the latest on these negotiations? Where does the peace plan actually stand?
Yeah, I would begin by saying that the Thursday deadline is probably a pretty fluid one. This is something that Marco Rubio, the U.S. Secretary of State, suggested after those Geneva talks that lasted about 24 hours over the weekend, that basically this may not be the fixed and the firm deadline, because as you know, Jumana, this is an intensely complicated issue to deal with a great many issues, from sort of NATO-like guarantees for Ukraine, territory swaps, all of these sorts of things still need to be thrashed out. But of course, the U.S. administration's ambition is to put a fire beneath the Ukrainians, beneath the Russians, and try to drive everybody to the negotiating table. So what we started with was a 28-point plan. We understand that we now have a 19-point plan after those discussions in Geneva that is now being shopped around to the various parties. We should say that today the attention is in the UAE, where Dan Driscoll, the Army Secretary of the United States, who's now taking a larger role in these negotiations, has been speaking with Russian officials. We should say that the Russian officials were quite dismissive initially of this now 19-point plan. But we should say, again, this is an ongoing negotiation. It seems like this 19-point plan is currently the sort of living document that we have that is being amended and being shot back and forth between the two sides. And we should also say that we're hearing just now from some Ukrainian officials over the last couple of minutes here saying that there's an expectation that President Zelensky will go to the United States within the next 4 days before the end of the month of November to discuss with Donald Trump. Because another thing, Jumana, is within that 19-point plan that the Ukrainians gave back to the United States, many of the most difficult issues, such as territory and some of the other political solutions, have been left off the list because Zelensky wants to speak to Trump about it personally.
Yeah, what are the types of measures that the U.S. and Europe can exert to get this across the line?
So I think for both sides, we've talked about it many, many times, Jumana, and I'm sorry to sound like a broken record, but the main point of leverage for the Europeans is about those Russian assets that are now frozen, 140 billion euros worth of them that are sitting here in Belgium. They have not had consensus on how to proceed with that. There is some question now because those assets were discussed in the 28-point plan by the United States. Are they now off the table, or is there even more urgency for the Europeans to move on it? That is kind of a divided opinion within Europe. But we should also say, Jumana, we shouldn't forget two things. One, that sanction package on Rosneft and that went into effect, that happened last Friday. That is going to begin to start hitting the Russian economy over the next weeks and months to come. And there is, of course, that bipartisan bill about secondary sanctions that would really hurt Russia that is sitting with the Senate. That just takes Donald Trump to put it forward. It's one of the few things bipartisanly there is agreement within the United States. That would go through and that would damage Russia immensely if Trump wants to pull that trigger.
Yeah. The story that we're watching very closely, Bloomberg's chief European correspondent, Oliver Crook. Thank you so much for that. All right, well, coming up, we're going to tell you what to expect from the budget. It is finally here. The day is finally here. That's tomorrow, obviously, with Barclays' Jack Meaning. Stay with us for that conversation. It's coming up next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning. This is The Pulse. I'm Joanna Bersecci in Dubai. Tech drives gains for global stocks as confidence grows over a potential rate cut by the Fed next month. But the rally fades in Europe. The gold standard under threat. Nvidia shares slip on a report Meta is in talks to spend billions on AI chips from Google. These are the market moves. You can see Nvidia down 1.5%, Alphabet up 2.6%. And tensions over Taiwan. President Trump holds back-to-back calls with the leaders of China and Japan as the diplomatic fallout continues between Beijing and Tokyo. And in corporate news today, EasyJet says it's receiving aircraft from Airbus at a growing rate, helping the UK budget carrier improve capacity as demand for low-cost travel remains high. The carrier's CEO also told Bloomberg he hoped the UK government would freeze or cut air passenger duty in its budget this week.
I hope there's some consistency in the budget. The government have been very pro-aviation and pro-growth. They really recognise the valuable role that aviation plays, especially to an island economy, in enabling growth. So I would hope that there is some sort of freeze or even reduction on air passenger duty, because last time we saw a reduction in 2023 on domestic APD, EasyJet added capacity, other carriers added capacity, that increased the connectivity, increased the consumer choice and brought down fares. And I think that, that kind of action would be very encouraging, but we'll have to wait and see.
Well, for more, I'm joined by Bloomberg's aerospace reporter, Kate Duffy. Kate, it's interesting to see the price action in EasyJet stock today because even though they beat for the full year, I guess some concerns about the outlook coming through?
Yeah, absolutely. It was a real mixed bag this morning from EasyJet. So what we really saw was this strong demand for package holidays. So EasyJet's holiday business, the profit target there has been upgraded for fiscal 2030, and also seeing a growing confidence for Airbus deliveries as well. So that they were all in line with expectations. They received 9 aircraft in 2025. Going forward, they are expecting to receive 17 aircraft as well. But what really struck us was the consumer demand as well on top of that, and that flows through into the positive momentum that they're seeing for their holidays business.
Yeah, and let me take you in a slightly different direction. Some news coming through this morning from Boeing saying that they have gained ground in its war against defects for its 737 MAX. What more do we know? Obviously, this is a big issue that's been swirling around the production of these 737 MAXs.
Yeah, absolutely. So our colleague Julie Johnson got access to one of the main factories at Boeing and spoke to the key players over there. Essentially, what we're seeing is very subtle changes, but important changes that are contributing towards the improvement in the quality of Boeing's aircraft. So what we're seeing is a decline in lost tools, also less defects in the airframe, and more inspectors looking at the fuselages that come into the factories. And this is all in the wake of the Alaska Airlines panel blowout that we saw nearly a year ago now. And obviously, they're looking to increase the FAA production rate on some of their aircraft as well. They've achieved that with the 737, also the 787, but they're not quite out the dark yet. They're still trying to get the certification for the 777X, and that's something that customers have really long been waiting for. But in terms of the reaction to the quality of the products that they're seeing, customers are really happy. You know, Ryanair's Chief Executive Officer, Michael O'Leary, was a fierce critic of Boeing earlier this year, saying that, that the deliveries were slow, they were stunting growth. But in more recent times, he's been really positive about Boeing's production, the communication style that they have. So, yes, our colleague Julie Johnson, she was over there and really saw the improvement that Boeing is making in its factories.
Interesting. Kate Duffy, Bloomberg's aerospace reporter, thank you so much for bringing those lines from Boeing and EasyJet as well. Now, investors will be keeping a close eye on the gilt market tomorrow as Rachel Reeves makes her much-awaited UK budget statement. Bloomberg understands the Chancellor is to slash the amount Britons can save in their tax-free cash ISA savings accounts each year from £20,000 to £12,000. The move is a bid to get households investing more in UK stocks. For more, Anna Andrade from Bloomberg Economics joins me now. It feels like every day we're getting a drip feed of measures that may or may be coming in the budget. Let's just talk about the ISA here. How big of a deal is it that the level is being lowered to £12,000? I guess the goal is to try to incentivize UK savers to invest more in the stock market, but big question mark as to whether they may succeed.
Yeah, I think that's exactly right. This is part of a push from Rachel Reeves to sort of raise revenue while at the same time incentivizing growth. I'm a bit skeptical she'll be successful at either of these, essentially because it incentivizes households to move their savings away from cash, potentially into stocks, but not necessarily British stocks. And the second thing, from a public finance perspective, it also represents Reeves going after sort of a narrower tax base than, if you look at income tax, VAT, NICs, and corporation tax, these are bigger tax streams. So essentially, Reeves targeting savings and Reeves targeting pensions, which you've also seen in the news, represents she trying to get some money out of these narrower tax bases. The problem is that they won't yield as much, and there's another big question mark about how certain these sort of revenues will be, because these are mobile tax bases, people will adjust their behavior in response to these taxes, so there's a risk that they don't yield as much as the OBR forecasts or Reeves is expecting. And I think that's something that's worrying investors, sort of the composition of the savings, and that's something they will be looked at very closely tomorrow.
Yeah, most definitely. Bond vigilantes keeping a close eye on everything that's announced, and also whether she actually sticks to some of her own fiscal rules. What are some of the other measures or policies that we're expecting out of the budget tomorrow?
I mean, I think one thing that bond vigilantes will be looking at in particular would be sort of anything that can sort of impact inflation. And there's two ways that the budget can impact inflation tomorrow. I mean, if Reeves delivers a big fiscal consolidation, that by default will sort of, be disinflationary. It will weigh on the economy. But I guess what investors will want to see is that this consolidation is sort of front-loaded, so it happens sort of in the next few years. If Reeves sort of backloads the fiscal consolidation, investors might get concerned that she actually won't follow through with these measures in 2029, which is like an election year. That's one thing. The second thing that they will be looking at is measures that directly impact inflation. So here we're talking about, freezes to sort of a reduction in the VAT of energy bills and freezes to rail fares. So all of these will sort of mechanically bring down inflation by as much as 0.4 percentage points, according to our estimates. And that's something that would be really welcomed by investors, as it would sort of clear the path for the Bank of England to sort of cut rates this year.
Anna Andrade from Bloomberg Economics, thank you for setting up our next conversation. Well, staying with the UK, my next guest says tomorrow's budget has been weighing on spending and activity in the economy. Joining me now is Jack Meaning, Chief UK Economist at Barclays. I'm going to start off by simply asking you, Jack, what your expectations are for the amount of fiscal consolidation we're going to get from tomorrow's budget.
Yeah, thanks, Jemana. I mean, I think, look, it's clear there's a lot of uncertainty around this, probably more than we've had for most fiscal events in recent years. But I think, where we think there's broad consensus is the Chancellor's going to need to find something in terms of 25, maybe 35 billion pounds of net consolidation if she wants to increase her headroom from where she was last time to at least 15 billion, which is what we think the market's looking for.
Yeah, so anything short of £15 billion on the headroom, you think will spook gilt investors out? Is that your interpretation, if 15 is sort of the line in the sand?
Absolutely. So if you look back at previous budgets, normally chancellors have been able to have somewhere between 0.5% and 1% of GDP, and we haven't had this repeated conversation that markets have been obsessing about for weeks now of whether the chancellor's going to breach her headroom. We did some work at Barclays with the Institute for Fiscal Studies and found that, if she had 10 billion of headroom, that would give her maybe a 1 in 3 chance that at the next fiscal event she'll have to come back and ask for more tax increases, which obviously politically that's bad. From a market sentiment point of view, that's not a great look. So we think 15 billion is probably the minimum the market is looking for. Anything closer to 20, anything more like 25, that's harder to get given the fiscal constraints the Chancellor has put on herself. Yeah. But actually that would be a more positive reaction from the market.
Yeah, my colleague Anna Andrade raised another good point as to whether the fiscal consolidation is front-loaded or back-loaded? How closely are you going to be watching that for? And again, how closely will Guild participants be watching out for the timing of this fiscal consolidation?
Yeah, I mean, I think there are a few things within that, Jemana. The first is that actually we know that some of this will be backloaded, or we have a good idea that some of it will be backloaded, in the fact that we think that freezing of income tax thresholds for another 2 years from 2028 onwards will raise maybe £8 to £10 billion of the gap. So obviously that doesn't kick in until the latter part of the Parliament. And so to some extent there will be something backloaded in there. But actually for market credibility, the market is kind of a, we'll see what you do rather than what you say. And I think that means that actually it's important that, the rest of the consolidation is front-loaded. Add into that, there's an important political economy consideration here, which is if their front-loading comes in at this budget and is in the next year or two, the peak pain for the UK economy will be maybe on our model in early 2028. If you muddle through this budget and you ultimately end up having to make another consolidation next year, then peak pain is really hitting the economy at the point that we go to the polls for the 2029 election. And that's a difficult sell, I think.
So they've got to be mindful of that. Yeah, they've got to be mindful of that. Okay, very good point on the impact on the economy. She's also talked about, the Chancellor's talked about wanting to bring down inflation levels. Do they have the power to do that mechanically? I mean, we know that one of the measures that's been leaked is the freezing of rail fares. Is that likely to have knock-on effects to the inflation path looking ahead to 2026?
Yeah, I mean, I think there's a whole range of measures. Anna was talking about them, some of them just before this. But, I think if we look at freezing of VAT on household energy bills, rail fares, maybe freezing of fuel duty, all of those things could take out 0.4, maybe 0.5 percentage points out of inflation by the time we get to April next year, maybe even sooner for some of those measures. Ordinarily, you would think the Bank of England would look through some of those price level shocks, some of the things that temporarily bring down inflation. But actually, the hawks on the Bank of England's committee have pointed to the risks that persistent inflation at the moment could lead to higher inflation expectations, more persistent inflation in the medium term. So anything that brings down that near-term inflation profile probably reduces that risk, and therefore, just frees up the Bank of England that little bit more to look at rate cuts.
That's exactly why I was asking you that question, because, the knock-on effect from that could be that it frees up Bank of England's hands to pursue a more vigorous rate-cutting strategy. What is your outlook for the Bank of England going into next year?
So going into the budget, we think there'll be 2 more cuts before the end of Q1 next year, so most likely in December and March. And then we're broadly in the range that we think the Bank of England views as neutral. So we think at that point, all else equal, they'll take a pause. Now, there's some definite downside risk to that. If the Chancellor delivers a little bit more disinflation in the budget, then, on our kind of forecast, you would be taking out, again, 0.4, maybe 0.5 out of the inflation rate, and that could free you up for more cuts than our baseline.
Yeah. Are you concerned that the net impact on growth also could, again, be very growth negative for the UK and put even more pressure on the Bank of England to come up with expansionary policy?
I mean, look, I think it's pretty obvious that a consolidation at this budget will be a drag on growth. Actually, if the Chancellor manages that consolidation without creating inflation and without losing the confidence of the market, actually our modelling suggests that the drag may not be too big, maybe 0.25% of GDP, maybe as much as 0.4% of GDP on the level. And as I said, that's peaking in terms of pain in around early 2028. Now, the risk is that on our modelling, if the Chancellor finds inflationary levers, either directly through duties and changes to kind of alcohol duties and things, or through something indirectly that puts costs on businesses that they have to pass through, if there's an inflationary consolidation, that could double that impact. So you'd be looking at more like 0.5% of GDP to 0.8% of GDP, and that's a more material drag. So there's a good outcome here where the Chancellor manages the consolidation with a pretty muted effect on growth. But alternatively, if she makes a misstep, which is why the market's so focused on it, then it could be a more material growth drag.
Yeah. What would you say is going to be the ultimate determinant of whether this UK budget has been a success, at least for market participants? Should we single-handedly just be watching out for the price action and gilt yields afterwards? Or should we also be focused on some of the micro sectors, the various parts of the UK economy that also may be exposed to certain measures announced tomorrow?
I mean, I think, look, across gilt yields, FX, the whole constellation, that will give an initial market reaction to the piece and tell you whether ultimately the market finds this credible as a budget. So I think we'll be looking across that whole range of asset prices. But you have to remember as well, we're kind of going into the Thanksgiving weekend. You know, there people kind of around the world may not have as much of an eye on markets necessarily. And so I think actually what we've seen in previous budgets is there's an initial reaction to the kind of headline numbers, but it's taken a day or two really for people to digest what is a huge piece of analytics by the OBR, and ultimately then to come to more sustained conclusions. So I think, yeah, look at those initial reactions, but also take time to work through exactly what's going on in the kind of the broader macroeconomic piece.
Jack Meaning, Chief UK Economist at Barclays, thank you so much for joining The Pulse today. Well, UK Chancellor Rachel Reeves will deliver that budget at 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. And it doesn't stop there. The opening trade will break down the numbers with key business and political voices in a budget special on Thursday. And European car sales have climbed for a fourth straight month in October as the region's automakers continue to push out more affordable electric models. The European Automobile Manufacturers Association says new vehicle registrations rose 4.9% from a year earlier to just shy of 1.1 million units. China's BYD saw sales in the region more than triple, easily outstripping Tesla, whose sales continue to slump with registrations down 48%. And New York Mayor-elect Zohran Mamdani has selected several corporate executives to join his transition team. It comes as the Democratic Socialist seeks to ease concerns that his policies might harm the city's business community. Amongst those chosen to help in his move to City Hall are former Goldman Sachs partner Margaret Anadu, developer Jed Walentas, and Kathy Wild, head of the Partnership for New York City. And in other news, a federal judge has thrown out criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruled that the prosecutor who brought the cases had been illegally appointed. President Trump abruptly installed the prosecutor in September after her predecessor resigned under pressure to bring charges against the pair. Comey and James are amongst a group of Trump's perceived political foes who have faced investigations after the president called for their prosecution. And coming up, China has instructed the country's airlines to reduce the number of flights to Japan, following comments by Japan's Prime Minister on Taiwan. We'll have more details next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg. Good morning. This is The Pulse. I'm Jumana Versace in Dubai. Bloomberg has learned the Chinese government has instructed the country's airlines to reduce the number of flights to Japan through March 2026. Tensions between the two nations were inflamed after Japanese Prime Minister Sanae Takaichi's comments on Taiwan. For more, I'm joined by Bloomberg's chief Asia correspondent, Ross Matheson. So we've all been keeping a very close eye on how this diplomatic spat between Japan and China has been playing out. What is China's latest move signal vis-a-vis the flights, Ross?
Well, as you were saying, they've given this edict essentially to Chinese airlines to cut the number of flights now through into a proportion at least of next year. And that signals that Beijing is really digging in there. In fact, both sides seem to be digging in here. It's been affecting travel to some extent. It's been affecting trade to some extent, although they've held fire on some of the really big impactful stuff, which would be, for example, if China decided to penalize Japan in its eyes by cutting off supply of things like rare earths. For now, the economic impact has been a little bit limited, but this does suggest that they're willing to drag it out. It could become quite protracted. It could, in fact, impact that peak Lunar New Year holiday period, of course, for travel in Asia. And the question again is, what is the off-ramp in this situation? Because Beijing is insisting the Japanese Prime Minister Sanae Takaichi apologize and retract her statement. She's saying she won't. She needs to also sound tough and that she's standing up to China because she's pretty newly in the position as Prime Minister. And so we're at a bit of a standoff here in terms of how this can be de-escalated. And the indications are from China, at least, that it's willing already to play the long game and to see this run on for quite some time.
Yeah, and it's interesting that in the last 24 hours, President Trump has had calls with both the Japanese Prime Minister and President Xi. Really speaks to the tightrope that the U.S. are walking on when it comes to Taiwan. Do we know whether Taiwan was discussed on the call that took place between Presidents Trump and Xi?
Well, at least according to China and their readout, it was discussed. Xi Jinping is said to have told Donald Trump that what they said was the return of Taiwan, which is essentially a self-governing island to China, is for China a key part of the post-World War II global order. Interestingly, the US readout of the conversation between Xi and Trump does not mention Taiwan at all. It talks about trade, it talks about the latest with Russia's war in Ukraine, but it didn't touch on Taiwan. In fact, for Taipei at least, they're interpreting that as a sign that Donald Trump does not want to use Taiwan as a bargaining chip with China in his broader conversations around their relationship and trade, that he doesn't want to get too pulled into this. But obviously, as you say, it's very delicate times because the US probably wants this to de-escalate. Donald Trump sees himself as a peacemaker. He would not want this to be escalating, but equally he can't be seen to be siding too much to Japan, for example, even though Japan is a long-running ally of the US. And so you've got all these delicate issues at play between Taiwan, Japan, China, and the US on this, but indications at least, China says that the US instigated this call with Xi Jinping, which does suggest that Donald Trump is keeping an eye on what's happening at the least and has a vested interest in it not escalating.
Yeah, absolutely. Ross Matheson, thank you so much for bringing us the latest there. I'm going to pivot to markets now. Tech stocks were helping global equities advance for a third day, but the rally seems to have run out of steam in Europe. Bloomberg's Markets Today co-editor Marwana Konayam joins us now. Marwana, talk us through the price action this morning. A lot of volatility going on with some of these key tech stocks today.
Yeah, absolutely. What we have seen is some of those gains that we saw earlier falling back, and actually we are now seeing stocks falling in Europe, and that's mainly because US futures are also turning lower after Nvidia shares are slipping, and that's not surprising because it's been driving so much of the recent equity rally. And it really shows the vulnerability there and how dependent, in fact, world equities right now are on NVIDIA and the AI industry that surrounds it.
Yeah, well, let's speak a bit more about NVIDIA. You mentioned that the shares are slipping. Last time I checked, they were down about 2% in pre-market. But this one report that Meta is in talks to spend billions on AI chips, but from Google. So what challenges does this pose for the industry's poster child for AI dominance?
Yeah, so it's quite significant because we haven't really seen that level of competition before. And a lot of the success is driven by pricing power. But I am kind of interested in what it means longer term, because having some increased competition does suggest that perhaps there's actually more gains to be had elsewhere in the sector. We've seen everything very much driven by NVIDIA so far. And actually, that does pose some risk as well, because as we've just seen, the vulnerability, the moment that the sentiment turned sour. So actually, if there's some diversification, it could also make it a bit more secure as a sort of longer-term underpinning of the equity market.
Bloomberg's Markets Today co-editor Morwana Kanayam. And speaking of markets, let's take a look at how some of the key European indices are faring. We are about an hour, well, almost 2 hours now into the trading session. You can see that not a lot of movement for the Stoxx 600, trading flattish, essentially the DAX down about 15 basis points. The FTSE, all eyes on the UK index as we head to that important UK budget tomorrow, trading sideways today around 9,500. As for US futures, this is how markets are pointed to open up slightly weaker, just as Morwana was saying. And this on back of some of the weakness that we're seeing in NVIDIA. So keep an eye on that and how it all plays out. On the flip side, though, investors continue to bet bigger on the possibility of a rate cut come December. So that is your picture as we head into the U.S. session. Up next, Bloomberg Brief. You've been watching The Pulse. This is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. A win for Alphabet. Meta reportedly in talks to spend billions on Google's AI chips as an alternative to Nvidia's GPUs. Moscow and Kyiv trade airstrikes even as President Trump cites progress on his peace proposal and as US and Russian delegations are set to meet in Abu Dhabi. And markets eyeing a raft of economic data from September retail sales to November's Conference Board survey after a blistering tech rally. So that blistering tech rally looks to be coming to a little bit of a halt today, primarily on weight from Nvidia, most likely after that Google Meta news. So we have futures pointing lower. This after the S&P 500 rose 1.6% yesterday and the Nasdaq 100 was up 2.6%. We'll see if this picture takes a turn because, of course, the other thing on markets' minds is the Federal Reserve. Let's take a look at the bond universe because we have now just a couple of weeks, not even before that Fed meeting, and odds are rising. We're up to about 75% now of a December rate cut. Because think about it, if we don't get one until January, that meeting isn't until January 29th, and that's really more than 2 months away. Can the markets really wait that long? Well, right now the 10-year yield is down to 4.03. We do have the 2-year yield below 4.50 and the 30-year yield still hanging out around the 4.67 mark. Mary Daly out now siding, it looks like, with a cut. And we also have Nick Timmerus in the Wall Street Journal, the Fed whisperer, of course, saying that the ground has been laid for Powell to actually make a cut in December. So we'll see how things progress. For the moment, though, let's get to some individual stock movers. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. Let's start with the biggest story of the day today, which is the report that Meta is in talks to spend billions on Google's AI chips. That would be potentially a big blow to Nvidia, whose chips have been the gold standard, really, in that tech industry for quite some time. We can see that reflected in those shares today, with Alphabet up quite significantly and Nvidia down. But there will be more on that very shortly. Moving on to SanDisk, which is the newest inclusion in the S&P 500. That is a company that makes memory cards and USB sticks, and it is set to replace Interpublic, the ad agency in the S&P 500. That follows a really impressive rally in those shares, and we can see that continuing today with shares up 2.7% pre-market. And finally, let's end with Symbotic, which is a warehouse automation robotics, a company that counts Walmart as one of its biggest customers, and it is up after providing a very upbeat forecast for revenue in the first quarter. Follows a very good year for the company as well, and it is up almost 13% in pre-market trading this morning.
A nice rise there from Symbolic. Chloe, thank you. That is Chloe Melly. And coming up in this hour, we're going to look ahead to that raft of data coming this week and later today in particular with JP Morgan's Priya Misra. The AI race heating up then. Alphabet getting a boost this morning after a report from The Information that Meta is in discussions to use Google AI chips and data centers starting 2027. That's dragging on Nvidia shares. Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. So these would be TPUs, apparently, Tom, as opposed to Nvidia's GPUs. How are they different? Are they better for the likes of inferencing, for example?
Yeah, so they were developed in-house by Alphabet, the parent company of Google, about 10 years ago, and they have since been adapted, and they can continue to be adapted because, of course, Google, as well as having its own chips, also has its own large language model, Gemini, of course. So there's this feedback loop between how the model performs. Then the developers can take that to the engineers of the chip and adjust the chip to add in those performance changes that they may need. In terms of whether or not it's better or not, it kind of depends what your specific aims are when you're one of these AI researchers building one of these models. But certainly it seems to be meeting the needs, certainly not just, it seems, of Meta, at least that's the expectation according to this reporting from The Information. We know it is meeting the needs of Anthropic, and they think that's going to work because Anthropic is committed to a deal with Google as well about being supplied with close to 1 million of these TPUs. The key standout point, Vonnie, obviously, is that it seems that Alphabet, with these partnerships with Anthropic and potentially this partnership with Meta, one of the biggest spenders, hyperscaler spenders on AI chips, it seems that Alphabet is being better positioned with its TPUs as being potentially a bit of a competitive threat to Nvidia, which essentially has dominated the market for these chips.
Yeah, exactly. So what would switching look like in this arena? I mean, is there an incentive on price? Do we know anything about how relative pricing, relative margins would be?
Well, they can work very well in terms of both training the models, but also inference. And it seems to be that is what the emphasis is for Meta in this potential deal, is they want to be able to use these chips for inference. So when we and consumers and enterprise are actually using these chatbots and these large language models, that is the process of inference, and TPUs work very well in that sphere as well. They do have to, and they will have to prove that they can meet both in terms of energy efficiency and in terms of cost as well, of course. And look, Jensen Huang at NVIDIA has been very keen to emphasize that with each new iteration of his own chips and the whole package that comes with it, so the CUDA software, but also the networking that comes with those NVIDIA chips, that you get those gains in efficiency, both on energy and on cost as well. And the latest, of course, generation of NVIDIA chips will be coming, the Rubin will be coming out in 2026, and he says there's already strong demand for that. So this is heating up competition, but in some ways it's also a reminder this is just as much Alphabet's world as it is NVIDIA's world, because not only are they performing and getting demand for their chips, they're also getting demand for Gemini 3, which of course dropped a few days ago and has had very good response, and you've seen that impact in terms of the competitive challenge versus OpenAI, and you've seen the read across to what is essentially a proxy node now for OpenAI, which is SoftBank, listed over in Japan, which has this sizable stake in OpenAI, and its shares have been under pressure. So that has SoftBank's become something of a proxy for the privately held, of course, OpenAI, and concerns that maybe OpenAI is facing more of a competitive threat from Gemini, and particularly Gemini 3.
Yeah, SoftBank shares have been pretty volatile of late. Tom, thank you so much. That is Tom McKenzie, host of Bloomberg Tech Europe. Well, staying on AI, President Trump has signed an executive order to establish what he's calling the Genesis mission in an effort to boost innovation in the AI space. Joining us now is Bloomberg's Suzanne Lynch. Suzanne, what are the details? We know that the president has been making all sorts of deals with individual companies, but as it pertains to specifically this Genesis mission, what is it?
Yeah, the Trump administration had flagged that this was coming, and this is part of the effort by Donald Trump to federalize AI investment, if you like, to try and inject some momentum, some power and some money into the federal government when it comes to investing in AI. He has in the past criticised the role of states for what he sees as holding back AI investment, and is even touting the possibility of being able to censor these states in some way for that. But I think it speaks to the fact that the Trump administration sees AI as the next big investment opportunity. Donald Trump has long spoken about the need for the US to be on top when it comes to the AI race. Of course, a lot of questions remain about the pressure this is going to bring in terms of not just spending investment, but infrastructure on the energy grid, for example, given the role of data centers in this. But it shows that the US administration is prioritizing this AI issue for now.
Yeah, that's domestically. Now, as it pertains to international space, the president has been holding calls. So one with his Chinese counterpart. Just have a listen to this, Suzanne.
I did speak with him about the call. It lasted about an hour, and it was a very positive call. The focus of the call was really Russia, Ukraine did come up, but the focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction.
So that was all very positive from the press secretary there. But on the Chinese side, the foreign ministry briefed this morning and said that, there's a lot going on when it comes to China and Japan, and that Japan's Prime Minister Takaichi hurt Chinese people's feelings, and that this 1972 agreement with Japan recognizes that Taiwan is Chinese. Do we have a problem here, Suzanne, in the sense that the president is keeping both the China premier and the Japanese Prime Minister happy?
Yeah, that's exactly what's happening here. And considering he had those two calls on Monday evening, it shows the balancing act now that is facing the US president. On the one hand, he needs to keep his ally Japan happy on board. On the other hand, he is trying to sign some kind of a trade deal long term with China and resolve the issue of critical materials exports. So I think we can see Donald Trump, who of course sees himself as something of a go-between, something of an international peacemaker, has to tread very carefully in these increasing tensions between China and Japan. Of course, Japan also has had a lot to lose here if this escalates. China is a major trading partner, and Japan also depends on a lot of critical mineral exports from China that go to Japan. So it's a tricky geopolitical issue for Donald Trump. But I think for the rest of the world, for Europe, for example, it shows that his interest is not just on the issues of Russia and Ukraine in the Middle East, but also further afield in Asia.
Yeah, exactly. And of course, where you are in Brussels, we just had the Commerce Secretary and a delegation from the United States there as well. Can you bring us up to speed on talks between the US and the EU and where we're at on any kind of deal?
Well, look, there were no big takeaways, no big results from Monday's meeting between those EU trade ministers and those two top Trump officials. And it was significant that these officials were here in Brussels. That doesn't happen that often, that they come to these meetings. But Howard Lutnick, the Commerce Secretary, was very clear in his comments to Bloomberg News yesterday that he wants to see changes to the EU's digital regulation in order to move forward on any trade deal, particularly as regards steel and aluminium. Now, the EU's antitrust chief, Teresa Ribera, last night warned that EU tech regulation is not negotiable. And she has poured cold water on the idea, the prospect that the EU could change its tech regulations. So look, let's see where this goes next. What the Europeans really want is something on steel and aluminium. They are still facing 50% tariffs, but there are also other sectors that they want different treatment for, including wine and spirits, everything from Italian pasta to other exports. So those negotiations are going to continue at official level.
Suzanne, thank you so much. That is Suzanne Lynch there in Brussels. And Moscow and Ukraine trading airstrikes overnight as a US official was due to meet a Russian delegation in Abu Dhabi. This all as President Trump cites progress on his peace proposal. Let's bring in Bloomberg's Oliver Crook for more. So as I understand it, Oliver, the 28 plan was brought down to maybe an 18 or 19 point plan, but now even that potentially isn't going anywhere. Can you bring us up to speed?
Yeah, Vani, there's a lot of confusion about the different plans that have been circulating. There was one that was proposed by the Europeans, but what we understand now is that that 28-point plan that sort of dropped like a bombshell in the middle of last week here in Brussels and for Kyiv has now been reduced to a 19-point plan after those discussions in Geneva, those 24 hours of frenzied diplomacy between U.S. Secretary of State Marco Rubio and the Ukrainian delegation. Now it seems that that living document, that 19-point plan, is what is being shopped around the world right now. And we heard from Volodymyr Zelensky speaking last night, saying that after those Geneva talks that many of the right elements had been taken into account into that framework. Of course, the Russians, for their part, have sort of dismissed this 19-point plan out of hand. That being said, one of the sort of new protagonists in the negotiations, Dan Driscoll, the U.S. Army Secretary, is in the UAE today. We understand that he met with the Russian delegation yesterday, that those talks will continue again today to try to get them on side in terms of what they need to see from this document. Of course, Trump administration and President Trump himself would like to see a deal struck by Thursday. I think that that is probably a fairly ambitious, if not totally impossible, deadline to actually strike. That being said, crossing the wires about an hour ago, we heard from some Ukrainian officials that we understand that Volodymyr Zelensky, the president of Ukraine, will be heading to D.C. in the next couple of days before the end of November in order to speak with President Trump. Because we should say, Vani, one of the big differences between the 28-point plan and the 19-point plan is that many of the most contentious issues like territory and some of the other complicated political issues have been basically removed from the document because Zelensky wants to speak personally with Trump about those in person in the coming days.
Yeah, and Sergei Lavrov saying that Russia has seen neither plan and expects to see this new peace plan after the US agrees it with Europe. We'll see. Oliver, thank you so much. Oliver Crook there, Chief European Correspondent. Now to other top stories trending on the terminal this morning. UK bondholders are preparing for the government to release a tax and spend plan that could impact their returns. Chancellor Rachel Reeves is expected to announce measures to help meet debt targets in her budget speech tomorrow. A benchmark gilt portfolio has returned almost 4% so far this year, on course for the best performance since 2020. That China-Japan rift widening. The Chinese government has instructed the country's airlines to reduce the number of flights to Japan through March 2026. The order was made last week after Japanese Prime Minister Sanae Takaichi's comments on Taiwan inflamed China. And ABN AMRO's new CEO, Marguerite Berard, seeks to slash its workforce by nearly 20% in a major revamp. The net reduction of 5,200 full-time roles is anticipated to be completed over the next 3 years. Coming up, we'll bring you our exclusive interview with the CEO of State Street Investment Management. That's next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Investors awaiting a slew of economic data coming out in the next 2 days to gauge the potential for a Fed rate cut. Bloomberg's Katie Greifeld spoke exclusively with State Street Investment Management CEO Ye-Shen Hung on her outlook.
We still would very much like to see a 25 basis point cut from the Fed. We think inflation is more contained, even though maybe there's higher goods inflation. Services are softer in the housing residential sector. And at the same time, we're very worried about the employment picture. Unemployment has ticked up, hiring has slowed down, and consumer confidence is weaker. And so to really protect against this, we'd like to see the Fed take that 25 basis point cut. A little less clear as we move into 2026. We may be not calling for as much as 100 basis points, but somewhere in the neighborhood of 50 to 75 basis points makes sense to us.
I also want to talk about how investors are positioning amid all these different cross currents, because one of the most interesting stories to me, I think, of 2025 is still this red hot demand for cash. You take a look at money market funds, you take a look at cash like ETFs, the lines just keep going up, even though you do have the Fed starting to reduce interest rates here. And I wonder, first off, what you make of that and what will finally break the fever. Is it lower interest rates or is it something else?
Well, the need for income is very significant, and whether that's because of sort of developed economies, have aging populations that are looking at cash is providing multiple uses within a portfolio. It's generating income, it's dry powder should there be a major correction, and it also helps to diversify the overall portfolio. And for that reason, we think cash probably stays at these sorts of levels. May come down, but I think that might need some greater investment opportunity than perhaps investors see today.
It's interesting to hear you say that, because I talk to a lot of folks, a lot of investment professionals, and it's the most urgent question they have to answer is how do you get investors out of cash, get them off the sidelines, so to speak. But it sounds like you're saying this isn't necessarily the sidelines. That's not necessarily the way to be thinking about cash.
I think that's right. And what we're seeing is just a continuum of cash, if you will, right? Short-term deposits and money market funds to short duration and the like. And we do see some argument for extending maturity slightly in the short and intermediate term of the curve. At the moment, credit spreads are incredibly tight, investment grade and high yield. And so moving along that sort of treasury spectrum, we think is warranted. But again, it's not the same as a lot of cash moving into the market.
I want to talk about retail demand for private assets more generally, because you think about the turbulence that we've seen in the past couple weeks, of course, when it comes to private credit, when it comes to, for example, cockroaches and Blue Owl's pooled fund merger. Has that dampened at all retail enthusiasm to get access to some of these private strategies?
I think from where we sit, we continue to see investment discipline in the private credit arena. Defaults may be rising slightly, but from a very low base. And some of the big profile ones we think are more idiosyncratic. And at the same time, there's a secular long-term trend of the private markets providing credit capability and availability, given that the banks are more limited. And so the liquidity aspect, the income aspect of private credit, we see continuing to be in demand by retail investors. One area that we're focused on is in the defined contribution arena. We're one of the largest USDC managers, and we've been first to market to introduce a target date fund with a 10% allocation across private equity, private credit, and real estate. And we think it makes sense for individual investors to really participate in this part of the market that is showing tremendous value creation, yet they don't have easy access.
State Street Investment Management CEO Yetian Hung there speaking with Bloomberg. Coming up, one story making headlines across major newspapers. We look at the progress being made in the Russia-Ukraine peace talks. More on that next. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. Most major papers and news outlets leading with the latest on the Ukraine-Russia deal. CNN saying that talks are gaining momentum as US and Russian officials meet in Abu Dhabi. Now, the Wall Street Journal is looking at how the US drafted a Russia-friendly peace plan. The New York Times, leading with how Secretary of State Rubio tried to bring that plan to the middle ground. And the Washington Post is highlighting the grinding progress for Russia on the battlefield this year. Let's take a look at where markets stand now. Nvidia really weighing on this market. It's down 3.5% of the pre-market, and that's dragging on futures. As you can see, S&P futures, Dow futures, and Nasdaq futures, they're all pointed to a loss at the open, although we did see a gain for the Nasdaq 100 yesterday of 2.6%. A little weight to the Bloomberg Dollar Index, and the 10-year yield, now it is below 403. Of course, is there a December cut coming? Nick Timrose of the Wall Street Journal seems to think so, at least says the ground is being prepared. Mary Daly now on the side of a cut, it seems like, as well. Let's have a look at some other asset classes. The VIX has come down a lot since we saw those down sessions, but we are still well above 20 and just a little bit on the rise today, as you can see, with stocks lower. Bitcoin, very volatile in recent sessions, above 87,000, but it was below that just a little bit ago. And no real reaction in crude oil to those sanctions being put on Russia. 58.65 for WTI. Coming up, we're going to be pushing ahead to today's data and the Fed meeting with JP Morgan's Priya Misra. This is Bloomberg.
Our North Star is do the work. Keep your head down and do the work. There's always going to be speculation in our business. We're in a massive time of disruption, and everyone's going to constantly be saying, what's going to happen next? Who's going to be there? You can't focus on that. You have to focus on the work. And I think what's so exciting about Warner Brothers right now, even though it's an over 100-year-old company, we all approach it with like startup energy. So it's actually a really great time to be making movies.
Our teams are used to it because it's
this company's been bought and sold.
Yeah. Right. Yeah. Some of the inherited Warner people, understand this feeling. But when we started to work for David, one of his edicts to us is, challenge all assumptions. The business has to transform. It has to adapt to the moment we're in. And we talked about Moneyball a lot, because Billy Beane in that movie and in the book was all about adapt or die. The company right now has been battle tested and it has been challenging assumptions for 2 years. As far as the day-to-day, we're heading for that split. That's the course that David has charted. And people trust David because this whole slate strategy, this whole diversified slate, the label strategy, getting DC up on its feet, getting New Line pumping, getting animation, which comes online for us next year, pumping, we still think it's the winning strategy.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. A win for Alphabet. Meta reportedly in talks to spend billions on Google's AI chips as an alternative to Nvidia's GPUs. Moscow and Kyiv trading airstrikes this even as President Trump cites progress on his peace proposal and as US and Russian delegations are set to meet in Abu Dhabi. And markets eyeing a raft of data from September retail sales to November's Conference Board survey. This after a blistering tech rally. So let's take a look at those markets. Futures are pointed lower. We'll see if that changes in the next 4 hours, but certainly Nvidia weighing on the pre-market. It's down about 3.5%. And of course, this comes after yesterday's 2.6% gain for the Nasdaq 100 itself. So perhaps there's a little bit of give back. Let's take a look at bonds because we're going to be talking about them in a moment with Priya Misra. As you can see, we have had a little bit of movement. The 10-year yield is now down below 403, the 30-year down below 467, and the 2-year firmly at 348.32. Just a few more days to go before that December meeting. And of course, the blackout starts on Saturday. Let's get to Chloe Melly in London now for some individual movers to watch. Chloe.
Good morning, Bonnie. Let's start with the big story that's on everyone's mind today, which is the report that Meta is in talks to spend billions on Google's AI chips. And that is a big blow to Nvidia, which, of course, has the chips that have been the gold standard in that industry for both big companies, big tech companies and startups for quite some time. And we can see that reflected in those shares in pre-market trading today. This is a story that we'll be following throughout the day. Moving on to the latest addition to the S&P 500, which is the company SanDisk, which makes memory cards and USB sticks, and it is set to replace Interpublic, which is the ad agency in the S&P 500. That follows an impressive rally in the shares, which is continuing today. And finally, let's go over to Symbotic, which is a warehouse automation and robotics company. It counts Walmart as some of its biggest customer, and it provided a revenue forecast for the first quarter that was seen as very upbeat and definitely ahead of expectations. This is a big win for the company and also for that broader automation sector that has seen a little bit of a setback, including with the European peer Ocado, which has seen a little bit of weakness recently. And we are up 13% for Symbotic.
All right, a nice pop there for that company. Chloe, thank you so much. That's Chloe Melly. JP Morgan's Priya Misra weighing in on the data catch-up, saying that the absence of some raises the bar for a December rate cut. Still, she writes, quote, "We do think that a cut is more likely than not, since policy is still restrictive and risks are skewed to the downside." I'm pleased to say Priya joins us now and in studio. So Priya, we have, 10 days before the meeting. You're still thinking that a cut is more likely. Does the fact that Mary Daly has now weighed in and the fact that we get the Nick Timmeros article saying that the path has been sort of paved for Powell to cut, does that make it even more likely?
So I do think so. I mean, there is a lot of data that we're going to get today and, between now and the Fed meeting. So it's not a done deal. And there's clear divisions at the Fed. But I think if I take a step back, policy is still in the restrictive territory. Now, I think there's a lot of debate. The divisions at the Fed really come from what is neutral. And there are Fed officials who think it's closer to 4, in which case we're at neutral. And there are others that think it's 3 or a little lower. But if I look at the range, if that's the range of neutral, you're just at the upper end of neutral. So there is, a case to be made for policy is being a bit restrictive. And then you look at the labor market data, and I think that's what, Mary Daly's comments about the nonlinear slowing, it's something we've been concerned about. If the hiring pace is slowing and you're seeing a pickup in layoffs, and we are seeing some of that, we're not seeing it in claims yet, but we're seeing it in challenger, warn notices. I think the Fed really doesn't want it to become a non-linear slowing, because anytime these layoffs start, they can non-linearly increase a lot. And I think they're trying to provide some protection against that, some insurance against it. So I think just given the labor market slowing that we've seen, and even the new data that's coming, you saw the rise in the unemployment rate, almost 4.5 on the unemployment rate. I think the Fed would want to provide a little bit more insurance. And then I think Governor Waller's comments around meeting by meeting, I think that's what we're looking at next year, where if the economy does slow down more, the labor market slows down more, they'll cut a lot more. But I think provide this one more cut and then base it on data. And I think the Fed will get more reliable data only next year. So provide this one cut, then wait for that reliable data and played by ear.
Well, there is the argument out there that, you know, the difference between December and January is not that much. If it doesn't happen in December, it'll happen in January. But that's a 6-week gap because the FOMC meeting doesn't happen until the very end of January, at which point we might even be looking at another government showdown or what else have you. Would it make much of a difference to the economy if it had to wait 6 weeks for a cut and the labour market was getting more fragile?
Yeah, I mean, monetary policy works with a lag. So whether they go in December or Jan, even though it is 6 weeks, it may not matter as much. I think it's the messaging from December. So if they don't cut, but we get the press conference, we get the dot plot, and if in that the Fed suggests, and Chair Powell suggests that another cut is imminent, I think it really won't matter. If the messaging is that we're at neutral and we're worried about inflation or fiscal easing in the coming months, and the Fed might be done cutting, at that point, I think you are going to get rates moving, and that's going to, I think, filter through sentiment across markets. So it's more than just that rate cut. I think if they don't cut, they still signal cuts in the dot plot. So I think the market may take comfort in that.
Is there any concern for the current leadership that, sure, they've done an insurance cut, and yeah, maybe it would be nice to do another insurance cut, but given that the Fed is very likely to skew a lot more dovish next year, perhaps hold back on a cut, and then maybe the economy won't suffer too much if there are too many quote-unquote cuts next year?
That's a fair point, I think, but if you listen to Fed speak, I think the concerns around independence seem to be a little less. You know, the chair is extremely important. The chair will build consensus, and so the chair decision is really important. But we've heard from so many Fed officials with different views. And so I wonder if, I think there's clear divisions at the Fed around risk management and which is a bigger risk, inflation or the unemployment rate. But I think this is a message to any incoming Fed chair that they've got a committee with views, diverse views, a vocal committee that's not just saying what the chair wants. I actually think it's improving the idea of Fed independence. That you can get, even if you get a very political Fed chair who's skewing dovish, the rest of the committee might entirely take the other side. And it is a democracy, it is a committee at the Fed. Everyone has the same vote. So I actually think this whole debate, this very public debate from the Fed, whether inflation's a bigger risk or unemployment rate, actually makes the Fed look more independent, and it makes the Fed chair's job to bring consensus so that you don't have a 6-6 dissent type issue.
The bond market has been very well behaved, actually, through all of this, right? I mean, when you think about it, so sure, we've been moving a few basis points here and there, and the odds definitely have been moving way up from, just more than 30% to sort of 75% of a cut. But the 10-year yield is still in that range that you talked about, 375 to 425, right?
And we got a lot of pushback with that range because people were saying, why can't we get to 5%? Look at the deficit, sell America. Well, I think we're not seeing sell America. We have auctions every other week, and the auctions are going okay. So, yeah, great point that bonds have been extremely stable. I would also say bonds are doing what bonds should do. They're giving you income. There's a reason why it's called fixed income. They are giving you that coupon income, and they're acting as a diversifier. I mean, we saw this last week. You had these days where equities were struggling, bonds were acting as that diversifier in the portfolio. So I think one of the reasons why bonds have been so stable is people are seeing that diversifying aspect of bonds. And so when they are over-invested in equities or they get a little nervous about being too positioned too long there, they're buying bonds. So I think we are seeing that demand. High quality bonds, so I think investment grade, high quality, high yield treasuries are seeing that demand despite a lot of supply. There has been a lot of supply.
Are you seeing a lot more inflows? Are you getting a lot more, phone calls and questions since the AI bubble talk started?
We are seeing inflows. And I think it started even before that, and it's absolutely increased because people are seeing price action. I mean, you might have a view, but when the market confirms that view, it makes you feel better. And so we are absolutely seeing inflows, a lot of inflows from passive to active. And I think that makes sense because dispersion is picking up. I think this is not the time to be in passive anything because, this is not a case of the Fed's easing to dovish territory, all assets will go up. I think you're seeing that dispersion with company earnings, so whether it's equities or fixed income, but we're seeing passive to active. We're also seeing people saying, well, if the Fed's going to keep cutting cash, which felt really safe at 5% Fed funds, and now, you think, oh, well, maybe it's going to go to 3%. So we're also seeing money that was on the sidelines saying, you know what, let's extend out the curve because duration is less risky now, because inflation is less of a concern. I mean, we did get that CPI report, and all of the data suggests that inflation is slowly but surely getting to 2%. And inflation is the problem for bonds, but I think we are seeing the inflows from all sides.
And I know you're not expecting it to re-accelerate. Priya, thank you so much for coming into studio today. That is Priya Misra of JP Morgan Asset Management. Now to other top stories trending on the terminal this morning. President Trump still working on a proposal to address a spike in Obamacare health insurance premiums. The White House has not confirmed when the proposal will be unveiled. Treasury Secretary Scott Bessent had said it would be announced this week. Apollo CEO Mark Rowan has rejected the notion that adding private assets to retirement and insurance portfolios can pose a systemic risk. Rowan said, quote, "People have really just lost their minds and the headlines get more and more hysterical." Rowan told investors that most private credit held by insurers and pension fund buyers is rated investment grade. Michael Burry is standing by his criticism of Nvidia after the company pushed back on his analysis of its stock-based compensation dilution and stock buybacks. Nvidia and rival AMD have sparked concern among some investors by making so-called circular deals with AI providers. Coming up, trading attacks. Russia and Ukraine carry out airstrikes overnight, just as President Trump cites progress in a peace deal. More on that next. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Just hours after President Trump struck a positive tone on prospects for a ceasefire deal, Russia and Ukraine exchanged fire with heavy air raids on Kyiv and southern Russia. This as delegations from Washington and Moscow are set to meet in Abu Dhabi. Bloomberg's Suzanne Lynch joins us now. Suzanne, peace plans are being thrown around. Russia says it hasn't seen the first one, it hasn't seen the second one, and yet these airstrikes continue. Is there any hope to be placed in this particular peace process?
I think there is renewed relief around the world that the initial 28-point plan that was presented by the US has, it seems, been amended in some way, has been pared back, and is now reflecting more of the Ukraine perspective on this. I think it's fair to say that Ukraine and US international allies were taken aback by the content of this plan. And those talks that happened in Geneva on Sunday did appear to make progress. Now, as you heard there, Donald Trump himself is predicting that some progress will be made, but a lot will hinge on the Russian response to this revised plan, with that meeting taking place between a senior US official and Russian representative today in Abu Dhabi. But it does look for the moment that the initial Thanksgiving deadline for which Ukraine was under pressure to reach a deal has now been pushed back, and these talks will continue for some time.
Well, at least they're talking. I mean, in another theatre, there's talk as well, but it's just annoying everybody, apparently. China and Japan trading barbs. China's foreign ministry out this morning saying that the people's feelings were hurt. I mean, it's getting very emotional. But President Trump has spoken to both leaders and apparently had a good conversation with both leaders. Can he calm this spat?
This is an interesting moment for Donald Trump when it comes to Asia and his Asia policy. He is really trying to strike a balance here between two powers, China and Japan. Japan, obviously an important ally. Donald Trump wants to keep them on side. At the same time, he is looking to find some kind of a longer-term trade resolution with China, and is expected to meet Xi next April. So quite a delicate balancing act here for the US. Donald Trump, as we know, sees himself as something of an international peacemaker, but this escalating situation between Japan and China is yet another challenge, and one that has to be treated delicately.
Yeah. And then domestically, the president has decided to take on AI. He signed what he's called the Genesis mission to boost innovation with AI. How is this Genesis mission going to work, Suzanne?
Well, look, this executive order had been flagged for a few weeks by the administration, and really it is an effort by the Trump administration to federalize, if you like, AI policy, to try and bring these different operators or different regulatory systems and different investment ideas behind AI together, and to give more of a role to the federal government in terms of regulation. Look, Donald Trump is saying that this is akin to maybe the space race, that this is a big moment in terms of harnessing scientific, technological power and ensuring that the United States is on top when it comes to the AI race. Of course, the US is not alone in this. All countries around Europe, around the world, in Europe, Japan, we've just been speaking to, and of course China, are very aware of the opportunities offered by AI and are trying to get ahead in this race. So I do think this is an important marker by the US in trying to advance this. Let's see, does the investment go? Does the investment flow? And the regulatory system adapt to make this happen?
Suzanne, amazing context. Thank you so much for joining us today. That is Suzanne Lynch. And sticking with technology, Alibaba just out with its earnings revenue topping estimates thanks to AI and cloud growth. And you can see the ADRs there moving pre-market pretty nicely, up more than 4.5%. Bloomberg Tech Europe host Tom McKenzie is back with us. So how did Baba do it, Tom? Where did it exceed expectations?
Yeah, Vonnie, an interesting timing as we talk about those tensions between Japan and China and the moves by President Trump to secure the lead that the US currently has when it comes to AI, because Alibaba really is a litmus test in terms of how far and how effectively China is particularly pushing the adoption as well as the innovation around AI. So the top lines on revenue, yes, it was a beat. E-commerce was also a beat for Alibaba. This is a stock that's already up about 100% year to date, so it's had a massive run up. But the focus of scrutiny really is on how it is delivering on AI. And the key part of the business, because this is a multifaceted business, Alibaba, the key focus when it comes to AI is the cloud intelligence unit. And there you saw growth of 34% growth in terms of the cloud infrastructure bit, showing that demand from their end consumers and enterprises in China to ensure that they have access to those cloud offerings of Alibaba. So that is good news. We're also hearing from executives saying that they are going to be investing free cash flow into future innovation. So read into that AI. This is after 4 straight quarters where capex and spending on AI infrastructure, according to executives, came in at about 17 billion US dollars. This is a company as well that's had recent success with its own relaunched chatbot, with a lot of demand from Chinese consumers for that as well. So it seems to be Alibaba continues to be well positioned to lead domestically in China when it comes to the AI story, a company that has really reshaped and reformed its focus around AI innovation and getting it into all of its end products and users.
And of course, huge competition for Alibaba with Tencent and Baidu as well. And speaking of competition, here in the US, Alphabet is gaining because Meta is going to use its AI chips, its TPUs, as opposed to NVIDIA's GPUs. And NVIDIA is down more than 4% pre-market. Is this a harbinger of things to come, Tom?
Yeah, this is according to reports that this potential deal is being struck by, of course, Meta, a company that's one of the biggest hyperscaler spenders out there, with potentially up to 100 billion US dollars being spent next year just by Meta alone on this AI infrastructure. So the reporting suggesting that they have struck a deal with Alphabet to get access to those TPUs. It may not be that Alphabet actually ships the hardware, the chips, to Meta. It may be an infrastructure story similar to the kind of deal that we've had between Anthropic, of course, a key rival to OpenAI, which recently secured access to about 1 million of Alphabet's TPUs. These are the in-house built chips on which Google and Alphabet have been training their own Gemini model, as well as the inference as well. So it seems to be further evidence that customers and end users of these AI accelerators are looking to diversify away from NVIDIA, and hence the pressure on that stock.
All right, Tom, thank you so much. We'll see how everything trades throughout the session. That is Bloomberg's Tom McKenzie. Retail earnings also on deck this morning. We're going to hear from Best Buy, Kohl's and Dick's Sporting Goods, all before the market open. Let's get a preview now from Bloomberg's Maddie Parker. So, Maddie, we've seen how the consumer has been faring from some other big retailers. What about these ones? What can we expect from these big retailers?
Yeah, exactly. So if we look at Best Buy, that's obviously one of the big results coming out today. The good news for Best Buy is that we're finally seeing some signs of sales growth kind of emerge. We've had a very rocky 4 years, but in the last quarter they were able to reverse that, and we're expecting to see that momentum kind of continue. This is clearly one of the key back-to-school periods. This will benefit Dick's as well. So obviously people are buying laptops, they're buying tablets, they're buying sports equipment. So hopefully that will come through in some of these results. In terms of Kohl's, which is obviously another key result coming out today, things are looking a little bit more difficult. We are expected to see same-store sales decline. They reported declines for the first half of the year, but clearly it's been a difficult time for the brand. They've had a lot of CEO turnover. So I think these results will actually be more of an indicator in their case to their new CEO, who was appointed just yesterday, in terms of how they're going to navigate this time.
So as always, some idiosyncratic stories and then some stories about the US consumers. So how is the consumer looking as we head into the Thanksgiving and the broader holiday season? Still a K-shaped consumer?
Yeah, we sort of, the kind of story of the whole year has been a lot of, negative consumer sentiment. Clearly, there are big macro concerns that are hitting the consumer. Things like, very stubborn inflation and unemployment, and also things that retailers have been warning about for a long time, like how tariffs can impact prices. Having said that, there are definitely stories coming out lately that American consumers are actually likely to be spending more this Christmas than last Christmas. We think that people are actually a little bit more positive about their finances than we might think, and hopefully that will come through, in sales and kind of give some hope to retailers in this festive period.
All right, Maddie, it's going to be a busy day for you, but thank you so much for making time for us. That is Maddie Parker covering all your retail earnings. Well, coming up, we'll get you set up for your trading day with more of those earnings and lots of economic data on deck. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. Now, a look at what's ahead this Tuesday trading session. Huge consumer theme today. We're going to hear from several retailers, Best Buy, Kohl's, Dick's Sporting Goods, among them. But we also get September retail sales data out at 8:30 New York time. Maybe a little stale, but we do get the Conference Board Consumer Confidence Survey out at 10 a.m. Eastern, and that's for November. A few micro movers, as you can imagine. Google and Nvidia both moving on this report that Meta is going to use Google's AI chips instead of Nvidia's GPUs. Nvidia down 4%. That'll weigh on this market. And then SanDisk up 2.6%. It's up more than 500% already this year, and it's replacing Interpublic in the S&P 500. Take a look at the macro picture for your Tuesday session. Futures pointed just a little bit lower, though well off their lows, and the 10-year yield at 4.03. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
The aim here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The reality is the fundamentals are still sound.
I don't think we have yet seen the real bubble trade in AI.
The market's done a little bit of work here to take some of the froth out.
I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
We think there's a broadening out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks taking a breather after the biggest two-day gain since May, with investors looking out for retail earnings and data later this morning. President Trump lowering the temperature even further with China, with plans to visit that nation in April. And Alphabet exerting a new influence over the Magnificent Seven, with futures surging on reports that they're posing some competition, Danny, to NVIDIA.
I just want to extend my sympathies for everyone like us who have had to all of a sudden do a deep dive on TPUs versus GPUs. But that is the place we're in. There's some real churn underneath the surface of tech of who is the winner of AI. The market still hasn't fully decided that. The price action, I think, will be interesting today. Can you continue to get a rebound if NVIDIA isn't playing along, even if we've decided, at least for now, the new winner is Alphabet?
Yeah, can you get a dispersion in the Magnificent Seven, in the big tech space, and not have an overall market rollover? This is the key question. We saw this yesterday when there were questions about OpenAI and Google once again posing real competition to the entire model with more profitability. And now a real question of whether they could supersede, maybe not NVIDIA, but clearly the other Magnificent Seven. It's clearly right now number 3 in terms of market capitalization, very much on course for $4 trillion.
And it's added so much to the S&P 500, just given the rally we've seen over the past month. So does it mean that we have all of a sudden have chips that are more energy efficient, that have better use cases, not as broad, but more efficient at doing the task at hand than NVIDIA? The problem with that is that NVIDIA has created this really complex web. So it's not just NVIDIA that suffers, it's Microsoft, it's SoftBank whose shares are getting killed today. OpenAI maybe has a problem, Anthropic has a problem. Just these interrelationships mean that it's bigger than just one company specific.
This is clearly an area that is rife for some sort of disruption, which is very clear to a lot of people, increasingly so as we see some of this price action. We'll get into your studies on GPUs versus TPUs, because you'll whip out your PowerPoint presentation, and I'm sure everyone will actually be really interested in it. We do get a bunch of retail earnings this morning, and I think it's interesting. Before the market opens, we get Burlington, Kohl's, Best Buy, Dick's Sporting Goods, Abercrombie & Fitch. After the bell, we get Urban Outfitters. To get these earning reports in the kickoff season of the holidays really creates some possible visibility into consumer appetite.
Because I think there are now some serious questions being asked about the consumer. There are being more cautious things put out there. BMO, for example, did a survey of 1,000 consumers, and they say that holiday spending will be more modest this year. There was also a report on Carnival from Barclays yesterday that said we went and we surveyed the management, and they also seem more cautious. Cruise lines have been these things that people have pointed to, saying, look how good the consumer is. What happens if that's starting to soften?
Yeah, and yesterday you did see about half of the S&P 500 stocks not participate in the best two-day rally going back to May, including Carnival shares, to exactly that point, because of this fear around the consumer. Later this morning, we also do get retail sales data coming out for September. Some interesting Fed speak over the past 24 hours. Mary Daly lining up very squarely in the camp of Chris Waller and potentially John Williams to cut rates. She's not a voting member, but she has never departed from what Fed Chair Jay Powell has ultimately voted with. And it really is signaling to markets, guess what? They're going to cut.
And this is what it's come to, right? Of reading tea leaves, trying to figure out which way Jay Powell leans, because we haven't heard from the man himself. And just given how divided the Fed is, the thinking goes is that Jay Powell will have the ability to sway to cut or not to cut. And to your point, because Mary Daly is so aligned with Chair Powell, we're looking to her for direction.
So right now we're looking for direction in equities. You are seeing a bit of a bounce back from earlier lows, still off though, still lower. Down about 0.1% on the S&P futures. You are seeing yields just marginally creeping higher on the long end. Yesterday, we did see an auction that did tail 10-year yields 4.03%, still lower than where we were yesterday. And crude off just about 0.33%. Coming up this hour, Peter Shear of Academy Securities with stocks coming off their best day in 6 weeks. Ed Al-Husseini of Columbia Threadneedle on why AI may not have the impact on economic productivity that so many people think. And former senior White House trade advisor Kellyanne Shaw with fresh talks between the U.S. and China. We begin this hour with stocks edging lower as investors count down to retail earnings as well as data. Peter Shear of Academy Securities writing, the end of free money has been a major factor in the recent downturn and could weigh on the economy and markets going forward. I think the economy is at a greater risk than we've seen in some time. Peter joins us now. Peter, great to see you.
Good to see you, too.
This seems to be echoing what we heard from Neil Dutta yesterday of Renaissance Macro, where he said that he thinks the train may have already left the station when it comes to Fed rate cuts and the potential damage that has been foisted upon the economy. Why are you so negative as well?
So what I'm seeing, I think, is what we're calling the end of free money, and kind of being a bit cavalier about that. But there was a time, right, if you announced you were spending X billion on data centers or AI, your stock went up 2X. And all of a sudden, now you're seeing people question that. You're seeing stories emerge about, ooh, which technology should we use? So I think we're going through this breather, right? A year ago at this time, if you didn't have an AI strategy, you were ridiculed as a CEO. Your stock was going to suffer. So there was spend, spend, spend. There was this kind of real rush to spend, spend, spend. Now I think everyone's sitting back, okay, what do we want to spend on? What is the best value? And the hyperscalers, right? All of a sudden, you can't just say you're going to build more and your stock goes up. So this is kind of this first time I think we might see a bit of an AI diet where people are like, okay, how do we be cautious on this? Where do we spend? What do we spend on? What technology is emerging? We haven't talked about anything out of China yet that could derail some of our stocks. So I think this is where we get a bit of a slowdown right now.
Before we get into the details of the AI trade, you said the end of free money. And I want to dive into that because yesterday we were talking about tightening liquidity conditions. Now, a lot of people attributed that to the sell-off that we saw in things like Bitcoin and also the big tech names. Why is this now the end of free money with the Federal Reserve cutting rates and ending quantitative tightening?
Well, you've also seen, coming back to some of the crypto, you had the DACCOs, or the digital asset treasury companies. Some are very sophisticated, some do a lot of things, some simply buy the underlying. And there was a period of time, right? If you bought X amount of Ether, your stock went up 2X. All of a sudden, that's not happening. So all these trades that were kind of self-perpetuating are falling down, and you're having a bit less liquidity come through this. And everything I hear and see when we're talking, whether it's consumers, corporate, I feel there's belt tightening going on everywhere. I think people are going to be a little bit surprised as they go through the budgeting process that companies are actually shrinking their budgets rather than growing, full scale.
What do you think the administration does in this? Because we were speaking with the Commerce Secretary yesterday who was beating the drum saying AI has been such a boon for our economy. David Sachs, the crypto czar, which also has an ear to the administration, was putting on X yesterday that it is an AI-related investment accounts that half of GDP and a reversal would risk recession. Is this an administration that would see this sector as too big to fail, as Sam Altman has hinted at to the chagrin of others at OpenAI?
What I think they are doing, I think it's rightfully to do, is investing heavily in electricity and energy production, right? We are putting money into nuclear, we're putting money into everything that's really the bottleneck right now is this electricity. And supposedly that's one of the arguments with the TPUs versus the GPUs is lower electricity usage. So I think electricity is actually a bottleneck. I see the government spending a lot of time on that, which fits very much, I know you're sick of hearing it, but production for security or PROSEC. I think they are trying to figure out I think these are the things that the government's trying to make sure goes along. I think it's going to be hard for them to intervene directly in AI, but yes, if we get this AI slowdown, unless other parts of the economy really pick up, we are going to see this potential, maybe not a recession, but a slowdown, and that's why I'm concerned.
How does the wealth effect play into that? Lisa's been talking about how just more of everyday people, of households own equities at this point, and a lot of the gains in equities have been tied to AI. If AI starts to take a breather, what overall wealth effect does that come back and have on the consumer?
Well, I think we've already seen a big hit to crypto, right? Bitcoin itself is down $650 billion, and it seems to track very well. I always use ARKK as a proxy for disruptive, stocks. Those stocks are down. So you've kind of seen this big move in certain segments of the market. Almost anything momentum related is down. So I think you've already seen a chunk of wealth wiped out for people who would spend that money. So I think we need to see this turnaround, or you're going to see everyone, hey, maybe we got to be a little bit cautious, right? We are kind of, everything's going to the moon. Crypto's going to 200,000, whatever the number is. All of a sudden, you're sitting here at 86,000 on Bitcoin. I think it does create this negative wealth effect where people are going to be conservative coming into their spending.
So there are three ways to look at this. There's one way to look at it saying, okay, this is going to be a recession next year that no one's expecting, which is typically how it happens, which is what we heard from Neil Dutta. Then there's a way of saying that actually there's going to be a rebound early next year because of the tax refunds and other types of stimulative effort, but that there will be sort of this flagging growth. And then the third way of looking at this is it is going to be morally hazardous for either this administration or the Federal Reserve to allow this market to crater. So you're going to see this bazooka of stimulus coming from quantitative easing, from Fed rate cuts, and from fiscal that will ultimately propel this market higher. Where do you fall in?
I do think coming into the midterm elections, we are going to see a huge effort. I think Trump and Trump 1.0 learned the pain. If you don't win the midterms, it's really hard to govern your next 2 years. So I expect a lot of stimulus coming into that. And I have liked, for example, my favorite trade right now has been to be underweight NASDAQ 100, so QQQ in ETF form. And I like the S&P 500 equal weight. So RSP is one, ETF that you can use for that. And I think you're going to get this bit of a rebalancing, right? Some of the air is going to leak out of the AI. Some of it should be transferring to the rest of the economy. And that's why I like kind of the equal weighted S&P 500. I think as we take away investor focus from the AI to electricity, which is still going to be a part of this, but what else is going on in the economy? What else are we building? What are we making? We are going to be trying to build manufacturing plants. We're going to be trying to build mines. We're going to be trying to build refining and processing companies. So there will be activity, and I think that's the area that's going to shine next year.
If you are defensive, can you go into long-term bonds with the expectation that this is an incentivized Federal Reserve to ultimately bring down long-term costs in whatever type of financial engineering it requires?
Normally, I would say yes, but I'm kind of stuck more on the belly of the curve, 5 to 7 years. I just think there's going to be some outward pressure on the 10s and beyond as people are nervous. Did we cut too much? Are we being too aggressive? Are we paying attention to inflation? So I think that's going to diminish a bit of the rally there. So I kind of like the belly of the curve. I think you're going to see 2-10 spreads actually go potentially to 100. So I could see us down at 3% on Fed funds, and I could still see a 10-year close to 4%.
Are you getting those vibes from the Fed that they are going to be forceful in their cuts? We heard from Chris Waller yesterday saying yes, December, and then it's meeting by meeting.
I'll be slightly embarrassingly honest. I'm not really paying that much attention. I think we are going to get a new administration. The Fed's going to look very different next year. We're going to get to 3% before the middle of the summer. I don't really care whether it's a cut in December or not. That's kind of my base case, right? This is the direction we're headed. It's going to come almost hell or high water. So that's kind of how I'm thinking about it. I'm spending less attention to who's talking today and tomorrow. Look who's going to be talking in the future. We know we're getting these cuts next year.
I love it. It tells you something, Danny, when Peter Scheer is not keeping track of each Fed speaker. Maybe they have no clue, and it's completely divided.
Also a great way to preserve your sanity, I think.
100%. So congratulations for being sane. Peter Scheer, the sane one, is going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Good morning, Lisa. Fighting between Russia and Ukraine continuing overnight with heavy Russian drone and missile attacks on Kyiv and Ukrainian assaults on southern Russia. The exchange is coming after President Trump suggested, quote, big progress was being made on a deal to end the fighting following weekend talks in Geneva. White House Press Secretary Caroline Leavitt says he still hopes the deal can get done by Thanksgiving. President Trump and his Chinese counterpart Xi Jinping held their first talk since agreeing last month to a tariff truce. Trump says the call was very good and touched on issues such as trade and Ukraine. He also says he will visit Beijing in April and that he invited Xi for a state visit next year. Shares of Google parent Alphabet rising in the pre-market on reports Meta is in talks to spend billions of dollars on the search giant's AI chips. The information reporting Meta plans to use Google's Tensor processing units, or TPUs, in data centers from 2027. An agreement would help establish TPUs as an alternative to NVIDIA's GPU chips. That's your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. All right, this is the time. Just 5 minutes.
Oh, wow.
5
okay.
seconds.
Thank you. I'm so
GPU
honored.
versus TPU.
Okay.
30
GPU
seconds.
NVIDIA's chip, originally for graphics processing, so it takes a lot of energy and has a lot of broad applications. TPU, built by Google, very application specific, so more efficient, maybe a better chip, but people are already using a lot of NVIDIA chips, and there's a kind of locked-in thing to it, so it's hard to get to the other one.
This is the debate. More energy efficient, although more restrictive, or potentially more expensive, energy intensive, but flexible. The race is on. Up next, we're going to be talking about lowering the temperature with China.
It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction.
Bloomberg's Michael Solner joins us next. This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Stocks just kind of meandering here, dipping just a touch after yesterday's surge, the biggest in 6 weeks for the S&P 500, the biggest two-day rally for the S&P and NASDAQ going back to May. Today, taking a little heat out of that, down about 0.1% for S&P futures, seeing yields just up marginally, but still lower than they were to start yesterday, 4.03%. Meanwhile, take a look at NVIDIA and Google, Alphabet in pre-market trading. A huge dispersion here in the fates of the two, and they're connected with Alphabet shares up 4.1% in pre-market trading. NVIDIA lower by 3.6%. On that news that Alphabet might be gaining some clout in the TPU game. We'll get into that coming up. Under surveillance this morning, lowering the temperature with China.
I did speak with him about the call. It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction. And the president and President Xi discussed continuing to stay in correspondence.
Here's the latest. President Trump saying his call with Chinese President Xi went well. The two leaders now planning in-person meetings next year. Bloomberg's Mika Solner joins us now. Mika, what was the understanding of what was discussed in that hour-long phone call between Xi and Trump?
Yeah, so the president and the Chinese president spoke for roughly an hour, largely focused on trade and trade negotiations, particularly around soybeans and how, you know, China is impacting U.S. farmers as well. So that was a large focus of the call. But the two also touched on Ukraine-Russia war briefly. But I know that, you know, there's been significant steps taken with the two promising to see each other in person next year.
Mika, the two readouts, whether it was from China or from the U.S., were vastly different. The one from the U.S. was talking about trade as well as a little smattering of Ukraine, Russia. The one from China really focused on Taiwan. Can you talk a little bit about that huge difference between the two readouts?
Yeah, I think that's really interesting, and I do think that there's going to be tension around Taiwan. I know that that's a big priority for the administration, but I also think that President Trump really wants to have a good relationship with China. I think that it's really different from previous administrations in the way that he negotiates with countries considered to be U.S. adversarial to the U.S. So there's going to be a lot going on and a lot of reaction from China hawks as well in terms of what's going to happen, particularly around Taiwan.
Mika Solner of Bloomberg, thank you so much for that. Peter Shear of Academy Securities is still with us. Mr. Prosek, let's put that hat on, because ultimately this really does go down to what is your takeaway? Does this have more consequences potentially for Ukraine, Russia, or potentially for Taiwan?
I think probably more for Taiwan. So when we're looking at this, and again, I work with 30 retired generals and admirals, a couple CIA people, so we spend a lot of time on where this is all playing out. And I think as we're having conversation with clients, we're reminding, one, Xi said he wants his military to be ready by 2027. It's not a sign that he's going to do anything in 2027. But we've always thought what's going to happen is there's going to be a multiple application of the levers of power. So the levers of power are diplomacy, information, military, and economics, so the DIME framework. I think they're going to put so much pressure on Taiwan that Taiwan may eventually just say enough's enough. And we are seeing the U.S. pivot a little bit away from the kind of this global, policeman of the world to really focused on domestic, right? North-south, the Monroe Doctrine seems to be taking place again, right? We moved the Ford into the aircraft carrier into the Caribbean. So there's this big domestic focus. So I think there is some risk that Taiwan feels a little bit maybe left out, a little bit nervous. And when we look at trade negotiations right now, the two things that I think China has some power over us are still the processed and refined rare earths and critical minerals. So on PROSAC, I think we are trying to do a lot of that. I am convinced that this administration, from some talks as well, one, we want to produce the rare earths and critical minerals, but really we want to make sure we can process and refine them to break that lock that China has on us. We control the chips. We control the best quality chips. Again, maybe now we throw the TPUs into that. Those are things China wants. At the same time, China controls a little bit the ability for Taiwan to ship things. So far, China has not done anything, but they do have this very, very large maritime militia. They've used it in the past in little incidents, but they could put this to work. It's largely shipping vessels. They have larger vessels within that, and they would just disperse themselves in such a way that it would slow shipping down. They would throw logs off back. They would throw nets trying to foul propellers. So they could do a lot if they really wanted to push on us against Taiwan. So I don't know where this is all headed, but it feels a little bit parcel and parcel where we're focusing a little bit more north-south, Monroe Doctrine, and maybe China has a little bit more control in that region.
Where does that leave someone like Japan, who has been leading on the U.S. alliance in their current heightened tensions with China after the prime minister made those off-the-cuff remarks that they would support or take action if China had military action against Taiwan?
I think it leaves everyone a little bit questioning, what is our mission, right? The Biden administration was very clear that we would support Taiwan. Trump has not been clear so far. And our official doctrine before Biden had always been ambiguity, right? So strategic ambiguity has been a part of this. The one thing, to me, it comes back, and we've been talking to clients about this for 4 years, and people used to kind of roll their eyes at us, and now I think they're listening, is shipping. You have to diversify your supply chains along shipping routes. You cannot be dependent on one shipping lane. So Thailand and Vietnam, you're not diversified. They're going through the same place, maybe even South Korea. So I think this is a kind of a huge wake-up call that everyone has to look at shipping as a bigger risk than we ever have in the past and say, hey, what happens if, and maybe it never happens, maybe we go on living peacefully and we have these great economic deals that allow it. I think we have to prepare for more and more deglobalization and more risk.
That's so interesting you say that, because I've had conversations with private equity executives who have companies, lots of them that need to deal with supply chain issues. And they've said, we've done such a good job since Trump came in as president because we've de-risked from China. And now we're in South Asia. To your point, we're in Vietnam. We're in these places that still might feel blowback should there be a larger scale conflict. Are there other options? Is the supply chain resilient enough to completely move away from that region, even if it's not China?
No, but I think you can diversify. You can have some there. You can have some other reasons, because you are going to want to try and sell into that region, right? India is a huge growth story. There's all sorts of opportunities. So you want to be there, but I think you want to look at South and Central America. What's going on there, right? Whatever happens, how do we do better with Brazil? So far, Brazil's been tough. We are working closely, I think, with Argentina. So I think there's going to be a lot of opportunities in that north-south. And again, keep coming back, and lots of things I've learned not being military, but, they talk about at Academy Securities the tyranny of distance. So in war, it is really hard to fight a war if you're far away. If you look at where Guam is relative to Taipei or Taiwan, it is a very far distance. It's going to be hard for us even when we try and do something to support that relative to what China. They have the same problem when you look at Central and South America. And let's not forget, the first place Marco Rubio went was the Panama Canal. That has never really happened in our history, right? The Secretary of Defense, Secretary almost always goes to the UK. He went to the Panama Canal. So there is something shifting in this administration. So I would pay close attention to that. And if you want to be where the U.S. government's going to protect you and do the most, I think it's pretty clear to me you want to be edging or favoring North and Central and South America over Asia.
5 years ago, when the pandemic was raging, everyone was talking about the deglobalization and this idea that you had to build in sort of inefficiency in your supply chain to create redundancies. It was going to be inflationary. Now we're not talking about inflation. We're talking about disinflation from artificial intelligence, even as we see an acceleration of this trend of being more regional. Is there still an inflationary overlay to this that's the reverse of what globalization provided?
I think there is as it comes online. There is going to be some pressure on commodity prices. If we really start building these factories, if we build out the energy production that we need or electricity production, we are going to see levels of inflation that have been higher. I think it's persistent, say that 2.5% to 3.5%. It's not going to get out of control. But over time, we've also built a much more secure system. I think costs will go down over time, right? If you're not shipping things long ways. Again, I just keep coming back to, I really believe this kind of concept of production for security is going to replace kind of ESG. When we're thinking about sustainability, it's going to be much more like, what do we need at the base? And this is going to sound wonky, but I look at Maslow's hierarchy of needs. I always think that's probably the most useful course I took was Psych 101. But it talks about you basically need shelter, you need food, and all those things before you can move up to self-actualization. And we are kind of at the self-actualization. What we would like, I'd love to do this, I'd like to do these things. And then we realized we had our base eroded. We cannot produce the things that we need. How can you be safe or sustainable if you're not making some level of your basic necessities? So I think that's where we are headed. I think the government's the first to see it. I think capital is already starting to flow into it. So capital is going to be second. Corporations are going to adopt it. And I think Europe's going to start following. I think Europe's going to fight it a bit more tooth and nail. But ultimately, they're going to get dragged into this where you have to produce your basic necessities or some portion of it yourself and work with close allies because you cannot just rely on China to be your friend.
Peter Scheer, thank you so much for being with us. Always really illuminating. Peter Scheer of Academy Securities, and this kind of goes to the heart of the issue. I remember a year ago when APEC was being held in Peru, and there was a real question over who is going to win the war right now. Is it going to be China or is it going to be the United States for one of the most important reserves of copper, of pretty much a ton of minerals that are absolutely essential to our modern world?
I remember when you were there, and the reporting you did was China is so present at this conference. They're present there. They're present in Africa. What does the U.S. do about that? To Peter's point, as they increase their reliance on those beneath us to the south of us.
There were Chinese flags. Xi came. He was going down the boulevard. Everything stopped. Real difference in tone. Coming up, we're going to be talking more about the emerging markets as well as artificial intelligence with Ed Al-Husseini of Columbia Threadneedle, who thinks that maybe AI productivity gains are overstated.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
We are heading into the open about 3 hours away. Right now, what we see in the morning futures is lower across the board after the biggest one-day gain going back 6 weeks. NASDAQ leading the charge lower, down 0.3% despite the gains that we're seeing on the likes of Alphabet. What you are seeing yesterday was the biggest two-day pop for both the S&P and NASDAQ going back to May. Optimism around potentially Fed rate cuts. Take a look at 2s, 10s, and 30s. You do see a bit of that optimism fading, but definitely below where they were yesterday. 2-year yields getting a bid after we heard from Mary Daly that she was inclined to cut rates next month. She is not a voting member. Nonetheless, she tends to work with Jay Powell and tends to agree with him. John Williams also on deck for a cut. I am the one who's actually watching, Danny, and counting each of these. It looks like it's pretty evenly split right now with a lot of undecideds, and a lot of people are saying this is up to Jay Powell to decide whether or not this is a Fed cut or a Fed hold.
Which is why Mary Daly was so important, because to your point, she's very closely aligned with him. It's a very different environment. We've moved away from consensus building. And I also think interesting in that Mary Daly article, interview with the Journal, was she said, this is a good thing. This is a healthy thing. You don't want groupthink. The question will be whether that protects the Fed or exposes them in an era where you have a Trump pick at the top of the helm.
Yeah, and whether it gives any kind of guidance at a time where the guidance aspect is very much part of monetary policy transmission, which is a key question. Right now, we are 3 hours away from the cash open. Let's get some morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, it is all about AI today, so let's take a look at these companies because you've been talking about it already this morning, TPUs versus GPUs. Remember, NVIDIA was great at making those graphics processing units. Well, now Meta is in talks, apparently, according to the information, to buy billions of dollars worth of TPUs from Google, the Alphabet company. Obviously, that could have an impact on NVIDIA going forward. Now, is this the very, very beginning of maybe what looks like the end of dominance for NVIDIA? Maybe, we'll see. But the shares are definitely suffering. Pre-market down 4%. AMD also along with it down 3.5%. And the Google parent up more than 4%. Let's switch it up because we are now looking at Alibaba. Just reporting this morning, we were talking about Qwen yesterday and the relaunch of all of its AI tools and its push into that. Its rivalry with Tencent and with Baidu, well, paying off apparently in the quarter. The ADR is up 4.5%. Overall revenue was up 5%, but its cloud intelligence revenue up 34%. Massive growth in that revenue in the quarter. And then let's take a look at SanDisk because you mightn't think of it. It's a memory chip company. We all remember carrying around those thumb drives and so on. But this is also really an AI story. This was bought by Western Digital back in 2016, spun out this February, up 530% year to date since it was spun out, up another 2% because it is now joining the S&P 500, and that's been giving the shares a boost. But obviously, there has to be an AI portion to this. It's in talks for the build out of large-scale data centers as well. So that's helping this memory chip maker today.
Thank you so much, Vonnie. On our radar this morning, tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back calls with the leaders of both countries. Any sign of the U.S. aligning with Japan could end up derailing its trade truce with China. Meanwhile, NVIDIA under pressure following a report that Meta is in talks to spend billions on Google's AI chips, millions, billions, trillions. The information reporting Meta plans to use Google's tensor processing units in data centers beginning in 2027. And real quick, TPU versus GPU, Danny, it is...
I wish I brought my PowerPoint with me.
Yeah.
Okay, TPU is Google's chips. They're specifically designed to do the tasks of Google's cloud, so they're very efficient, both in terms of ability to get work done and energy, versus NVIDIA's GPUs, which were originally built as graphics processors, so they do more tasks, but a little bit more clunky, take up more energy. So you could say Google's better. The issue is there's a lot of locked-in syndrome. It's really hard to change cloud providers because so many people already use those types of data centers with NVIDIA chips. It makes it harder to transfer to Google.
There is this 1-2 punch, and it comes to something we were discussing yesterday with OpenAI and this question of whether Google could potentially supersede it in terms of Gemini 3 and some of its capabilities. This next story about NVIDIA versus Google and the idea of Google selling chips to Meta just reiterates this feeling of disruption and this ongoing sense that the story that we're seeing right now in AI is not the full story. It is not the end of the story. This is just the beginning, and we're not really seeing the full iteration.
And it's still a market, you'd have to argue, that hasn't decided who the winner is. You could do the Dan Ives thing. He's just put out a note with his top AI picks. It's kind of literally all of them. So that is one bet and one way you could do it. But if anything, it's a market that is more discerning. And again, I think Alphabet coming in as a challenger is so interesting because they have so many corporate relationships. They have better brand power than OpenAI does. So who's to say, if they can get people to switch over, that they're not going to be the ultimate winner?
Yeah, and just to add on to this, SoftBank shares tumbling to a 2.5-month low, with investor concerns really coming out after OpenAI with respect to potentially Alphabet's Gemini 3 superseding OpenAI, which is part of the reason why people are wondering, what is this iteration going to look like? Let's stick with AI. Ed Al-Husseini of Columbia Threadneedle casting doubt on the so-called productivity boom, writing, AI will lead to an acceleration in automation, which has been a central feature of economic growth. AI will have no impact on aggregate economic productivity. Ed joins us now with that bold statement. Ed, why do you think that that's the case, given the fact that so many people are saying that is when this will start to pay off? That is when this will be disinflationary and not necessarily just the investment in nuts and bolts in the physical world?
Yeah, absolutely. Look, we've seen these waves before. The point I wanted to make is it's really difficult to translate technological innovation, which we've seen pretty much continuously over the course of the past 40 years, into aggregate economic productivity. That's extraordinarily difficult. It really requires us to reorganize how we make economic widgets.
So at this point, you're saying that there are implications for the fixed income world in terms of the ultimate payoff, right? Because it comes to not only the corporate debt market that's been fueling and funding a lot of this, but also it goes down to the expected inflation rate and just what kind of growth you can see on the heels of AI. So where do you think the biggest misunderstanding really is right now?
Yeah, I mean, part of the problem is we're channeling an extraordinary amount of savings now into the AI thematic. It's going to cannibalize to some extent the capital that's available to other parts of the economy, including the treasury market. We're in the early stages of this. The AI theme has just come to the investment grade market wholesale. It will be with us for a number of years, no doubt. But one of the risks is it starts to lift yields across the board and starts to make the cost of capital more expensive for other companies. That ultimately could be a drag on growth down the line.
This is a real crowding out, because not only in capital, but in manufacturing capacity, the way that energy is used too. So wouldn't that be a healthy thing if all of a sudden we've decided we've gone too far and AI backs up and the spending on AI backs up? Does that open up other parts of the economy to make use of this capital, make use of the energy, make use of America's manufacturing capacity?
Yeah, eventually that could very well be the story. We've seen this happen in other parts of the world. China is a fantastic example of this. It's gone too far. We're now seeing deflation, outright deflation, because of that capacity in China. It's very early in the story, but one of the risks is we've invested an extraordinary amount of capital, some starting with a T at this point, in the AI thematic, and some of that capital either depreciates rapidly or is stranded and doesn't contribute to economic growth.
What happens to private asset players who've all started to pour money in this? A lot of the conversation there is, we're not taking AI risk, we're taking meta risk, we're taking Oracle credit risk. If what you're talking about, that corporate bond markets also start to feel some of the pain, what does that do to this entire ecosystem of funding?
Yeah, it's quite vulnerable. Let me say this. The good news is we're starting with corporate balance sheets that are extraordinarily strong. These are high quality, high grade issuers. The corporate bond market, particularly the investment grade market, was practically invented for this. It's there to fund these themes. So it's going to be a while until we get to a point where it starts to degrade and we see whether it has an impact on earnings. But the fact that the story is so deeply interconnected is definitely a vulnerability. That's not a new theme, but it's going to be with us for some time.
So how much of a liability do you think this is for the Treasury market?
A little bit. And again, the good news is we're sort of focused on the narcissism of small differences. What is the Fed going to do in a couple of weeks? The AI theme doesn't affect that in any meaningful way. One of the core questions for the Fed in the next couple of years is, should we assume, the way Greenspan did in the mid-90s, that productivity is rising? That's a license to keep monetary policy tighter than it would have been otherwise. If they make a mistake, and look, Greenspan got lucky and he got it right, but if we make a mistake, that leads to lower growth, that leads to tighter policy, that leads to lower inflation in the coming years. And that's going to be a really, really interesting debate in both 2026 and beyond.
If this does lead to greater weakness and potentially overly tight financial conditions, at least for the rest of America or the rest of corporate America that hasn't experienced the AI boom, are you expecting this to be essentially disinflationary for the wrong reasons, right? The idea that it could actually slow growth and end up in a situation where the corporate debt issuance really suffers because the growth just isn't there to really fuel the returns and the profits in an ongoing way?
Yeah, let me start with the second part of the question. So if productivity does not materialize, or in other words, productivity is very concentrated in parts of the economy that potentially deliver earnings to these companies, it's fine. If productivity becomes more diffuse and the economy as a whole starts to lift, that's a license for, again, higher interest rates across the board. That's a license for a healthier growth story. That's something we saw in the mid-90s through the mid-2000s. Great outcomes in terms of inflation, fiscal, interest rate stability, and so on. The challenge for the Fed is, again, if we make the wrong assumption in the short term and we put that higher productivity story into our strategy at the moment, you could make a much stronger case for tighter policy, and that would be a mistake at this stage.
So if that's the case, what's your highest conviction right now heading into year-end, into 2026?
With respect to interest rates, look, I think we have a starting level of real yields, inflation-adjusted yields across the board that are still quite healthy. At the same time, when you look at the corporate debt market, where we're financing and underwriting this AI story, corporate spreads are extraordinarily tight. There's a lot more room for those spreads to widen, and there's a lot more room for real interest rate, inflation-adjusted yields to come down in the course of the next 12 to 18 months.
What would it take for spreads to widen, though? Because this is a market that's flush with cash, looking to put it to work. And it feels like every single auction, every single debt issuance, that there is so much demand that spreads, even when they widen, are widening to, like, I don't know, 70 basis, like nothing crazy still, even when you do see widening.
Absolutely. And the appropriate answer is, I have no idea. All I know is, at the moment, investors are not being compensated for a lot of the risks that they are taking, particularly in weaker balance sheets. How quickly those balance sheets degrade ultimately is going to be the key part of that narrative for next year. And then most importantly, we need a shock to our beliefs. That's what always happens. There are deep stories that are embedded in the way we price these spreads. There are deep stories around the AI thematic, for example, that are being embedded in how we price assets in the economy. Shocks to stories like that ultimately are what reorient credit spreads.
I think that we've had enough shocks for this year, but we could have more, and that's what Al Husseini of Columbia Threadneedle is laying at. And thank you so much for being with us. Have a wonderful Thanksgiving. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief, the Vonnie Quinn. Vonnie.
Lisa, thank you. UK Chancellor Rachel Reeves is getting ready to deliver her autumn budget tomorrow. Sources telling us here at Bloomberg she will announce plans to slash the amount Britons can save in their tax-free cash ISAs each year by nearly $16,000. The decision is part of Reeves's push to get households to invest more in UK stocks. Apollo Global Management CEO Mark Rowan saying people have, quote, lost their minds over private credit fears. Rowan rejecting the notion that adding private assets to retirement and insurance portfolios could pose a systemic risk. According to the Apollo executive, most private credit held by insurers and by pension fund buyers is rated investment grade. Rare layoffs taking place at Apple. Sources telling us here at Bloomberg the iPhone maker has eliminated dozens of roles in its sales organization in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, looking for the edge in trade talks.
I think the question that we are negotiating is how to do things bigger and better together between our two great economies.
Former senior White House trade advisor Kellyanne Shaw joining us next. This is Bloomberg Surveillance. Good morning.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophy.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Less than 3 hours away from the opening bell, you can see a little bit of a rebound from the earlier lows in futures. Futures softer across the board, down about 0.2% for S&P. But you can see a bit of just sort of meandering after yesterday's rally. Yields marginally higher on the long end, lower on the front end, 4.03% on the 10-year. Take a look at these retail names. We are getting some earnings this morning. We're getting Kohl's, Dick's, Best Buy, Abercrombie & Fitch, Dell, HP. Just moments ago, we got Burlington Stores, which is a discounted retailer. And Danny, it did seem to be a beat, which is, again, sort of this interesting question of, is a beat on some of these discount retailers a good thing for the U.S. consumer or one that potentially belies a little bit of concern and choicefulness, as the word of the day seems to be?
You add that, and then you add Walmart doing better, getting higher income consumers coming down. Maybe it's not a great thing, but I have to say expectations clearly were very high for Burlington. Shares are down very sharply, and I wonder if it has to do not with what they're saying are great trends, but the fact that their third quarter comp sales were much less than expected, about half the rate that they expected. Maybe they didn't raise things enough. So it's one of these companies that people are like, yeah, you're a discounter. We know you're doing well. And if you don't show up and raise things more than you have, we're going to punish you.
Yeah, revenue missing. They did say that traffic to our stores fell off significantly after the back-to-school period, driven by unseasonably warm temperatures in our major markets. This comes after some discussion over hurricane season when it comes to the Lowe's and the Home Depots of the world. We'll be watching out for other retailer earnings, just as a forward-looking read on what we might expect during this holiday season. Under surveillance this morning, looking for the edge in trade talks.
I think the question that we are negotiating is how to make the deal bigger, how to make it stronger, how to make it more inclusive, how to bring in these digital Markets Act and try to improve that for digital America, how to maybe do steel and aluminum and how to include that, how to do things bigger and better together between our two great economies.
Here's the latest. Talks underway to preserve trade deals reached earlier this year. Former senior White House trade advisor Kellyanne Shaw writing, the détente between the U.S. and China is continuing to hold, and I expect it to through New Year's. I am increasingly skeptical about the durability of the U.S.-EU trade deal. Kellyanne joins us now. Thank you so much for being with us, Kellyanne. Let's just first talk about what you make of the idea of negotiating a deal for the EU and the U.S. that supposedly was already set in stone.
Yeah. Good morning. Thanks so much for having me on. This is why I'm so skeptical about this deal and frankly watching it very, very closely. The United States and Europe announced back in July that they had agreed on a package of mutual concessions, including tariff cuts going both ways. The U.S. implemented that going all the way back to August 1st. The EU has only introduced its legislation with no real hope of even passing it in the short term. So the EU has yet to cut a single tariff line. Now, the U.S. is in Brussels. You have Ambassador Greer as well as Secretary Letnick, who are there talking to their counterparts. What seems to be on the table is a potential deal on steel in exchange for concessions on the digital single market, on the DMA, on some of these digital regulations. But the EU has said that they're not budging on that. So I don't expect the U.S. to budge on steel and aluminum either, which means we have an impasse. And I think as soon as the president starts to connect with the fact that the EU hasn't cut a single tariff line, that's going to spell some serious trouble for this relationship.
That relationship has been frayed for quite a while. There are ongoing questions also about the U.S. and China, and I think that right now more people are focused on that just simply because of how essential trade is between these two economies, particularly when it comes to rare earth minerals and a couple other products. I'm just wondering what you make of the phone call between President Trump and President Xi and this idea of a visit coming in April.
Yeah, this was a really interesting conversation. It wasn't interesting so far as the two leaders spoke. They speak all the time. It's not unusual to follow up with a successful meeting and a deal that is being implemented to touch base, to talk about the trade issues, to talk about China's soybean purchases, wheat purchases, and other commitments that are coming due. But what I found so interesting were the competing readouts, and one in which China really rushed to get out. The president didn't even give his own readout for several hours later. China's was almost exclusively focused on this issue of Taiwan, on the importance of Taiwan, saying the U.S. had acknowledged the importance, talking about its criticality for the post-world international order. While the U.S. readout didn't mention Taiwan at all. It was focused on the trade deal, focused on Ukraine. And so it's this he said, she said, what actually happened in this call mystery. Now, of course, there are no transcripts available to the public about what happens in these behind-the-scene phone calls. But what is interesting is the narrative that both sides are laying out. And I think what is clear is what's on China's mind right now. I think the president's focused on this trade deal. But when the president does go visit President Xi in April, I have no doubt that Taiwan is likely to be on the agenda, at least from China's perspective.
The fact that Taiwan wasn't mentioned by President Trump, Kellyanne, does that say anything about the White House's willingness to step in should there be military action from China to Taiwan?
I certainly wouldn't read that into an omission. I think from the U.S. perspective, this call was really about checking in on the trade deal, discussions around what's happening in Ukraine. The administration has said several times over the past few months that there's no end to the Ukraine-Russia war without China's active participation. So I do think that those are the things that are likely on the administration's mind right now. I think what is clear based on what is happening between China and Japan right now, the concern over Taiwan is really this messaging campaign that we're seeing from China. This seemed to me more about a race to win the narrative versus what actually happened in the call. And I think that's why you're seeing the U.S. just not address it.
I was going to say, in terms of competing narratives, you also had the Japanese prime minister say that she received a call right after that China-U.S. call from the president. But we didn't really hear about it from the side of the U.S. Kellyanne, what do you make of that?
Yeah, clearly there is a tremendous amount of tension right now between Japan and China. China's threatening to cut flights. There is a huge diplomatic row right now over the prime minister's comments about the existential threat to Japan of any sort of military incursion by China into Taiwan. I think what the United States president is showing is solidarity with the prime minister. I think this is about saying that we are with you, we stand with our ally. I don't think the president needed to issue any sort of statement to make that point. The fact that that phone call happened was the message. And so I do think that the United States and Japan are united. But again, this issue of Taiwan is increasingly on President Xi's mind. And I think this will be a real point of tension, particularly going into those April meetings. And I expect President Xi to try to squeeze the president for something on Taiwan. And that's when we'll see what the U.S.'s real position is here.
Kellyanne, how much is it a tit for tat, this idea that if the U.S. does shift away from hardcore rhetoric around Taiwan, that China will help with the Russia-Ukraine war and potentially bringing an end to it sooner?
Look, I think that China is likely to use all of its leverage points in terms of trying to push issues that are so important to it. And Taiwan is issue number one in terms of the things that President Xi wants to do. But look, I do think that the U.S. position is strategic ambiguity. I don't think that the fact that the president hasn't departed from that, or at least said anything from that, indicates a different pivot point in U.S. policy. But again, the rubber is really going to meet the road come April, when I fully expect President Xi to push the president on this issue. And then again, we'll see what the result is. But the U.S. position, as far as I'm aware, has not changed. I think strategic ambiguity continues to be the U.S. view.
Former senior White House trade advisor Kellyanne Shaw, thank you so much for being with us. Definitely the two different readouts were notable, given the idea that people were wondering, what exactly is this phone call and what exactly will this meeting be in April?
Right. And what did President Trump say about Taiwan? What was his response? Because the Chinese angle was very clear. To them, it's a matter of sovereignty. And for the White House's response, just question marks at this point.
Yeah, and question marks around AI and just how much the U.S. was willing to sell chips into China. Coming up next, John Bilton of J.P. Morgan Asset Management, Jeanette Lowe of Strategas, Lauren Murphy of Wells Fargo, and Samantha Dart of Goldman Sachs as we get retail earnings, as we parse through the day ahead with Google very much front in focus.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What I am a little bit worried about is that the Fed is kind of dragging its feet.
It's sort of confusing what you're hearing out of the Federal Reserve.
You might not want to hold the Fed to the same standard as in normal times.
It's certainly a much more rowdy and disorderly process from the Fed than what we're accustomed to.
We will get 3 rate cuts over the next 12 months, but December's still a toss-up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks meandering after the biggest two-day pop since May, taking some heat out of that today in futures. Retail sales trickling out for the likes of Burlington earlier, Kohl's and Dick's Sporting Goods as the holiday shopping season kicks off, with traders awaiting September retail sales data in about 90 minutes' time. And Alphabet becoming the U.S.'s third most valuable company, approaching $4 trillion in market capitalization as it presents stiff competition to both OpenAI and NVIDIA. Danny, this question of disruption very much roiling the artificial intelligence space.
It does. There is so much churn underneath the surface as the market hasn't fully decided on who's the winner. We're going from the yay, everybody's a winner that does anything with AI and spends money to, hey, maybe not everybody is going to be okay. But one of the interesting things is, despite how volatile that sort of back and forth has been, it is the Fed that's dictating the overall directions of markets. It was yesterday in hopes of a cut that was lifting us up. Weeks before, it was doubts of a cut that was pushing us down.
Yeah, and this is really going to the bifurcation that you're seeing in the market. So even though we did just see the biggest two-day pop going back to May, there was, again, that bifurcation, this tale of two halves within the market, with about half the market not participating. The consumer-facing stocks not exactly rallying. You saw, for example, Carnival shares falling quite considerably. And it goes to this question, how long can the AI trade continue unless you get participation of the rest of the economy? And is the Fed too late to turn around the weakness that we've seen in certain pockets, akin to what we were hearing yesterday from Neil Dutta?
I also think that's why what El Hudsaini told us from Threadneedle was so interesting, because the idea that a productivity boom is going to come to the rest of this market and to save us, even if AI spending slows, he cast doubt on that. And that's a real problem for those that say, yes, the AI trade, but all these other companies are benefiting from it too. What happens if they don't? And what happens if that happens at the same time of a slowing consumer?
Meanwhile, this is the shopping season, and that's the reason why the retail earnings have been so interesting. We saw from Burlington, they did raise their full year forecast, still taking a beating on comp sales. Kohl's, just take a look at that. jumping 15% after their comp sales beat estimates in the third quarter. This is a company that just had a new CEO come in, but those shares really rallying after seeing full-year operating margin significantly above where it previously expected, and just beats pretty much across the board, Danny. This, to me, is really interesting.
It is fascinating. And the margin story, which you just pointed to, again, this is a sector that we assumed margins would be really bad. We assumed that they'd be paying more and they'd have to move it along to the consumer. That's not what's playing out. They're finding clearly efficiencies from somewhere else. And for a company like Kohl's that has been in such need of a turnaround plan, the idea that they're able to do it in this environment with a new CEO at the helm, again, is getting greatly rewarded by this market.
The word efficiency keeps coming back to that, and we will keep looking at that. Right now, the efficiency in market is just slightly lower after yesterday's rally. You're seeing equity futures lower by about it was 0.2%, reprising some of that as we do get some of these earnings now basically unchanged. We are seeing unchanged on the 10-year. Wow, this is not a very active board today. Coming up this hour, John Bilton of JP Morgan Asset Management, as investors maybe tap the brakes, maybe just take a pre-Thanksgiving pause. Jeanette Lowe of Strategas as Ukraine peace talks gain momentum, and Samantha Dart of Goldman Sachs on why energy is the key to winning the AI race. We begin this hour with stocks sort of meandering following yesterday's tech-fueled rally. John Bilton of JP Morgan Asset Management seeing potential for positive opportunity, and we feel the gloomy narrative on tech is somewhat overdone. John joins us now. John, thank you so much for being here. I could use a little bit of excitement and optimism this morning. I'm wondering why you think that any kind of rally is going to come on the heels of people watching the AI space and gaining enthusiasm about it again, rather than focusing on the transformation and the competitive landscape that we're seeing, certainly on a morning like this one.
Well, I think we've got to remember what tech actually is. It's about innovation. It's about the next new idea, and it's about continually challenging itself. Think back to, I think it was February time, when, of course, we had DeepSeek suddenly appeared on the horizon, and I thought, oh my goodness, what does this mean for US tech? You know, it's all over. Was it? Absolutely not. We got the strongest rally out of tech that we've seen in an awfully long time from April onwards. So I think what we're beginning to see is something of a maturation. We're seeing competition begin to come in. You know, we're seeing different opportunities using different technologies for different purposes, etc. There's a lot of money going in. This year's or this third quarter's results from the tech leaders show huge capital spending commitments, which will continue to boost the investment share. Open question on productivity. Longer term, you know, we've looked at this in our long-term capital market assumptions work. We do feel that productivity is set to gain, but it's a long burn. It requires the investment first. And so we think that there's reasons to be positive, and we think that with this cycle of investment happening now, there's reasons that we will see dips bought.
Is there enough cash and enough investor enthusiasm to supersede any kind of hiccup that would come from, say, just theoretically, a company that's worth about $500 billion and is private, that has a lot of loans, that's sort of trying to grow into the image that it has for itself, OpenAI? If you do get some sort of blow up of one of these companies that has been more speculative?
Well, look, take a step back from the individual companies themselves. There's a lot of capital in motion right now. There will probably be winners and losers out of that. I'm not a stock analyst. I wouldn't want to project as to who's who. But with the amount of capital being spent, we know that up to around 80% of total factor productivity gains typically can be explained by the upfront investment. Bigger issue we have right now, actually, again, if we take the long view, we know that the input of labour into growth going forward is going to shrink. We've got, you know, bipartisan support for clamping down on migration, and it's a global factor, by the way. It's not just a US thing. So it amplifies the impact of an ageing population. So as my colleague Dr. Kelly likes to say, someone who I know is on this show quite a lot, productivity is what happens when you run out of workers, and guess what? So we are constructive there, but we're tracking a chain of events from the investment being made to the technology being built, to the adoption taking place, and then the full deployment. No prior tech cycle, mainframe, e-commerce, mobile telephony, and now AI, has not gradually broadened out through time. So we are optimistic about the overall technology cycle here, and still in the early stages, we think.
It's incredibly complicated, though, and I was joking with Lisa earlier that, like, I, for some reason, spent a huge chunk of my day yesterday understanding the differences between TPUs and GPUs. You say you're not a stock analyst, and you're certainly not a tech-specific one at that, But is there a sort of sense that in order to be an active investor, in order to actually understand who are the winners and losers, you need to have a technical know-how that most people don't have? Does it pay to be hyper-specialized on tech in this kind of environment?
Well, I think the same is true on any sector. If you get down into the depths, if you don't know the difference between an oncology drug and a therapeutic, you're not going to be a very good pharmaceutical analyst.
But this is a sector that dominates the market, though, whereas you can't say the same for pharma.
But fair point. But if we think about it, you can break it down into the jobs that tech is doing. Highly specialized functions need that real top-end, cutting-edge innovation. That's where your GPUs are coming in. Your TPUs, which are much more, brute force, can apply a lot of processing power to a more single direction. I think the ability to be able to scale and learn fast about what one is investing in. Actually, funny enough, if you think about it, that's an amazing AI use case. So I think what we can see is how we stratify different uses of AI. Are we automating simple tasks? Are we doing large model, sort of modeling of very unstructured data? Those are two different endpoints. But just having that basic understanding of what's leading where, I think is reasonable as a financial analyst anyways.
To that point, there was the dream of agentic AI and super intelligence, and it's something that Sam Altman talked about, Jensen Huang, and it's a thing that really built up stocks and had this, I don't know if you want to call it bubble, but anyway, high valuations because of this far promise in the future. Has something changed? Have we decided that we care less about what's happening in the future and more about the here and the now in terms of profitability and actual use cases of AI?
Well, I think there's a little bit of both, really, because I think that we always want innovation. It's one of the reasons why we continue to see that the US carries on dominating global market capitalization, even out 10 to 15 years from now, when we look at the work we've done in our capital market assumptions. So that innovation cycle is incredibly important. But at the same time, this is what separates in our mind from the dot-com era to where we are now. We've got high-quality, cash flow generative companies making investments that actually have real-world gains. And once more, I'd come back to that point. Productivity is what happens when you run out of workers. And that's the biggest driver to us. It's not the robots coming for our jobs. It's the fact that there are fewer of us, and we still want to be able to sort of develop processes and growth around that.
This is the reason why people are having such a hard time getting a handle on what exactly is going on with the economy during this transformation that has a very different kind of time frame. We're going to be getting ADP payrolls numbers coming up on their weekly at 8:15. At 8:30, we're going to get backdated, stale data from September. We are getting details from some of the retailers who are reporting earnings today. I'm not going to have you comment on them because I know you're not a single stock analyst, but it's been generally a positive read. It hasn't been gloom and doom, and yet what we're hearing from a lot of people is that there is a lot of gloom and doom, and you are seeing that in the bifurcation of market performance. Do you think that is overstated in the non-tech names or not tech obvious names, the idea that the consumer really is a lot weaker than it might seem?
Well, I think there are differences in the consumer as you look across income cohort, for instance, but we know that the dominant piece of retail sales of any sort of activity in the consumer space is driven by the upper income brackets. Where we will get some impact, though, of course, and this is the delayed impact of the Fed, will be on gradually lowering those costs for consumers across the board. We're also seeing oil prices reasonably stable, which is great for households at the end of the day. These operate with a lag. Right now, if we had a very exuberant consumer, I'd feel much more concerned about the outlook for the economy. When you've got the consumer, we've got consumer sentiment really, really weak. In Europe, 15.3% household savings rate. It's the highest we've seen outside of the pandemic. The consumer has actually a surprising amount of coiled up sentiment and coiled up savings as we look around the globe more generally to put to work. We get big issues, a thawing between Washington and Beijing, as we've seen a little bit of. Possibly, and we hope, perhaps steps towards peace between Russia and Ukraine. As we get some of these big sort of geopolitical overhangs working their way through, the potential for a pickup in sentiment could be quite powerful from the consumer's perspective.
And a lot of retailers are trying to get ahead of that and build up their portfolios. John Bilton, thank you so much for being with us. Have a wonderful Thanksgiving, if you celebrate. John Bilton of JP Morgan Asset Management. And we are seeing certainly Kohl's shares absolutely surging now, up more than 20% after those earnings. But what you can see across all of the earnings is a tale of different corporate execution. And this question of efficiency, this question of market share, this question of which goods they can actually raise prices on. And Danny, to me, that's the reason why it is so hard to get a more macro read from some of these micro earning reports versus just corporate strategy to adapt and adjust.
It's such a good point because you've seen it all throughout earnings season. Does the fact that all of a sudden the fast casual restaurants are doing really poorly, does that mean everybody is doing poorly, but TJ Maxx is doing well, Kohl's is doing well, Walmart is doing well. Is that a good thing or a bad thing? It is a choose your own adventure, depending on what company you pick and what narrative you want to build around it.
Just give more protein. That's, I think, what we've learned. Anyway, we'll get into that, or we won't get into that. Let's get to an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie. Vonnie, thanks so much.
Lisa, thank you. Tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back phone calls with the leaders of both countries. China's foreign ministry saying the U.S. initiated the hour-long call with President Xi Jinping. Trump then called Japan's prime minister to reaffirm their ties. Any sign that the U.S. is siding with Japan on Taiwan could jeopardize its trade truce with China. A federal judge has thrown out the criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruling the prosecutor who brought the cases had been illegally appointed. And nearly 2 years after the mid-air calamity that plunged Boeing into crisis, the company says it's making progress in its war against defects at its 737 jet plant factory. The company's efforts include weekly meetings where employees discuss on-the-job impediments and irritants. Boeing says it's seen encouraging results and is planning to increase 737 output to 60 jets a month. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth.
Jeanette Lowe of Strategas joins us next. This is Bloomberg Surveillance.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Less than an hour till ADP Tuesday. It kind of doesn't have the same kind of ring, and yet we are going to get ADP payrolls data coming out at 8:15 that might give us a little bit of a current look at the underlying economy. Right now, stocks doing nothing, futures basically unchanged. On the S&P, we're tracing losses from earlier this morning. We are seeing 10-year yields marginally higher, but lower versus where they were this time yesterday, 4.03%, and crude just off by about 0.4%. Under surveillance this morning, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth. I have watched as the president and his team have worked around the clock overnight with both sides on endless phone calls, endless meetings to try to bring this war to a close.
Here's the latest. Peace talks between Russia and Ukraine gaining momentum. Sources telling us here at Bloomberg, a U.S. official is meeting a Russian delegation in Abu Dhabi ahead of President Trump's Thanksgiving deadline. Bloomberg's Mika Solner joins us now. Mika, what's your sense of where we are? It's gotten from a 28-point now to a 19-point. How close are we actually getting to some resolution in this push for a peace negotiation?
Well, the White House is very adamant to bringing this war to an end, but they have softened that Thanksgiving Day deadline, which is obviously just a couple of days away. But I know that, that they're really trying to stress and emphasize. We just heard White House Press Secretary Caroline Leavitt say that they're negotiating strongly with both sides. Now, this is to say the White House is also facing some criticism, saying that they're playing too much into what Russia wants. So we're going to see what they're doing there, and they're trying to work out those kinks now.
Mika, do we have a sense of what Europe's role is in trying to negotiate this and get back on the stage when it comes to trying to understand what the discussions are, who's having discussions with whom?
Yeah, I mean, I think that the White House says that they're working very closely, trying to keep everybody in communication. And I know that there is a consensus that everybody wants this war to end. And I think that the U.S. is working strongly with European allies in terms of rebuilding Ukraine. But right now, they're still negotiating out a lot of this. The deal keeps changing and shifting. And so we're really going to see what comes. But I know that these talks are ongoing, and the administration believes it's making strong progress here.
Mika Solner, thank you so much for being with us. Jeanette Lowe of Strategas writing, it remains a question as to whether negotiated changes can hold and if Putin will agree to the ultimate plan. Jeanette joins us now. Jeanette, what do we know about what's been taken out of the initial 28 points that could potentially bring Ukraine closer to agreeing to this?
So, I mean, there's a couple of things that definitely started to push things a little bit more towards Ukraine's favor versus Russia's favor. That would be things like allowing Ukraine's military to be larger than it was under the 28-point plan, the potential for it to still be allowed to enter into NATO at some point if there is agreement, to allow NATO troops to be in Ukraine, but not on a permanent basis. So those were some things that allows Ukraine to have a little bit more stability with regards to its military, but then also having more security guarantees longer term. So we'll see if that holds. I think one of the issues has always been whether or not Putin really will agree to a deal. I mean, he came to the Alaska summit, made it seem like there was going to be progress made with President Trump, and then basically the talks went nowhere. So I think that remains to be seen. We hadn't seen Putin specifically say that this would be something he would agree to, even when it was the original 28-point plan, whereas there was much more pressure on Ukraine to actually agree, and it was left to kind of see then what would happen with Putin on the other side.
Given that after this, or as this negotiation has been going on, we had the call yesterday between Presidents Trump and Xi. What role will China play in this? Do you think that they will be able to exert pressure on Russia to accept any sort of deal?
You know, it's interesting because I think one of the things that we've been watching too is what's been happening in Venezuela, and could that be an effort to try to put more pressure on Russia to accept a deal? I think there could be some pressure with regards to China to try to get them to get Russia to accept a deal as well. It also could be just China watching what's happening. Maybe they hadn't been involved in these discussions and wanting to make sure that they were at the table and kind of seeing what might be at play with Ukraine and thinking that there might be some similar tactic that might be taken with regards to Taiwan, since that obviously was a piece of the conversation that they held yesterday. But I do think Trump is really trying to push Russia to get to a deal. We'll have to see if that ultimately is successful, but he does want the war to end. He does kind of want lower oil prices, getting that geopolitical premium out of the oil prices. He probably also wants to separate Russia and China and having some those linkages during the war, breaking those apart a little bit, as he is trying to really remove the strength of China overall, kind of also focusing on decoupling the US from China. All of those things are coming into play here. So I do think that ultimately it was probably more still about trade and Taiwan and issues with Japan at this point, and maybe even less so about Ukraine.
I was going to say, when it comes to trade, does it make any difference that these Ukrainian negotiations are happening at the same time that you have Trade Representative Jamieson Greer and U.S. Commerce Secretary Howard Lutnick in Brussels trying to negotiate yet again with the Europeans on trade deals with the U.S.?
Yeah, I mean, it was obviously interesting that the Europeans were a little bit caught off guard by the original 28-point plan. So things are also within the administration kind of focused on very separate tracks at the same time. Things are definitely in their own lane, and then they do have spillover effects. But obviously, this has been something with regards to the EU and the US that there has been a little bit of tension with the Europeans thinking that with the steel and aluminum derivative products and things like that nature, that it seems like the 15% tariff rate that they've ultimately had is not going to hold and is not going to be as beneficial to them. They're obviously also looking for other tariff exemptions, thinking about things like wine and spirits and pasta. So there's also that very separate thing. But I think those I would probably tease apart. I think this is much more focused on there was the effort in Gaza that was relatively successful. The administration wanted to take that momentum and put it towards getting some sort of deal with regards to Ukraine. And there's obviously this piece about trying to put a little bit more pressure on Russia with regards to oil, with Venezuela. And I think now there's just trying to see if we can actually get to a deal. But I do think Putin is probably the bigger question mark here.
There's a potpourri of issues here, and I'm trying to parse out how much is cost of living issues, how much is some sort of domestic win to celebrate international victories, and how much is an effort to work with allies and really get some sort of understanding that can hold. How much of it do you think is a cost of living issue that makes the U.S. more amenable to potentially lowering tariffs or being more cordial in some of the discussions in order to at least lower anything that people pay back home?
Yeah, I mean, I think the one thing here is that the oil piece, even before this affordability issue has really kind of come to the fore over the past few months, the oil premium that, him trying to say, I want to end wars, I want to lower oil prices. This was something that Trump pointed out early on in his administration before he came in, and then early on in the beginning weeks and months. So this has always kind of been his goal here. So I think this is less about affordability and more about getting the war ended, but still having lower oil prices. The tariff exemptions, obviously, to some extent, were about lowering prices, but the administration had also flagged this early on. You've always had Secretary Lutnick talking about the fact that the U.S. doesn't grow mangoes and that we'll probably have to exempt goods like that from the tariffs. So that is where we have ultimately ended up. Of course, it's happened as the conversations about affordability have really grown. So there is that component to it. But the fact that they've decided to make the exemptions across the world for all of those goods. But even if you get some additional exemptions, let's say with Europe, and there's a cost coming down in some of those things, it's really not significantly large. We looked through all of the tariff exemptions that came out, and it only really reduced tariffs on an aggregate basis by $7 billion. And we still have nearly $380 billion worth of tariffs in place. So it's really not going to lower overall prices. It's really much more targeted at specific food items and that affordability aspect.
Jeanette Lowe of Strategas, thank you so much. Currently, affordability very much front focused during the retail season, and we've heard from some retailers about how they're handling it. A real motley picture here. I got to say, Danny, I mean, you look at the performance of these shares after they report earnings, and it's, again, choose your own adventure. It seems like everything is, as you were saying earlier, with some really delivering and some talking about efficiencies, Dick's potentially closing some Foot Locker stores.
And they're saying that even though they've boosted their outlook for a second quarter, and shares are being punished because everybody's looking for cracks, and the fact that they might need to turn to efficiencies, maybe that's a crack for Dick's Sporting Goods.
And this is the reason why so many people say this idea that AI made us cut jobs isn't really the story. It's actually, we're just looking to cut money, to cut costs and preserve our margins. Coming up next, we'll be talking about that with Lauren Murphy of Wells Fargo, as holiday shopping offers a fresh read on the consumer. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
About 2 hours away from the opening bell, and you can see futures just trying to find some kind of direction after being down as much as 0.2% on the S&P, now essentially flat. Even NASDAQ futures have really retraced. Yesterday was the biggest one-day pop going back 6 weeks, biggest two-day pop for both the S&P and the NASDAQ going back to May. The Russell 2000 turning around, up 0.2%, possibly on the heels of some comments from Fed officials yesterday. Take a look at 2s, 10s, and 30s, and you can see in the bond space, particularly on the front end, a bid. And this really comes after we saw San Francisco Fed President Mary Daly in an interview with the Wall Street Journal say she would support a Fed rate cut next month. She is not a voting member, but definitely is considered an ally of Fed Chair Jay Powell. There also has been Chris Waller, who wants to go. Of course, John Williams has also indicated, which is the reason why you are seeing a bid into that space. Here are your morning movers with Vonnie Quinn with 2 hours away from the cash open.
Well, Lisa, one of the narratives that's going to dominate today is TPU versus GPU, right? What are the switching costs? Would companies want to even switch? And that's because Apple is in the news, obviously up 4.25%. Meta is in talks, according to the information, to buy billions of dollars worth of Google's TPUs. Now, it could have gone the other way. It could have gone and bought NVIDIA's GPUs. It didn't. And the question is, are TPUs better for inference? Are they more energy efficient? What would it mean down the road? Does it mean the beginning of the end of the NVIDIA dominance? It's a big question. So you can see NVIDIA down about 3.5% off its lows of the session, AMD down 3.8%, and those Alphabet shares rising. Let's get to some of the retailers now, because we had many report today. One of the better stories, Kohl's up 22%. That stock already up about 12% this year. So the interim CEO, Michael Bender, who was put into the position in May, has really proven himself in the third quarter, definitely stabilizing Kohl's. He has now been named full CEO. He is in that position from now on, and today bears him out. So sales were still down, but only by 1.7%. The estimate was for a decline in the third quarter of 3.9%. And for the full year, the outlook is now comp sales being down 2.5% to 3%, as opposed to down 3% to 4%. So you can see the ranges are a lot better. Different story at Dick's Sporting Goods. So Dick's down about 10% on the year, down another 8.5% today. It did raise its outlook for a second straight quarter, citing sales from existing stores. But consumer sentiment down in November, as we know. And this, how does it, bring Foot Locker into the equation? Well, CNBC is saying that it's actually going to sell some of the existing Foot Locker stores. And so that's one of the parts of this story. Adjusted earnings per share missed at $2.07. The full year forecast did get boosted, though, but obviously investors not buying this particular idiosyncratic retail story.
Thank you so much, Vonnie. There is this question of Abercrombie & Fitch as well. Those shares popping more than 10% after reporting better than expected earnings across the board. We'll get to that in a bit. What you are seeing, though, is, Danny, a sense that their third quarter comp sales came in Not exactly well. They came in actually below, but you did see overall net sales increase and a sense going forward, some commentary saying people are really buying more strongly heading into the holidays.
It does contrast with what we've heard elsewhere, to be fair. You've had, Bonnie was just talking about Dick's Sporting Goods trying to close some of their Foot Locker locations. It speaks to this moment where if companies do innovate, and Abercrombie & Fitch has really changed their lineup, or you look at Gap, who's leaned into celebrities and different collaborations, that there is money to be spent. It's a story that's been evolving for the past few years. It's a consumer that has money to spend, but it's choosy, which makes it hard to develop an overall narrative about where we stand.
Yeah, the commentary coming from the C-suite. We achieved 3 years of consecutive quarterly sales growth, delivering record third quarter net sales with 7% growth to last year. The strong finish to back to school and fall seasonal transition very much front and focus. Meanwhile, spending on other things is on our radar this morning. Meta reportedly in talks to use Google's AI chips in data centers. According to the information, the agreement would help establish Google's chips as an alternative to NVIDIA's. The deal hinges on whether the chips demonstrate power, efficiency, and computing muscle. That is what Bonnie was talking about with TPUs and GPUs. Meanwhile, Apollo CEO Mark Rowan saying, quote, people have really just lost their minds when it comes to concerns over private credit. Rowan rejecting the idea that adding private assets to retirement and insurance portfolios can pose a systemic risk. Danny, this is what we've heard from so many of the titans of the private asset management world.
Yeah, because it's really hurt them. I mean, you look at the share price of these publicly traded companies of private credit, private equity, and they have been really damaged by it. I think it's a fair argument to make that it's not systemic. There can't be a run on the bank with these kind of companies. But maybe what some of the wobbles do demonstrate, and Mark Rowan has talked about this, that we are late cycle dynamics. So much money has been poured into the sector. It's no longer a niche corner of finance because of insurance money, because of the move into wealth, and that money has to be put at work. So has due diligence softened? Has it been moved to the wayside? And does that mean the certain blow-ups or at least stress you've seen just does become more commonplace?
So late cycle in private credit, early cycle in the economy, early cycle in some sort of downturn. I'm getting lost in terms of what inning, what cycle we're in, because I've heard 5 things this morning alone, Danny.
Yeah, maybe we're just, the cycle is dead. Maybe that's the answer, that the cycle doesn't exist.
Well, maybe we'll get some inclination from U.S. economic data. It is getting back on track. Sort of. Delayed September PPI and retail sales due this morning at 8:30 a.m. September PCE now set to be released on December 5th. Meanwhile, a slew of results from the retailers, as we've been talking about, continue to give insight into the U.S. consumer. And sticking with retail, just days away from Black Friday and the unofficial start of the holiday shopping season. Lauren Murphy, Retail Finance Managing Director of Wells Fargo, writing, holiday shelves are full, but prices may rise in 2026. Lauren joins us now for more. Lauren, thank you so much for being with us. We've been trying to get a read on the holiday shopping season this morning in an ad hoc way with all of the earnings reports that have been coming out. Do you have a better sense of exactly any consistent themes running throughout the retailers?
Yeah, so I think the good news is retailers, as I mentioned, are well stocked. The inventory is on the shelves. They're ready to meet their consumer where they're at. I think the constant theme is just this question of consumer sentiment and really what is going to be needed to get that consumer and traffic in the door this holiday.
Lauren, there have been various notes this morning. One from UBS Securities saying that consumers' willingness to spend has waned and they expect a mediocre finish to the U.S. holiday season. BMO on their survey saying that consumers are going to raise their spending on the holidays more moderately than they have in the past. What are you seeing? Are you also seeing that softening around the edges of a consumer spending this holiday season?
Yeah, so Wells Fargo economists are forecasting that holiday sales will be between 3 and 4% increase year over year. However, that is not accounting for inflation. So I do think that consumers are seeking out value, they're seeking out discounts, and they're really mindful of their wallet this holiday.
A lot of what we've heard from the retailers too, Kohl's being one of them, having a really good quarter, Best Buy, another one that's lifted their outlook because everybody is buying the new iPhones. Lauren, if there is this concern, is there a scenario where people have spent all of this money because they're concerned about the future? They're concerned about where prices go, where employment goes. So past strength can't necessarily be indicative of future strength.
That's right? This is still the prime time spending season between November and December. And we think retailers did a really good job trying to keep prices low heading into this holiday, pulling up forward inventory purchases ahead of price increases. I think we're seeing that in the results. We haven't seen the margin hits that we were probably anticipating. However, what we're hearing from our retailers is that may be coming in 26, right? They're trying to hold the line right now. However, the question is if they're going to have to increase prices just because they can't sustain it any further heading into 26.
And this goes to a question a lot of people have been asking. Have we already felt the ramifications from the tariff costs? Have they already been borne by a lot of these companies, or are they yet to come? Are you saying that they're yet to come?
Yeah, I think what we're hearing is there is a lag, right? Where people are, what we're seeing in the margins today are still at that pre-price increase because they pulled forward so much inventory in the first quarter. However, what we're hearing is that we do think that there will be further margin prices heading into Q1, Q2 next year.
Do you have a sense of how much prices will increase? Is it just commensurate with inflation? Is it beyond that? I mean, is there a range that retailers are getting a sense of during the holiday season based on what they can pass along and where now?
Yeah, I think that's a great question. I think what we're seeing, at least in this holiday season, is that there is a mixed bag of discounting strategies, right? And I think how that falls into price increases, where you're seeing retailers capping markdowns on well-selling items that still may have value that the consumer is still going to show up and buy, or they're trying to expand their discounting strategy to make sure that they're getting, that more consumers are getting value for a particular product. So I think it's a mixed bag, and that's more on the margin side. But as you relate to the price increases, I mean, I really think it's going to see where they have to hold the line and making sure that they're hitting their margin forecast because they're all worried about their bottom line P&L.
What about within the subsectors, Lauren? Are there certain parts of retail that are facing price increases more than others?
Yeah, I would say right now, most immediately, we're seeing it in home furniture, home goods, right? I think because there was such a high preponderance of sourcing in China in those industries, the price increases were just too swift and they're already being passed through. However, I think we're seeing better resiliency in apparel and some specialty items as well. So I do think consumers are going to hopefully benefit from that this holiday season.
Is the home goods also an issue, just the fact that we've seen some of the big box home improvement stores that they continue to lag because of issues within housing? How does that trickle down to a home goods sector, for example?
Yeah, I think furniture is a good example, right? We're seeing a little bit more distress in that sector, knowing that just consumer spending, discretionary home sales, et cetera, right? People aren't going out purchasing houses, therefore they don't need to furnish these new houses. And so I do think that we are seeing the immediate impact of that across the sector.
Lauren Murphy of Wells Fargo, thank you so much for taking the time. And Danny, do you go to the store ever on post-Thanksgiving and celebrate by shopping?
As a creature who has a natural level of built-in anxiety, I can't do it because it skyrockets. I am one of the ones comfortably on my computer, like a cup of hot cocoa on one hand, scrolling through the deals. That's more my speed.
I think that you're more the common denominator
Probably.
than you are the exception at this point, given how many deals and offers I've been getting in my inbox. But it seems like people definitely decked out. Interesting to see some of the retail earnings that have come out this morning. A more positive tone than not, aside from Dick's Sporting Goods, but a sense that if you have a product that people want to buy with efficiencies, a lot of them are resurrecting some of their post-pandemic malaise.
But that's also why I'm kind of scratching my head, looking at, again, the notes that I mentioned from BMO and from UBS Securities saying that this is a consumer whose spending is waning. You're not necessarily seeing that across the board, but maybe it gets back to this issue we've been dealing with. People will say one thing and then they still buy when faced with deals.
Yeah, this has been the conundrum. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Gwynn. Vonnie.
Lisa, thank you. The European Union is rejecting the US's demand to ease tech regulation in return for lower steel tariffs. The EU's antitrust chief says the bloc's digital rulebook is, quote, not up for negotiation. The comments came after Commerce Secretary Howard Lutnick told Bloomberg his administration could relax levies in return for the rollback. President Trump signing an executive order on Monday establishing the, quote, Genesis mission, a federal effort to boost innovation using AI. It aims to coordinate research done by government agencies to integrate AI tools. Officials say the push will accelerate scientific discoveries in engineering, health, sciences, and energy. In sports, the San Francisco 49ers beat the Carolina Panthers on Monday Night Football. 49ers running back Christian McCaffrey had over 140 yards from scrimmage and a touchdown, while the San Francisco defense held Bryce Young and the Panthers to just 9 points. The Niners improved to 8-4 on the season, and Carolina falls to 6-6. That is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, powering the AI build-out.
We are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy.
Samantha Dart of Goldman Sachs joining next. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield back on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Day 3 of a rally after 2 straight days of gains that were some of the biggest that we've seen since the post-Liberation Day rally. We are seeing an S&P futures, at least, that are turning around after being down as much as 0.2% earlier. NASDAQ also turning around as people get a little bit more optimistic about the efficiencies and some of the new progress and new developments going on there. You are seeing a little bit of a lift in longer-term yields, but just 4.03% on the front end of the yield curve. You do see a bid with the Fed very much in focus. San Francisco Fed President Mary Daly endorsing the idea of a December rate cut. Under surveillance this morning, powering the AI build-out.
Everything is about energy, right? Energy and technology are the main drivers of productivity. And we are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining.
Here's the latest. Electricity demand set to surge as the race to revolutionize AI calls for more energy. Samantha Dart of Goldman Sachs writing, as AI demands massive power, a reliable and ample power supply is likely to be a key factor shaping this race. Samantha joins us now. Sam, thank you so much for being here. Let's start there. The idea of a race against whom? Is this China versus the U.S. and a question of who can get the most computing power and then who can actually power said programming?
Yeah, these are the two front runners. You have today the U.S. holding over 40% of all data centers in the world right here. But China's number two, a little over 20%. And when we look at what's ahead, do we have the capacity to keep this going? I think that's where the differences really start to show, because in the US, we're already seeing about 8 out of the 13 power markets, regional markets in the US, already strained during peak summertime. Whereas in China, spare capacity is not only much larger, but we estimate it will get even larger over the next 5 years.
So without the U.S. building massive amounts of power the next 5 years, which is really going to be the time when AI is really ramping up, this really comes down to efficiency and how much more efficient can chips get, which is the reason why everyone's focused so much on Google today and this idea of their TPUs, the idea of a more efficient chip that uses less energy versus NVIDIA's GPUs. How much is that important and a necessary ingredient for the AI race to really continue in the United States?
I think it's key, because otherwise we're just not going to be able to add enough capacity to continue to fuel this. So, for example, already this summer we saw the Eastern Atlantic market in the US, the power market, really tight. We saw real-time power prices spiking to reach record highs. We saw capacity auctions reaching record prices. So it's the market positioning not just to price your peak summer price very high, but hey, we're going to need to pay utilities a lot more to build additional capacity in the long run, because what we have is just not sufficient. So either we get more efficient, or we're going to start to see bottlenecks, or at least a slowdown in the addition of data center capacity in the U.S.
How much is there a timing mismatch? Because everybody's running to the gold rush, the field of dreams, build it and they will come, trying to build more energy capacity. Presumably it takes some time for these to get online. Is there a concern that we are ramping up so much with our demand of AI and what we're expecting versus the ability of these projects to come online?
Yeah, it's almost like you have two lines. The data centers are coming in troves, and on the power generation side, it's not that it would normally take so long. You would ordinarily build a natural gas-fired power plant in 2 years if you had the turbine. But we have a 4 to 5 year queue to get a new turbine if you want to start a project today. So you're having to rely on other sources. And what do you have? Well, we're still building a lot of renewables, but they are intermittent, so they are not always there. You need something to back it up. We can't build nuclear because every time we try, it takes many, many more years than planned, and it costs a lot more. So we're sort of running out of options if we don't have that efficiency gain in the very near term. And the result ends up being that our peak summer periods are going to be tighter and tighter in power markets and giving room to price spikes and potentially even outages.
All this conversation also just always leads me to think, what does Europe do? Europe already faced an energy crisis. They're still trying to wean themselves off of Russian energy. Can they compete when even without data center demand, they struggle to get the capacity that they need?
Yeah, I think it's unlikely they can compete. And a lot of that is because they haven't even secured their energy sources. So when we think about who has enough energy to power all of this. And the US has already become an energy net exporter. But if you look at Europe, even though a lot of Europe is not using Russian gas, for example, anymore, that dependency just switched to imported liquefied natural gas. You still have to import it. So almost 50% of Europe's energy has to be imported. So that dependency is still there. The grid is very old. They don't have rare earths. They don't have uranium. So it's a very vulnerable place to be.
So let's start talking about some price levels. Liquefied natural gas, how much do you see prices increasing, say, in the next 12 months?
Actually, we're now starting a wave of supply growth in liquefied natural gas, and the U.S. is a big driver of that. The U.S. is going to drive more than 50% of global growth in LNG supply. So that's the bright side for Europe, if I can find one, is that their access to energy is likely to become more affordable over the next several years.
So this is the conundrum. You have, on one hand, the liquefied natural gas prices going down because of supply. You have actual gasoline, diesel, also diesel, I guess less so, but prices going lower because of the supply glut that you're seeing coming out of the Middle East and other places. So where is the crunch going to happen, right? Where are the prices going to go up so materially that people are going to really feel the pain?
Yeah, I think at least in the U.S., what we're seeing so far is that the bottlenecks and the price pressure points, I think, are more likely to show when it comes to power price than, for example, natural gas prices or even gasoline prices. So it's really a power story a lot more than gas.
This is an administration that's increasingly been focused on affordability in recent weeks. If the net result of what you're talking about is everyday consumers also feel that higher energy price, is there anything the administration can do to solve these bottlenecks, or do they just need to be worked out?
That's a great point, because we're here talking about potential bottlenecks on infrastructure. But if it becomes a political issue because electricity prices are rising, that becomes another type of bottleneck. And because we can't really fix infrastructure building that fast, the only thing that policy can do is just make permits come a little faster. But if we can't get a turbine in less than 5 years, we still have a problem.
How much is this ultimately going to rest with the hyperscalers having to pay for the power themselves and create their own power plants